The China connection comes on at the top of the next hour, and Emily Tan is here with a sneak peek on some of the stories she's watching. Emily, you're watching a very interesting story today. Hong Kong overtaking Switzerland as the world's largest offshore wealth hub. Tell us more about this.
That's right. JP, we have this coming through in a report from the Boston Consulting Group, with Hong Kong overtaking Switzerland as the world's largest cross-border wealth hub. This being driven by IPOs as well as capital inflows coming through from the mainland. As we all know, Hong Kong managed to retake the #1 spot in IPOs last year, 114 listings, $37 billion. And in the first quarter of this year, 37 listings raising over $13 billion. Not to mention there's 500 IPOs in the pipeline. So that's how it stands in the top 5 there. It's really a razor thin edge that Hong Kong has the lead over Switzerland. But in terms of the outlook, the growth of this wealth is expected to be continuing. For Hong Kong, there's expected to be growth of about 10% over the next couple of years, 9% annually projected through 2030, and that will help Hong Kong secure its #1 spot. That is compared to Switzerland's 6% growth annually in the coming years. We are looking at the Hong Kong market, and in particular, we want to look at some of the property stocks, because when we're talking about inflow of capital, this is supporting the property market, liquidity boosting overall economic activity and fueling a wave of optimism in the Hong Kong property sector. And with that, according to the Rating and Valuation Department, showing that Hong Kong's lived-in home prices rising for an 11th straight month, and now for the index at a 30-month high, standing at 316.6, up 0.89% month on month, but year on year up 10.5%. So with that, the CBRE expects a strong momentum in the primary market, driving wider recovery across Hong Kong's property sector, although we're not seeing that play out in the Hong Kong property stocks here. Today, we're seeing a down session with the Hong Kong Hang Seng Index also lower on the day. So that's what we're watching out for here in Hong Kong. JP, it's back to you.
And definitely a lot of interesting things to track when the China connection comes online in about 23 minutes. Emily Tan, thank you so much. And we'll be staying tuned when Squawk Box wraps up and hands it over to you. Thank you so much, Emily Tan. Meantime, earnings season in full swing. China's social media platform Kuaishou beating first quarter estimates thanks to the rapid adoption of its flagship AI video generator called Kling AI by both corporate and individual users. Sales for Kling surged over 300% since its inception, with Kuaishou describing it as the source of its second growth curve, with overall revenue also growing by more than 3%. That's compared to a year ago. Shares of Kuaishou now up by about 1.8%, defying the broader downturn in Hong Kong at just over 46 Hong Kong dollars apiece. On the flip side, Pinduoduo missing first quarter profit and revenue estimates, setting shares lower by 10% overnight. The U.S.-listed Chinese e-commerce group, which operates the Temu app internationally, has been investing heavily to boost its supply chain network. Pinduoduo also faces cutthroat competition from rivals back home, such as JD.com and Alibaba. And finally, ByteDance reportedly considering boosting its capex this year to as much as $70 billion as part of a broader AI push. And this comes as the TikTok owner doubles down on its AI infrastructure efforts. Remember, ByteDance is also potentially partnering with U.S. chipmaker Qualcomm to secure millions of Qualcomm chips to help support its AI data centers. Sources say the expenditure figures are preliminary and are subject to adjustment at least every quarter. All right, let's take a quick break here. Back in about 2 minutes. Final stretch of Squawk just around the corner. Don't go away.
Let's take a look at Asian markets, how they're doing this morning. And we do see some patchiness, or well, actually just red is really the dominating color on the wall there. The Kospi is letting go of some steam. I'm not going to call it a correction in all this. I mean, just given the rally that it's had. And, you know, TAIEX over in Taiwan looking pretty resilient, adding on about 1% despite the softness in the rest of the pack here. And I do want to get a check on GGB markets. So we've got yields edging higher. It's a mixed bag, but edging higher on some of these durations, but now they're turning around a little bit. So really the market is showing how it's digesting, I guess, in real time. But it's really the story of fiscal spending here. So we've got reports suggesting that, of course, we've got Prime Minister Sanai Takaichi's party planning to use so-called bridging bonds to finance certain investments. This is according to a draft proposal reports on this at this point. And I think the market is showing some caution around this and digestion as well. Asia chip stocks definitely worth checking every single day, probably every hour, because this is really the sector that has garnered global attention. And we've got the green for some of the Chinese names. And there we go. So Huawei really rallying hard, close to 7% of gains, and South Korean names letting go of some steam. Julia Wang is the CIO at North Asia and Nomura International Wealth Management, joining us live this morning in Hong Kong. And, you know, this memory story, I think, because I remember wanting to get your thoughts on this sector last time, and we were just so busy talking about something else that I wasn't able to. And now I feel like semi is really the sector that is sitting at a crossroads. And then I see a lot of heated debate over what to do. How does this make sense? And is it structural? Is it cyclical? I want to start there with you, Julia.
Okay, sure. So definitely, I think it's structural. I think that, you know, there's always a lot of doubt and skepticism around this whole AI story. But I think that what we saw this year was the explosion of agentic demand for AI, and the effort around, you know, physical AI really shows that there's a very long way ahead for this technology development. So I think that the rally, although it has been very strong, we believe that most of that are justified from an earnings perspective. It doesn't mean that the pace had to be so quick, but I think that the prices don't look out of whack with what, you know, earnings have come through. And some of the projections, although you can say maybe the projections look pretty robust in that sense that some of the players, when we can't say with the painting a broad brush, maybe some of the players, it looked like the valuations are now much fuller than before. But I think broadly, it's still a story that you can say is fundamentally very justified. So I think what really has probably caused a lot of anxiety is really that the lack of the follow through from the rest of the market when it comes to AI, when it comes to the equity market. The other sectors have not caught up. So that makes the AI story look like it's standing in a kind of a category all of it on its own. Yeah. But I think that's more to do with the macro problems and worries and concerns that we've all been talking about over the last couple of weeks, like the war and inflation, rate hike and things like that. And if we do see those concerns start to ease, we actually could see a catch-up play. Because I think that the AI productivity growth really is a real one. Some of the memory stocks, some of the GPUs and CPUs, yes, that's where the certainty is. But the productivity benefits are starting to filter through to the real economy as well. Because you look at the real economic data, they look pretty resilient. You would not have imagined this level of resilience if you know that the war was going on and oil prices would have briefly hit $110, and central bank would be thinking about, you know, pivoting from rate cuts to rate hike. So the underlying economic resilience show that actually economy is actually much better this year compared with the last few years, and that's because of technology change. So we do believe that actually the rest of the market can also benefit economically from what's going on the technology front, but it just needs that macro worry to kind of maybe take a pause or hopefully go away.
Exactly. And, you know, when that moment comes, perhaps it's going to take some steam off of the AI trades that ran so hot, because that's where people have been hiding because of Iran war, and you're actually calling a rotation. So where does that money go? The relief money. You were talking about Hong Kong and China, and you were just talking about the resilience, the fundamental story. But is it what you're seeing in China? Because I look at earnings reports like PDD, Pinduoduo, talking about this domestic consumption story not picking up. I mean, it was such a bad earnings report. I wonder if you're seeing something different out there.
Yeah, I think that there are probably two parts to this. The first part is whether there will be a diversification or portfolio rebalancing. I think that's probably prudent. We don't think that investors should go underway to the AI story at all. In fact, I think that most of the large names that we can look at, they are probably still very fair valued. But I think the extra dollar, the cash on the sidelines, the dry powder probably can go into some of the other laggard sector in the markets. Now, where are these laggard sectors? Some of them are in the industrial space, where I think Asia broadly has a pretty big market share, but China especially does as well. So I think that a lot of that resilience is still very much there. But what did we have? We had this Iran war that fundamentally disrupted logistics, right? And we have a very big uncertainty over global growth. All of that probably held back the export and industrial sector. I think some of that, once the lid goes off, I think people can start to reappreciate the industrial sector. So I do think that on that front, the valuations are pretty attractive. Earnings momentum is actually pretty good. It's just that the market hasn't really been able to look at that. The consumer sector in China specifically, I think is not yet something we'll be very bullish on for now. I think that is truly still at this point a more cyclical story rather than something that's a little bit more structural. So probably from a logical perspective, that's kind of lower down the chain of priorities that we'll be thinking about right now. Yeah.
JP?
Yeah, Julia, what are your expectations with regards to where rates might head? In the previous notes of Nomura, I noted that there are expectations that rate hikes might actually ease. But based on our conversations with the two Fed presidents earlier on today, it seems that there's still a lot of a lot of inflation risk that they're worried about, and there is still possibility of a rate hike happening down the road. Has this changed expectations with regards to how you're viewing where rates might go, and is also perhaps changing the strategy for Nomura?
Sure. So I was listening to that previous interview when I walked in, and obviously you had Fed Chair Goolsbee, and he's the expert on monetary policy. But I would offer a slightly contrarian perspective from a market participant viewpoint. And that is, I think we are, going through a big technology change. Just look at the equity market. That tells you a lot about just how unusual this economic cycle is. When you have AI technology that can't be really fit into a macroeconomic cycle type of box, right? So, our view is that actually AI is going through a big ramp-up phase, and that's because of the economic structure. Developed market don't have any infrastructure build-up, hasn't had any for the last 20 years. So now you have AI, which really needs energy. It needs, factories. It needs equipment. It needs all of that supply-side expansion. So that's why you're seeing inflation. But the cure of that inflation is not rate hike. It's actually more supply-side expansion, which, from a counterintuitive perspective, actually requires a not overly hawkish or instinctive reaction from a monetary policy perspective. So, I think maybe it could be seen as a slight leap of faith, but I don't think policymaker needs to go that far. I mean, with the dual mandate the Fed has, they're in a fairly unique position of being able to say, just looking at the data, assuming that the war, wraps up or comes to a political resolution sometime soon, I think they still are in a position to say that maybe they can just be, holding for this year, which is our base case, but perhaps with a hawkish tilt. I think that's something that the market can digest as long as not a series of rate hike that's forecasted or a very long continuous stretch of hawkish guidance. I think that's fine enough for the market, and that's okay for us from perspective of still being relatively risk on overweight equities.
Julia, we just have a minute now, but just very quickly, does that mean that if the tech rally continues, it will still be just favoring those tech-heavy markets like Korea, like Taiwan, like the Hang Seng Tech Index? Or is there a case for possible rotation in some of the laggards later on?
Yeah, so we think that if the Iran war come to a political resolution, I think that will be a very powerful tailwind for the sectors that have been very interest rate sensitive, held back by hawkish guidance, held back by high oil prices. The things like the industrial sector, financials look quite attractive to us in certain pockets of the Asian markets as well. Infrastructure, something we talked about, and I think that investors, once the war wraps up, investors will think about reconstruction. They think about all these energy demands that needs to occur, and there's a lot of that in the industrial space that nobody's been looking at last couple of months. But we think nothing fundamentally has shifted. So I think that the risk reward for these sectors, given that they haven't done anything, actually looks pretty attractive. We don't want to go underweight on the AI story, of course. We still believe that's the growth engine. But I think a broadening of market participation from a regional and sector perspective is a very likely outcome if we see these macro war-related worries start to fade.
Julia, making the case for industrials. So thank you so much for coming in this morning. That was great. Julia Wang from Nomura International Wealth Management. Squawk Box Asia is coming right back for the very final stretch of this morning.
Now let's get a final check of how Asian markets are faring, and starting with the equity space, we're seeing that there is a big sign, at least, of markets perhaps just taking a breather after that blistering rally we've seen over the last couple of days, and indeed shades of red across many of the 8 major equity indices, from Tokyo to Taipei, from Seoul to Sydney. We're seeing signs, at least, of markets pulling back. Slight fight back there we saw earlier on today from Japanese and Korean markets, but that was short-lived. The Kospi now down by about 0.6%, and the Nikkei 225 flat to the downside. The one exception so far today, the Taiwanese TAIEX, which is which is the one exception to the broader sell-off. They're up by about 1.2% and defying some of the sluggish sentiment we're seeing here. Oil prices in Asian trade, perhaps one of the reasons why we're seeing just a little bit of confidence being taken off the table in today's session, because we're starting to see oil prices and crude futures inching higher once again. Brent crude jumping up by almost 2% in today's session at $96 a barrel. Ditto for WTI, which is just above that $90 a barrel handle, Sherry.
And that brings us to the end of a Squawk Box Asia. That was a big show this morning. I'm Sherry Kang in Hong Kong.
And I'm JP Ong in Singapore. Stay tuned, though. The China Connection is coming up next. Have a good morning.
It's 10 a.m. here in Hong Kong and China. I'm Emily Tan. Let's get to your headlines. Oil prices rebounding in Asia on reports of fresh U.S. strikes on an Iran military site and with no deal yet in sight. The elevated cost of prices is becoming a big issue for policymakers. Kaori and Joji is in Tokyo at a Bank of Japan conference.
Thank you, Emily. Well, the U.S. Federal Reserve has two mandates, inflation and jobs. Interviews with two Fed presidents this morning pretty much show which way their priorities lie. Take a listen.
I'm more attuned to the inflation risks in the immediate term than to the labor market risks.
I am focusing heavily on inflation. I'm not ignoring at all the labor market. We need to pay attention to both sides, but the labor market is in decent shape right now, while inflation is simply much too high.
Germany and China seek to deepen cooperation in a balanced way as Germany's economy minister visits Beijing. Good morning. Welcome to the China Connection. Now let's take a check on markets across Asia, and we had records being set on Wall Street. It's playing out like this. So we are seeing some softness in the market, in particular the Hang Seng Index pulling back 1.5% at 24,962. The Nikkei 225 and the TAIEX standing firm. I should point out that the Taiwan market is at a record high, up 1.25%, 44,806. We're looking to oil prices this morning after reports that the U.S. and Iran exchanged fire. A U.S. official told Reuters that the strikes targeted a military site that poses a threat to traffic on the Strait of Hormuz. The official also said the U.S. military shot down multiple Iranian drones. Both sides also seem far apart on who controls the Strait of Hormuz. Iranian media claimed yesterday that Iran and Oman would jointly manage the strait to restore traffic back to pre-war levels. But at a cabinet meeting overnight, President Trump dismissed those reports, saying no one would control international waters.
The strait's going to be open to everybody.
And who would control
it? International waters. Nobody's going to control it. We're going to watch over it. We'll watch over it, but nobody's going to control it. That's part of the negotiation that we have. They would like to control it. Nobody's going to control it. It's international waters, and Oman will behave just like everybody else, so we'll have to blow them up. They understand that. They'll be fine.
It seems like the U.S. will not compromise on two other issues that Iran is holding out on: uranium stockpiles and restored access to frozen funds. Here's what Trump had to say about those.
Would you be comfortable with Russia or China taking their stockpile of highly enriched uranium, and have they offered to do that?
No, I wouldn't be comfortable.
That
That would not make me comfortable.
Is the U.S. considering easing sanctions on Iran to allow Iran to sell its crude to market?
No, we're not talking about any easing of sanctions or giving money. No sanctions, no money, no nothing. We have control of money that they claim is theirs. We'll keep control of that money. When they behave properly and when they do what's right, we'll let them have their money. But right now, we're not doing that, and it's one thing is not contingent on the other.
The Bank of Korea leaving rates on hold as expected, even as inflation risks rise. Our East Asia reporter Lisa Kim joins us now with the details. Lisa.
Hey, Emily, that's right. The BOK leaving rates unchanged at 2.5% as expected for the 8th time in a row. This was the first rate-setting meeting chaired by the new governor, Shin Hyun-suk, and the Bank of Korea cited uncertainty includes degree of spillovers from the chip boom all the way to consumption, and also that they will continue to pay attention to conditions with regard to the housing market and household debt. The South Korean won is trading weaker by nearly 0.4%, so weakening on the back of the rate decision. And it's interesting because the BOK in its policy statement said that the won is weaker because A, of the dollar strength, and B, because foreigners are selling South Korean equities. Also, the updated quarterly dot plot style forward guidance system indicates that in the next 6 months, the majority of board members expect a 50 basis point hike to 3%, and followed closely modestly by a 25 basis point hike to 2.7%. This is largely in line with investor expectations that the bank would hike 1 to 2% until the end of the year. And the forward guidance is quite a shift from the previous one, which was issued before the Iran war, which suggested the bank keeping rates steady. But a lot has changed with regard to inflation. So the Bank of Korea revised upward its inflation forecast for this year to 2.7 from the previous 2.2. And also, we got to remember that that South Korea's consumer price inflation for April rose above the bank's 2% target. So the upward revision to inflation forecast for this year is not hugely surprising. The BOK now sees the South Korea's economy growing at 2.6% this year versus 2% previously. And Emily, the new governor's press conference is slated to start in just about 5 minutes' time, and that's where a lot of information and headline news comes out. So I'll be tuning into that.
Thank you very much, Lisa Kim, for that. Keeping an eye out on the BOK and the rate decision today, and on hold as expected. Treasury yields ahead of the Fed's preferred inflation gauge coming out later today, and we're looking at the 10-year at 4.5024%, the 30-year at 5.0262%. Japanese bond yields rising today amid fiscal spending concerns. The Nikkei reporting that Prime Minister Sanae Takaichi plans to issue called bridging bonds to finance government investment. And Kari and Joji is at the Bank of Japan and Institute for Monetary and Economic Studies conference in Tokyo, where key global policymakers are at. Kari, please bring us up to speed.
Good morning. Thanks a lot, Emily. This is the boardroom at the Bank of Japan. As you pointed out, they're holding a two-day conference here at the Bank of Japan, and central bankers from the U.S. Federal Reserve to the Bank of England and many, many others are attending this at a time when inflationary pressures are spiking and a major headache for these central bankers. We had two Federal Reserve presidents joining us live on CNBC this morning. And I first talked to Minneapolis Fed President Neel Kashkari, and I asked him, if the war were to end today, how long do you think it would take for the ripple effects and the inflationary pressures as a result of the war to work through the economic system? Here's what he had to say.
Big global companies that are headquartered in the U.S. who have global supply chains have told me it's going to take 6 to 9 months, even if there was a complete resolution, a reopening of the Strait tomorrow, 6 to 9 months for their supply chains to normalize and get back to something like normal. And so I think that these pressures are going to be with us for some time.
Inflation has been well above the 2% target for a while now. Is the Fed fulfilling its mandate?
Not yet. I mean, we are committed to it. I know that all of my colleagues are just as committed as I am to getting inflation all the way back down to our 2% target while maintaining a stable labor market. That's our goal. We have a dual mandate in America, and we have our work to do, but we're committed to completing the job.
And Neil, this is Sherry jumping in here. So what are you going to be watching out now to get to the decision on your next policy meeting, of course, in the month of June? You've pointed out how real Fed funds rate as well as employment, I mean, the labor strength is pretty remarkable as well. And sure, were some talks of softening, and tell us the latest view on that front as well. But I wonder what you're going to be watching out for in terms of thinking about whether the Fed is restrictive enough or accommodative enough, given really just sort of opposing forces that the U.S. economy is facing?
You know, just like you said in your question, the U.S. economy has proven to be remarkably resilient. Every time we think it's really slowing down, it surprises us in a good way with more strength. And the labor market has held up with an unemployment rate of 4.3%. So certainly I'm going to continue to watch the labor market. Things like unemployment claims in America have been very low. Right now, it seems like the U.S. labor market is holding up, and I'm going to continue to look for the underlying resilience in the economy. And then, of course, as we were just talking about, paying attention to what's happening around the world in terms of global events and what happens in the Strait of Hormuz. So a lot of attention on the real economy in America, on the labor market, and then paying close attention to what's happening geopolitically with the negotiations that are taking place.
Kari was just asking the hypothetical question of the Iran war coming to an end soon. What about the other hypothetical situation where it gets actually prolonged, that there are negotiations going on, but of course the Strait of Hormuz is really the critical matter for the economy and for markets. Do you think if this energy-driven inflation, if it's persistent and prolonged enough, do you see the chance for the Fed to sort of prioritize in a de facto manner prices over employment?
Well, we'll look at everything, and we've said when the two sides of our mandate, the labor market and inflation, are in tension, that we will take a balanced approach. For me, as one policymaker, what I would say is inflation has now been elevated for more than 5 years. And the longer it goes on, the more we run the risk of inflation expectations unanchoring and starting to drift higher, which we cannot let happen. If that were to happen, then we'd have to respond even more aggressively. So we're much better off doing what we need to do to keep inflation expectations anchored. That means, for me, I am focusing heavily on inflation. I'm not ignoring at all the labor market. We need to pay attention to both sides. But the labor market is in decent shape right now, while inflation is simply much too high.
Well, Emily, it's not just a delicate time for the global economies, but for the Fed itself as an institution, with the new Fed chair, Kevin Warsh, coming in. I talked to the other Fed president who joined us today from the Chicago Fed, Austin Goolsbee. We talked a lot about inflation, of course, again. And in terms of the jobs report, he says, it's stable, but not great. You'll hear more from that interview later on in the program. Emily, back to you.
Kari, great discussions and interview. Thank you very much for being with us, and we look forward to another update. Kari and Joji there, coming from Tokyo, live reporting. Christian Tuntono is Senior Asia-Pacific Economist at Allianz Global Investors and joins me around the set here. Chris, good morning. And you got a chance to listen to the two Fed presidents and the latest comments. Kashkari saying that the economy is resilient, paying attention to geopolitics, but also acknowledging that inflation still remains above their 2% target. In terms of your base case, what is your expectations for the coming meetings?
Our base case is that we expect the Fed to stay on hold, right, for this year. But obviously, the risk is really tilting on the upside. Inflation is a problem, right? First of all, like the conflict over in the Middle East is still ongoing. There's still probably hard to say when there will be a deal, and then if the Strait of Hormuz reopen, I think we always hope for the best, right, for that. And also, one thing don't forget is that I think the tariffs and trade war actually is still looming at the background, right? Very soon we'll come to July, and then we probably may expect some new initiative from Trump's on that front. And what it means is that the price pressure, right, on the tariff fronts or on the oil front are still on. And that's what make us concerned about the upside inflation risk in the U.S. But as the Fed governor just mentioned, I think that at this time, the U.S. jobs market is still resilient, but we watch very closely on inflation. And we still think that the Fed is likely to stay on hold for this moment with some upside risk bias towards inflation side.
I'm going to push on that a little bit more because we are waiting on PCE to come through. This is the key inflation gauge for the Fed. In terms of the bigger risk, is it inflation or labor weakness for the outlook?
I think for this time, I will watch closely on the inflation. So we'll see if the PCE really comes out as expected or gonna be above expectation. I think there's a chance that it could be. Right? Look at the gasoline prices in the U.S. It's actually staying quite elevated. So, and in terms of that, because of high oil prices, it may have a negative impact in terms of retail sales, consumer confidence as well. So, I'm concerning that not only that we see some upside risk on the inflation, we may see probably some weakness on the growth side looming up as well, and that could be actually a relatively difficult situations for the Fed to handle going forward. Yeah.
As we watch the transition to a Warsh-led Fed, the impact for Asian markets and the predictability of U.S. policy, how does U.S. policy drive Asia?
I think U.S. policy is very important for Asia. If the outlook for the Fed policy is tilted on the hawkish side, and focus more on inflation, and there's potential that there could be policy rate hikes, right? Then that would further really narrow any kind of room for Asia to ease policy rates. And I think sometimes it's also about the directions of policies, right? Previously, we expect the Fed probably have some room to cut, not much, maybe one time or two times, but those expectations are gone after the onset of the conflicts in the Middle East. Now, market is actually expecting maybe there's potential for hike increases, right? Even though our view is that it's going to be stay on hold. And this change in direction is important. I think it changed expectations, and therefore we see some weakness on the currency in Asia also at the background of it, especially for some economies that has see higher, more rampant inflation, right, because of higher energy prices, or those that have some few subsidies, but they choose to actually transfer, I would say, the pressure towards the fiscal side. And there's concern on the fiscal side whether it would be able to withstand it and trigger, right, some selling on the bond market or on the currency market. So all this we are watching closely. But I think many things are looming in the background, and it is transitional, pivotal moment at this time.
In terms of the playbook for Asia, is there a north and south divide? We saw the BOK staying on hold, but ASEAN countries, they don't necessarily have the same dynamics.
No, I would probably frame it as probably AI or versus less AI focus, right? But remember, there's some economies that doing not that bad, I would say, in the ASEAN space. Let's say Malaysia or Singapore, I think some of the industrial production numbers are actually quite good because of their heavier AI or tech exposure. Obviously, Korea and Taiwan is leading in terms of exports and chips exports. But then I think they benefit from that, and obviously the external account also benefit from that. And that's why it kind of helps to cushion like the rising energy import bill that they would have. Some economies in Southeast Asia, right, let's say the Indonesia or the Philippines, are relatively more vulnerable on that, right? Let's say for the Philippines, not only that their current account deficit like to widen because of rising energy bill, inflation is also very rapid. And on top of that, actually we see that the secondary pass-through towards core prices is ongoing. And that's why, right, the BSP needs to hike, and they are hiking to really to kind of preempt that from continuing.
How is the energy crisis impacting the supply chain, this China plus one supply chain shift? Does it make more production? Does it get forced back to China?
I don't think I see trends for that yet, but actually you raised a very interesting point. Even though the Strait of Hormuz is very important for Asia and is represent about 80% of energy supply, but as the conflict drags on, we actually see some data showing there are more actually replenishing supply coming from, let's say, Africa or from the U.S. coming to Asia. So that kind of helped at the edge, right? Even though like the transportation distance is a little bit further away. So, but nonetheless, I think the supply of energy is still strained, and therefore we see pressure on some of the economies that are weaker on the external balances, right, or have higher inflation transmission. But all in all, I think the supply chains in Asia are still on hold, as actually the whole world cannot run away from a bottleneck in the Middle East, right? It's not only in Asia, but even though Asia is disproportionately more impacted, but still the Middle East represents a big percentage of global energy supply. So, the matters is not only Asia, it's across the world.
I have to ask one more question about artificial intelligence, the impact of AI on jobs. We're just a couple of days out from Computex, where much of the semiconductors, the supply chain will converge in Taipei for the latest annual event here. We just heard from Jensen Huang yesterday. He's looking to invest, or has, $150 billion into Taiwan, declaring it the epicenter of the AI revolution. In terms of jobs and the impact from AI, how do you see that?
You know, very good questions. I may not have a perfect answer for that. But I would probably say I would stay more on the optimistic side. I think the AI can increase productivity. And yeah, it may have some pressure on some sector of jobs, but I think the society will learn with it. Think about the level of technological innovation that we have gone through over the past, let's say, 100 years, right? When we were replacing, horses with cars, and then with trains and planes, and I could imagine people in many decades ago would probably ask the same thing. So, how to deal with all those people who raise horses? What are they gonna do in the future? And it's like similar to that. As the world progresses, I think the society will find a way. And when new technology comes in, it will replace some, but it, at the same time will create possibly a lot more occupations or jobs to really fill in and fit in the society or the technology progress going into the future. So I'm more on the sanguine side, so to say. Yeah.
Yeah. So more job augmentation rather than job replacement.
Hopefully.
Yeah. Thank you very much, Chris.
Okay.
It was great to chat with you. Thank you very much for being with us today. We've been speaking with Christian Tuntono from Allianz Global Investors. We also heard from Chicago Fed President Austin Goolsbee, who was at the Bank of Japan conference in Tokyo. Speaking on Squawk Box earlier, he discussed productivity, inflation, and the implication for the Fed.
I'm thinking on the other side about the impact of productivity growth. You've seen in the United States an uptick in productivity growth, and some people arguing that that's going to continue, that it's coming from AI, and I'm trying to think through the implications for monetary policy in the short run.
And your feelings on that right now?
Well, you got to weigh off a couple of things. One is if the productivity growth is not predicted, then it could just reduce inflation and it's manna from heaven. But if everybody expects it, you can overheat the economy in the short run. So we definitely want to be paying attention to some of the shifting forward.
And in terms of energy prices, we've seen the shock to the system already over the last couple of weeks, but there were inflationary pressures to begin with in the U.S. before this war erupted. Do you think this energy-related shock that we're getting in the system is transitory?
I certainly hope so, but I'm not totally convinced, and it's worth at least emphasizing that the initial estimates in the market, in the futures markets, and of predictors were that the price would be a lot lower than it is today. So it's already proved more lasting than it was initially forecast. And that's a little dangerous for exactly the reason you highlight in the U.S. context, that we had a tariff increase in inflation, which was supposed to go away, supposed to be a one-time increase in the price level, that the inflation part would go away. It hadn't gone away yet, and then we added this one on top of it. So that's a little more disturbing situation, more concerning situation. And if you look in Japan, or if you look throughout Asia, where they're much greater, to a greater degree, energy importers, it's more just a stagflationary shock of the old-fashioned variety. So we're trying to think through the implications.
I mean, timing-wise, hypothetically, if this war ends, won't the lingering impacts, because of the supply chain issues and the bottlenecks that are already in place, for that to work through the system, how long do you think that's going to take?
For almost certainly, you're exactly right. The people in the industry, and when we're out talking to folks in the auto industry, the Chicago Fed's district of the United States is by far the largest auto production and the largest manufacturing in the U.S. When we talk to executives throughout the Midwest in the USA, they highlight that the supply chain, even if the war ended tomorrow, the supply chain has got damage to it that is going to take some time to repair. I do think that's already known by the market. So looking at the futures markets, as I say, they keep predicting that prices are going to come down somewhat significantly in a shorter order, but the speed at which it comes down, everything has ratcheted up. So we're already higher than when this thing started. They thought it was going to get to as a peak.
So if you were to vote tomorrow, if you were to be voting this year, Austin, where do you go? I mean, inflation upside, there's the risk, but then there is also the downside, growth risks.
I think the U.S. Fed has what they call the dual mandate. The law says that when setting monetary policy, we're supposed to do two things only: maximize employment, stabilize prices. My read of the U.S. labor market is it's been quite stable. And the thing that is going wrong is inflation. It was making progress. It stopped making progress last year and now has been rising. It's going the wrong way. So I'm more attuned to the inflation risks in the immediate term than to the labor market risks.
And we are now looking at live pictures coming through from the Bank of Korea, and the governor there, Hyun Song-shin, he is delivering his remarks following the BOK decision to hold the cash rate or the base rate at 2.5%. He says they need to raise interest rates sometime in the future. There is inflationary pressure coming up. The cost of living seen rising in South Korea. Strong growth seen sustaining in the coming months. And there's an early resolution of the Middle East crisis could boost growth even higher beyond 2.6 for this year. And he goes on to say that the policy path is very clear, heading restrictive going forward, factoring in FX, growth, and inflation. These comments coming through from BOK Governor Shin following the interest rate decision, keeping the base rate at 2.5%. Just pointing out that the BOK dot plot 10 of 21 policy rate projections by board members for the next 6 months at 3%. 7 of 21 policy rate projections for the next 6 months at 2.75%, and 2 of 21 policy rate projections for the next 6 months at 2.5%. So we've got the bulk of them, the members expecting rate increases in the next 6 months to as high as 3%. We're looking at the Korean won at 1,505 against the greenback. We'll leave you with a look at the Forex space, the China connection taking a short break. We're looking at the won weakening slightly against the dollar this morning.
And on the other side, you're seeing
for almost 7%. Hua Hong Semi, double-digit percentage gains, up 13.5%. We are keeping track of SK Hynix, which joined the trillion-dollar market cap club yesterday and still advancing, up 1% today. Samsung Electronics, we're seeing a slight pullback here. It's been in the news, of course. We've been watching out for that threatened strike. And then as the labor union had agreed to the terms by the chip maker, we're looking at Samsung Electronics shares today down about 2%. So chips definitely in focus, and the Chinese listed in Hong Kong seeing strong gains today. NVIDIA CEO Jensen Huang says the company will invest $150 billion a year on the island in Taiwan. He was speaking to employees as NVIDIA gets set to break ground in a new headquarters in Taipei.
Taiwan is the epicenter of the AI revolution. This is where the chips come, packaging comes. This is where the systems are made. This is where AI supercomputers were created. 4 years ago, 5 years ago, NVIDIA was spending about $10, $15 billion a year in Taiwan. Now, we're spending 100, going to $150 billion in Taiwan each year. $150 billion from one company alone is going to fuel an incredible ecosystem here.
And as we continue to look at chips, a memory chip maker Changxin Memory Technologies receiving approval for its mainland IPO and what could become China's biggest listing in 4 years. The company is looking to raise at least 29.5 billion yuan or $4.3 billion on Shanghai's Star Board, with the deal size potentially rising above $5 billion. Based in Anhui province, CXMT is crowned as the world's 4th largest maker of DRAM memory chips. The chip maker says proceeds from the IPO will go toward expanding production capacity and upgrading its chip technology. Let's take a look at how Greater China markets are faring this morning, and we are largely negative in Hong Kong. As I mentioned, the loss leader down 1.8%, fractional losses for Shanghai and Shenzhen. The TAIEX is standing out firm and in record territory, 44,488. This as TSMC shares sitting at record highs of 1.5% at 2,335. I want to zero in on the Hong Kong market. A new report showing that Hong Kong has uprooted Switzerland as the world's largest offshore wealth hub. We're looking at this being driven by IPOs. We've seen a huge flurry of them, about 500 IPOs in the pipeline. We had 3 listings in Hong Kong just yesterday, and we got a couple more coming through tomorrow. Capital inflows from the mainland helping to drive this, and we're Hong Kong 2.95 trillion with just a really narrow margin compared to Switzerland's 2.94 trillion. But what I should point out is that the growth, the cross-border wealth growth, is projected to grow about 9% annually through 2030 in Hong Kong, securing Hong Kong's top position, whereas Switzerland's growth is projected at about 6%. All of this capital inflows helping to support the market, liquidity boosting overall economic activity, as well as fueling a wave of optimism in the property sector as well. This comes as Hong Kong lived-in home prices rising for an 11th straight month, putting April at a 30-month high, the index at 316.6, and we're looking at prices up 0.89% month on month. But what I should point out is that we are still about 19% below the peak prices in August of 2021. Property stocks in the Hong Kong market today pulling back by 2% or more. The loss leader here is Sun Hung Kai Properties, down 2.7%. Foreign and Chinese banks in Hong Kong are moving quickly to comply with the Beijing-led crackdown on cross-border investments. Major lenders, including HSBC, Hang Seng Bank, and Bank of China, reportedly tightening requirements for mainland clients opening investment accounts in Hong Kong. Some banks are now requiring clients to declare that their investment funds originate from outside mainland China, while others have stepped up due diligence checks or paused certain account services for mainland residents. The move follows a broader crackdown by Chinese authorities on illegal cross-border trading, including hefty fines on online brokers accused of operating without licenses on the mainland. Let's talk more about this and the markets. Theodore Shou is CEO of Yi Capital and joins me on the set here. Theodore, good morning, and thank you for joining us today. Let's start with this story about this cross-border trading. The regulatory tightening, do you see this as a one-off thing, or is this more just a targeted move?
So first of all, I disagree it is tightening. We have to differentiate between cracking down on cross-border investment and cracking down on illegal cross-border investment. So I think all these latest regulations or measures that we are seeing are very, very much consistent with the policies and regulations in mainland China all along. So let's look at this definition of Chinese or mainland Chinese clients. The trick is, if you are speaking to most of the banks and brokers today in Hong Kong, and the client walks in with a foreign residency, a foreign tax residency, or even a foreign address, they will still largely be allowed to open an account there. So the key is really just targeting the mainland Chinese who has no foreign connection whatsoever, who has no foreign address. They are not legally trading accounts outside of China. And I said this is consistent with the policies all along because there's capital control, as everyone knows. Many people will argue, oh, isn't there this $50,000 annual quota? That's a common misunderstanding because that quota is targeted for current account use. What does that mean? That means that if I'm planning to go to Hong Kong and buy a Louis Vuitton bag, yes, that's what's the quota for. But if I'm planning to open a brokerage account in Hong Kong, that isn't the legal use of that 50K. Now, I think for a large economy, a large country like China, it does have the luxury and capability to levy all these measures. If we look at US, for example, assuming you are an American who has very little foreign connection, traveling to Hong Kong, walking to any bank in Hong Kong, highly likely many of the banks will decline your bank account opening request, right? That's primarily because of the compliance burden. And again, this is why I'm saying it is, what China is doing now is very consistent with its own policies because historically, these capital accounts cross-border flows were forbidden. And if you don't have any means of generating foreign income, how would you be able to come up with the cash to trade in these accounts anyway?
I'm glad you brought up the U.S. compliance because I was going to ask about that as well. So it's not just China, but of course the banks scrutinize U.S. residents, passport holders as well. But with this regulatory tightening or this oversight, I guess you could call it, does this just reinforce the more established traditional players in the securities trading?
I think yes and no. If we look at the three major brokers that got penalized specifically in this case, in the past few years, they have been aggressively expanding in the local markets here. So back to your point, I see them as the established players now, right? And they are gaining market share over many of their traditional peers in the local market here in Hong Kong. And we can witness a very similar flash decrease of shares prices in the past 2-3 years. It happened a few times to these brokers, particularly the public ones. And this time around, it's no different. We are seeing a V-shaped rebound in the share prices because, again, back to my point, they are expanding aggressively outside of China, outside of this mainland Chinese client base that people associate them with. And the market is fully realizing that, and the market is attaching value to their efforts and to this business that they have built over the years.
Hong Kong is a super connector, and this role has allowed Hong Kong now to overtake Switzerland as the world's largest cross-border wealth hub, driven by IPOs, driven by wealth coming through from the mainland, $2.95 trillion. But where is this money going? Because we continually talk about Taiwan, Japan, Korean markets hitting highs, but the Hang Seng Index is still trading at these levels. Where is it going?
I actually think China overall, Chinese assets, be it Chinese fixed income or Chinese equities, could still potentially be beneficiaries, and that become one of the appeals of attracting capital from outside of the region to Hong Kong. I mean, I have first-hand experience. Some of our affiliates are wealth managers, and we recently onboarded our RMs who are non-Chinese, even non-Asians, and they're dealing with non-Asian clients. And these clients are moving capital across to Hong Kong. Back to your question, where the money can go. I mean, Hong Kong and Chinese equities specifically have had two pretty good years in the past 2 years. And now we are possibly in this consolidation phase. Despite the struggling economic conditions, as well as a lack of visibility to tremendous stimulus policies, I still believe Chinese equities offer quite good opportunities compared to some of the peers. Here I have to specifically point to the dispersion that we see in markets. And again, this is not confined to China. If you look at US equities, it's the same. A few of the large players, they carry the entire market. In China, we talked about the foundry stocks this morning. Many of Chinese stocks have gone up by 2 times, 3 times, or even 10 times just year to date, right? At the same time, there are many losers in the market that are not giving any value to their investors. But here's the key. China is similar to US in that it is a big market, it is a deep market, it has liquidity. And therefore, as long as that dispersion exists, that should in itself create a big magnet for foreign capital.
Global investors or global funds are underweight China, but China has recovered from 5-year lows. Do you see room for a re-rating?
I do, and that re-rating has a lot to do with the geopolitical tension that we are seeing in the market today. That has a lot to do with a potential migration from the US-centric portfolio construction for many non-US investors. I'm not foreseeing a big re-rating in the sense that if I have 80% of my portfolio in US assets today, shall I decrease it to 40%? No, I'm seeing more a re-rating of 80 down to 70. And where will that 10% difference go? Part of that will go to Chinese assets, as I mentioned. I mean, take this year, for example, you're right. We are still seeing underinvestment, underexposure to Chinese assets, but we are seeing a very quick pickup of Japanese assets, and particularly Japanese stocks. So what I'm trying to say is capital can flow fast. And if they can go to pocket A today, they can easily move to pocket B tomorrow.
I have to ask about the massive blockbuster IPOs coming online. We're watching SpaceX, OpenAI, as we spoke about whether or not the Chinese money can get into that stock. There's going to be a vacuum. The air is going to be sucked out of the room. All the money is going to be flooding there. Are you going to be buying this stock? And what is going to happen to the Chinese markets while that is happening?
I think we track private markets closely, and many of our portfolios invest heavily into private markets. And if I'm being honest, the mega deals that we are seeing in the market today, when they go public, it's very possible that their valuation is peaking out. And therefore, it defeats the purpose of investing and getting the results of your investment for the long term. So what I'm saying is that many of them could still be very good investment objects, but we are seeing better opportunities elsewhere. A typical comparison back to our discussion around Chinese assets is that in comparison to the US, there's significantly less capital available in the private markets in China. And that also means many of these Chinese players in AI, in tech, they possibly will have to go public earlier in their life cycle compared to many of their U.S. peers. And they will likely be able to offer more upside potential for investors because they're public earlier.
Theodore, thank you very much for joining us today. Wish we had more time. Great discussion. We've been speaking with Theodore Shou from EE Capital. And we're tracking a raft of earnings today. Kuaishou reporting a drop in quarterly earnings as rising spending on AI and infrastructure weighed on profitability. Net profit at China's second largest short video platform falling 27% in the first quarter. Investors are closely watching Kuaishou's AI video generator Kling, which saw revenue more than quadruple from a year earlier, but still in the early stages of monetization. The company is facing mounting competition from rivals including ByteDance, while concerns over slowing consumer demand and weaker e-commerce growth continue to pressure sentiment around China's internet sector. Shares marginally higher in Hong Kong trade. Weaker consumer demand also weighing on e-commerce giant PDD. The company, which operates Pinduoduo and the international discount platform Temu, reported a drop in first quarter profit and weaker than expected revenue, with net income sliding 15% on year. PDD is ramping up investments in supply chains and logistics, including a planned 100 billion yuan push into a new self-operated retail brand. At home, the company is facing sluggish demand as well as tough competition. At the same time, Temu facing growing regulatory pressure globally as the U.S. and Europe tighten rules around low-cost imports shipped directly from China. U.S.-listed shares of PDD sinking over 10%. Over in the U.S., Snowflake shares surging a whopping 37% in U.S. extended trade after sales, profit, and Q2 guidance all beating street estimates. The cloud platform also raised its forecast for annual product revenue, getting a boost from heavy enterprise spending on AI. It's also just signed a 5-year, $6 billion deal with Amazon Web Services to use the AWS processors and infrastructure. Salesforce shares pulling lower despite beating on the top and bottom line. Its Q2 revenue forecast was disappointing, falling just below analyst estimates of 11.36 billion. The company has been plagued by SaaSpocalypse concerns as investors expect evolving AI tools to draw clients away from traditional software like CRM. Chairman and CEO Mark Benioff dismissed those worries in an interview with CNBC.
You can see we just had a record quarter. It's really incredible. And when you see the number of million-dollar transactions that happened in the quarter, well, this was our record level. We've never seen this many large transactions happen. And also, I think we're going to see in the second quarter, attrition is probably coming down. A lot of the predictions that are happening in regards to the SaaSpocalypse just hasn't happened. I mean, you think about half. You look at Slack and the incredible growth rate of Slack. It's been really driven by the AI wave and the ability now for these companies to do things that they have not been able to do before. All of this is really made possible by this tremendous new AI technology.
Germany's economy minister is in Beijing as Berlin tries to balance its relationship with China. More on the high-stake visit right after this break. On our radar this morning, authorities say 2 people were killed after a major chemical explosion at a paper mill in Washington, D.C. on Tuesday. 9 others are still unaccounted for, likely bringing the death toll to 11 people. A further 9 people were wounded, with some still in critical condition. A chemical tank ruptured at a Nippon Dynawave packaging facility, causing it to spill more than millions of liters of highly corrosive liquid. Authorities say the contamination also entered the Colombian River. A probe has been launched into the cause of the implosion. Norway has agreed to join France's nuclear umbrella, becoming the latest country to receive France's nuclear protection. The move, which was announced by both leaders at a Paris meeting on Wednesday, signals a shift by Norway towards closer defense cooperation with Europe, reflecting growing concerns in the region over U.S. commitment to security. Under the agreement, Norway would take part in what France calls forward nuclear deterrence, under which allies are more closely involved in French strategic thinking on nuclear defense. And finally, Chinese Foreign Minister Wang Yi met his Indonesian counterpart Sugiono at the United Nations headquarters on Tuesday. Both sides agreed to intensify high-level exchanges, strengthen multilateral collaboration, and promote further development of bilateral relations. The two also exchanged views on international and regional issues, including on the recent Middle East crisis. Ties between Germany and Beijing in focus after Germany's economy minister said both competition and cooperation are needed to create shared progress. Our China reporter Elaine Yu has more on this.
Yeah, so the German economy minister, Katharina Reiche, is in Beijing. This is 3 months after Chancellor Merz visited, and he's joined by dozens of business leaders from Germany's industrial heavyweights like BASF and Siemens Energy, some of which are quite invested deeply in China. But this trip comes at a critical juncture because the EU is set to debate its China policy, with some major member states like France, Italy, Spain, and the Netherlands pushing for a tougher stance to address issues like China's overcapacity. Now, the minister in Beijing said, "We are seeking dialogue with China because fair competition is needed." She said competition is good and ensures that we improve together. But she also said competition needs to be designed in a way that is for a mutual benefit. Now, another central point of discussion is how Germany will secure reliable access to critical minerals in China. She said she's exploring ways with her counterparts to create this access, saying that German companies, not just those invested in China, but also downstream ones, need these materials. And she said modern technologies are inconceivable without them. Now, the minister and her delegation met with the Chinese Vice Premier He Lifeng and the Commerce Minister Wang Wentao, and the Commerce Minister had some pretty strong words saying that protectionist EU trade restrictions have seriously disrupted cooperation between European and Chinese companies, perhaps noting that some member states are now pushing for sharper defense tools against China and its exports. But he also said China is willing to expand areas of cooperation and narrow its list of differences. But she'll be in China today as well, so we'll see what other perhaps more investment links and cooperation comes out of that.
Elaine also talked to us about the growing divide within the EU on China policy.
Yeah, that is becoming more evident these days. Just days ago, you see France, Spain, Italy, the Netherlands, and Lithuania issuing an unofficial document urging the bloc to crack down on China's industrial overcapacity. And notably, Berlin did not endorse that document. Now, we see Reiche in China making comments seeming to draw the line. She said, thousands of German companies depend on being able to export to the large Chinese market, and so advocating for a balanced approach is what she's proposing, basically balancing between protective measures and openness to exports. And so we see Berlin taking a softer stance compared to some other EU member states, which is underpinned by Germany's and its relative reliance, which she is ready to acknowledge. Bilateral trade between the two countries exceeded 250 billion euros last year, but Germany's deficit also reached a record 87 billion euros last year. And there's a report from the Center of European Reform saying that estimated that 400,000 jobs have been lost to Chinese exports. So the title of that report is also the cost of Germany's complacency. So perhaps it'll be harder to find a unified approach, and they'll be debating that, what the EU's policy to China should be.
Elaine, thank you very much for that, covering the German economy minister and her visit to China. On that note, that'll do it for this edition of the China Connection. I'm Emily Tan here. Keep it tuned to CNBC. Inside India is coming up next.
In the market.
Welcome to this Thursday edition of Inside India. I'm Sri Jagaraja. Here are your headlines. Oil prices are rebounding in Asia on reports of fresh US strikes on an Iranian military installation and with no deal yet in sight. Elevated energy prices are testing the Fed's dual mandate. Top Fed officials telling CNBC they are paying a lot more attention to rising inflation risks.
I'm more attuned to the inflation risks in the immediate term than to the labor market risks.
I am focusing heavily on inflation. I'm not ignoring at all the labor market. We need to pay attention to both sides, but the labor market is in decent shape right now, while inflation is simply much too high.
And Hyundai Motor will start hiking prices in India starting on the 1st of June as input and commodity costs rise. Welcome to the program. Let's get to the energy complex first of all. And oil prices are rebounding in Asian trade. WTI up by 2.5%, Brent crude up by 2.5%. And both the global indicators at $90.95 and $96.68, both of them rising and responding to the headlines. And this after reports that the US and Iran exchanged fire. A US official told Reuters that the strikes targeted a military site that poses a threat to traffic on the Strait of Hormuz. The official also said that the US military shot down multiple Iranian drones. Both sides also seem far apart over who controls ultimately the Strait of Hormuz. Iranian media claimed yesterday that Iran and Oman would jointly manage the strait to restore traffic back to pre-war levels. But at a cabinet meeting overnight, President Trump dismissed those reports, saying no one would control international waters.
The strait's going to be open to everybody.
And who would control it?
It's international waters. Nobody's going to control it. We're going to watch over it. We'll watch over it, but nobody's going to control it. That's part of the negotiation that we have. They would like to control it. Nobody's going to control it. It's international waters, and Oman will behave just like everybody else, so we'll have to blow them up. They understand that. They'll be fine.
It seems like the US will not compromise on two other issues that Iran is holding out on: uranium stockpiles and restored access to frozen funds. Here's what President Trump had to say about those issues.
Would you be comfortable with Russia or China taking their stockpile of highly enriched uranium, and have they offered to do that?
No, I wouldn't be comfortable.
That
That would not make me comfortable.
Is the U.S. considering easing sanctions on Iran to allow Iran to sell its crude to market?
No, we're not talking about any easing of sanctions or giving money. No sanctions, no money, no nothing. We have control of money that they claim is theirs. We'll keep control of that money. When they behave properly and when they do what's right, we'll let them have their money. But right now, we're not doing that, and it's one thing is not contingent on the other.
And let's take a look at regional markets, which are turning decidedly cautious exactly for these reasons of re-escalation or escalation, depending on how you define it. Reports of US strikes that we talked about against Iran undermining optimism for a peace deal. And then we also have on the data front the release of US inflation data, PCE. This is important because this is the Fed's preferred gauge of inflation. Expectations are putting the headline at a 3-year high of 3.8%. Core is forecast to rise to an annual 3.3% rate. And if that did materialize, that would be well above the Fed's 2% target. Let's take a look at chip stocks in Asia now, looking a lot more mixed after yesterday's massive rally. Hong Kong-listed chip makers are a bright spot. SMIC and Hua Hong shares both logging strong gains. And the rally in chip stocks, such as TSMC, has fueled Taiwan's stock market to gain an edge over India. Taiwan took over the title of the 5th largest market in the world from India, with its market cap standing at around $4.95 trillion. India's Nifty 50, meanwhile, has lagged regional peers this year, down close to 9%, as higher oil prices and the Iran-linked energy shock weighed on sentiment. By contrast, markets with major semiconductor exposure, including Taiwan and South Korea, have posted strong gains, prompting brokerages to say India may increasingly become a stock picker's market, driven by sector-specific opportunities rather than a broad-based rally. Let's test that theory and bring in VK Vijayakumar now, Chief Investment Strategist at Geojit Financial Services. VK, welcome to the program. And before we get into strategy, I wanted to ask you whether it's your expectation, as it seems to be in some corners of the market, that we should get ready for a rate hike by the RBI at the June meeting in a few days' time?
That is quite possible. A rate hike by the RBI is very much on the cards. Last year, in 2025, we had a 125 basis point rate cut by the RBI. That was a big monetary stimulus to boost consumption and growth, because inflation also was much below the RBI's tolerance limit. It was around 2.5% last year. RBI's tolerance band is 4%, up 2% up or down. So it can vary between 2 to 6%. It was decidedly down last year at 2.5%. But now with this energy shock, prices of petrol, diesel, and LPG all have been increased, and this will certainly reflect in the inflation numbers expected soon. Already it has started inching up. Therefore, it is quite possible that the Monetary Policy Committee might think about at least a hawkish stance in the coming June 5th monetary policy. June 5 alone, they may not raise the interest rates, but hawkish stance and raising the rates, let us say 3 months from now, is very much on the cards.
VK, if the RBI does raise rates at the June meeting, will it do so ostensibly to defend the Indian rupee, the currency? Because it was interesting, wasn't it? A few days ago, RBI Governor Malhotra gave an interview to Mint, saying that he would do whatever is required to ensure an orderly FX market. Is defending the rupee part of that strategy?
Yes, defending the rupee is part of that strategy, but then that alone is not sufficient. What is happening is now massive FPI, foreign portfolio investment outflows from India. Just to give you one data, the FPI outflows from India so far this year is $23 billion. That is on top of the $19 billion last year. And this $23 billion outflow from India, you can put it in contrast with the $23 billion inflows into Taiwan, mainly into TSMC. So this AI trade is the important factor, the dominant factor behind this FPI outflows. And in that context, the RBI has to do whatever it takes to defend the rupee. Therefore, it is likely. But then the RBI also is unlikely to do anything to hurt India's economic growth and economic recovery that has been underway at the beginning of this year, but impacted by the energy shock that we had.
Can RBI policymakers afford to wait, VK, wait for more inflation data to really confirm the trend? Or do they have to act now, preemptively?
They don't have to act now preemptively. They don't have to, because inflation even now is under control. It might start reflecting on the consumer prices only let's say there will be always a monetary lag. And that lag, I think we'll have to see the evolving data and the evolving outlook. This is unlikely in June 5 monetary policy meet, but in the next policy meet, this is very much likely.
Yes. At what point then do equities have to start pricing in what could be a tightening bias by the RBI?
Well, the tightening bias will always be there in the present context, but it is unlikely to be the beginning of a rate hike cycle. We had a rate cutting cycle of 125 basis points last year. That is over, and the rate hiking cycle is yet to begin. A lot will depend on crude prices. We were very much concerned when Brent crude touched 119 to the dollar. Now, despite the escalation, the re-escalation in the conflict in West Asia, even though the ceasefire is intact, crude is trading in the range of, let us say, 95 to 99 or 100. It is not spiking. So long as there is no spike in crude, well, the RBI need not be ultra hawkish.
And What's your sense about portfolio inflows? Because I hear that domestic retail investors, quite a formidable force in the market, and they are stepping in when foreign portfolio investors are leaving. But given the pressures that are building in the domestic economy, is it just a matter of time, perhaps, before those domestic investors too start throwing in the towel?
Well, it is very unlikely in the present context because despite all these headwinds that the economy and the markets have been facing, the market has been resilient. There has been no major sharp correction in the market. Of course, the market is down around 8.5% year till date. And that will appear huge underperformance, particularly when you contrast it with the 90% upside in the appreciation in KOSPI and the 50% upside in the Taiwan index, TAIEX. But then foreign Indian domestic investors have been staying put. And if you look at the numbers, particularly the systematic investment numbers, SIP flows, it has been steady and slowly rising. There is no panic from the side of the domestic retail investors. There has been a transition in India from saving to investing. People of the older generation, my generation, have been mainly savers, relying on mainly fixed deposits and gold. But then the new generation is more equity oriented. So this transition from savers to investors is likely to last longer.
Would you agree, though, Vico, that this type of market environment demands a stock picker's approach? And if so, then in what sectors, businesses and names do the opportunities lie?
Well, yes, this is a stock picker's market now in India. At the index level, we don't expect very good performance in 2026 or even in 2027, early 2027. Of course, a lot depends on the conflict in West Asia and the crude prices. But then even now, when the market is range bound and the market is down 8.5% Nifty year till date, some sectors are doing exceedingly well and some stocks are doing exceedingly well, particularly stocks in sectors like pharmaceuticals, in defense, automobiles. These are segments which are doing well, and we are more bullish on pharmaceuticals in the coming quarters and for the rest of the year also, because this is one segment which has inelastic demand, and the currency depreciation is substantially helping the exporters. Currency is down by 7%, Indian rupee is down by 7% this year, and Indian pharmaceutical industry, often referred to as the pharmacy of the world, is doing well, and they are getting a boost from the tailwind of currency depreciation. So there is one sector which we should look on. And also there are segments like renewables, particularly in solar energy, and also partly in metals like aluminum, steel. And financials, of course, financials have been performing very poorly because of the FPI outflows. For the foreign portfolio investors, around 30% of their assets under custody are in financials. Therefore, if they want to sell, let us say $500 million a day, it is easy in financials because there is huge liquidity there. That is why that segment is under pressure, and their valuations are also very attractive. Therefore, we have confidence in the FIIs, the domestic financials recovering sometime this year because of the fair value.
I understand, VK, but how concerned are you about, as we head into what could be a slower growth environment, that we're going to see a rise in debt proliferation, bad loans, credit impairment, and that may affect balance sheets? We're already seeing a lot of stress in the MSME sector. To what degree is that going to feed back into the banks and their earnings?
There is stress in the MSME sector, as you rightly pointed out, but Indian banking sector and the leading names in the NBFC sector are, very, very resilient. Actually, their balance sheets look good. It's never been so good. If you take the last 20 years, their balance sheets are good. NPAs have come down drastically. It is the least in the last 20, 25 years. And credit demand is slowly improving. So I'm not very much concerned about the balance sheets or the margins of the leading names in the financials. Of course, there is stress in the microfinance sector, and that is likely to last for some time. But in microfinance, we don't have much listed names.
I see. VK, final question. How should we approach the consumption sector, retailers, staples, discretionary? Because there is a sense that this is a classic supply side shock that could very well metastasize into a demand shock and demand destruction in the real economy. Is that happening yet? Is there any sign that that is happening?
It has not yet happened because the last 3 years, we had 7% plus GDP growth. And this year, of course, we expect a slowdown. The GDP growth in the worst case scenario will be around 6%. I'm talking about the financial year 27, April to March 2027. 26 April to 2027 March financial year, GDP growth may decline in the worst case scenario to 6% with a 5.5% inflation rate also. So there is no risk of a demand destruction right now. There are no signs yet. Particularly in automobiles, when I talked to a showroom owner in mid Kerala yesterday, he said there is a shortage of supply. They are not getting enough supply. There is huge demand because the interest rates have come up, and the GST cuts provided by the GST Council last year has made the prices also very much affordable. So I don't see any demand destruction there side. There will be a demand slowdown, but not a demand destruction.
I see. But nonetheless, we have to watch those profit margins given the higher cost environment that a lot of these companies are operating in. VK, thank you. We'll leave it there, sir. VK Vijayakumar, Chief Investment Strategist at Geojit Financial Services. Coming up on the programme, we take a deeper dive on the elevated levels of US Treasury yields, with the 30-year breaching 5% for the first time since 2007 earlier this week. Inside India, we'll be back in 2 minutes.
deep enough.
It's called bridging bonds to finance government investments. Now, Carrie Njoji was at the Bank of Japan and Institute for Monetary and Economic Studies conference in Tokyo this morning. Carrie, we remember, don't we, how policymakers woefully misjudged inflation, thinking that it was transitory. Are they at risk of making the same mistake again?
Well, this is the question I posed along with my colleagues on Squawk Box to two Federal Reserve presidents this morning. And, you know, they have two mandates. One, of course, is inflation. The other is jobs. It's clear that they're squarely focused on the former. And they, to the great extent, they don't really see any signs shifting in terms of the jobs market per se in the United States. But we had a chance to speak to these two Fed presidents. Let's take a listen to what Chicago Fed President Austin Goolsbee had to say about the productivity gains that people are expecting and anticipating as a result of the AI boom. Let's take a listen.
I'm thinking on the other side about the impact of productivity growth. You've seen in the United States an uptick in productivity growth, and some people arguing that that's going to continue, that it's coming from AI. And I'm trying to think through the implications for monetary policy in the short run.
And your feelings on that right now?
Well, you got to weigh off a couple of things. One is if the productivity growth is not predicted, then it could just reduce inflation and it's manna from heaven. But if everybody expects it, you can overheat the economy in the short run. So we definitely want to be paying attention to some of the shifting forward.
And in terms of energy prices, we've seen the shock to the system already over the last couple of weeks, but there were inflationary pressures to begin with in the U.S. before this war erupted. Do you think this energy-related shock that we're getting in the system is transitory?
I certainly hope so, but I'm not totally convinced, and it's worth at least emphasizing that the initial estimates in the market, in the futures markets, and of predictors were that the price would be a lot lower than it is today. So it's already proved more lasting than it was initially forecast. And that's a little dangerous for exactly the reason you highlight in the U.S. context, that we had a tariff increase in inflation, which was supposed to go away. Supposed to be a one-time increase in the price level, that the inflation part would go away. It hadn't gone away yet, and then we added this one on top of it. So that's a little more disturbing situation, more concerning situation. And if you look in Japan, or if you look throughout Asia, where they're much greater, to a greater degree, energy importers. It's more just a stagflationary shock of the old-fashioned variety. So we're trying to think through the implications.
I mean, timing-wise, hypothetically, if this war ends, won't the lingering impacts, because of the supply chain issues and the bottlenecks that are already in place, for that to work through the system, how long do you think that's going to take?
For almost certainly, you're exactly right. The people in the industry, and when we're out talking to folks in the auto industry, the Chicago Fed's district of the United States is by far the largest auto production and the largest manufacturing in the U.S. When we talk to executives throughout the Midwest in the USA, they highlight that the supply chain, even if the war ended tomorrow, the supply chain has got damage to it that is going to take some time to repair. I do think that's already known by the market. So looking at the futures markets, as I say, they keep predicting that prices are going to come down somewhat significantly in a shorter order, but the speed at which it comes down, everything has ratcheted up. So we're already higher than when this thing started. They thought it was going to get to as a peak.
So if you were to vote tomorrow, if you were to be voting this year, Austin, Where do you go? I mean, inflation upside, there's the risk, but then there is also the downside, growth risks.
I think the U.S. Fed has what they call the dual mandate. The law says that when setting monetary policy, we're supposed to do two things only: maximize employment, stabilize prices. My read of the U.S. labor market is it's been quite stable. And the thing that is going wrong is inflation. It was making progress. It stopped making progress last year and now has been rising. It's going the wrong way. So I'm more attuned to the inflation risks in the immediate term than to the labor market risks.
There's also another big variable here, and it's one that the markets are certainly concerned about. It is the new Fed chair, Kevin Warsh, and whether or not he will bring any changes to the institution that is the U.S. Federal Reserve. But we talked about a lot of things, including the concerns that he has made, the new incoming Fed chair, about shrinking the balance sheet and whether or not that's going to be a big priority and how they will actually do that. So wide-ranging conversation. We also talked to the Fed president of Minneapolis, Neil Kashkari, as well, who also echoes Austin's comments that it's going to take a couple of months for the impact of the war, the inflationary pressures coming primarily first from energy, to work through the supply chain and work its way through the economy. But interesting combination and very timely that all these central bankers, not just from the U.S. Federal Reserve, the Bank of England, of course the Bank of Japan, other central bankers from Asia, are meeting here in Tokyo at this time. Sri, back to you.
Great work, Harry. Thank you. This region may need to prepare for a stagflationary shock, and that presents a dilemma to policymakers, central banks. Thank you, Carrie. Coming up on the programme, we will continue to assess the impact of rising bond yields with a focus on Asia. Daniel Lam of Standard Chartered Wealth Solutions joins us next. Will implement previously announced price hikes from June the 1st, citing rising input and operating costs. The automaker will raise prices by up to 12,800 rupees, depending on the model and variant, after delaying the increase earlier this year. This comes as higher commodity prices and fuel costs linked to the Iran war continue to pressure automakers globally. Hyundai joins rivals Maruti Suzuki, Tata Motors and Mahindra, all of which have announced vehicle price hikes in recent weeks. India's cabinet has approved a nearly $2.7 billion package to strengthen and expand the country's food security program. The scheme is aimed at supporting one of the world's largest welfare systems, which provides free food grains to nearly 800 million people. India spends around $27 billion annually on food subsidies as part of the program, which has become a key pillar of social support for low-income households. The approval comes as policymakers remain focused on inflation risks and food security amid rising global commodity and energy prices. Let's check back in on the Asian markets now, and the mood is decidedly cautious given the re-escalation that we have been reading about in the headlines. And we did learn that the US has been targeting bases and assets in southern Iran. And that has negative implications, of course, for these very fragile peace talks. Kospi is giving away yesterday's gains and is down by about 2.5%. We got a policy decision too from the Bank of Korea this morning. Let's bring in our East Asia reporter Lisa King for more. And Lisa, no surprises here, on hold, but this was a hawkish hold, yes?
Yeah, you're absolutely right, Sri. So the hawkish hold, keeping rates steady at 2.5% as markets widely expected. And it was the 8th hold in a row. And of course, this was the first rate-setting meeting chaired by the new governor, Shin Hyun-song. And the key takeaway, he spoke for about an hour at the post-meeting press conference. But I think the key takeaway is that given FX, growth and inflation, all of which are higher, he said the path forward is clear. And the updated quarterly dot plot system forward guidance system indicates that in the next 6 months, the majority of board members expect a 50 basis point hike to 3%, followed closely by a 25 basis point hike to 2.75%. And this is largely in line with investor expectations that the bank will hike 1 or 2 times more until the end of this year. The BOK revised upward its inflation forecast for this year to 2.7 from 2.2 previously, and the bank now sees South Korea's economy growing at 2.6% versus 2% previously. Governor Shin Hyun-song said that according to the BOK's analysis, growth in fact might overshoot the upgraded forecast if the Iran war were to end earlier than expected. South Korea's GDP growth for Q1 blew past expectations on the back of robust semiconductor demand. The South Korean won today is slightly weaker, continuing to trade in the 1,500 handle to the dollar. And also, one of the other takeaways was when asked about South Korean won, Governor Shin, he sort of spoke with a firmer voice and with a firmer facial expression, saying that the Bank of Korea will not tolerate one-sided moves in the FX market and that the bank will respond, quote unquote, decisively, and that the bank has the means to do so. So sending a message to markets with regards to excessive moves. And when asked about the reasons behind South Korea's weak won, he said it's because foreign investors are selling South Korean equities as they rebalance their portfolio amid this surge in South Korea's Kospi. So it kind of echoes what we talked about on CNBC yesterday, that Kospi is surging, so portfolio managers having to keep a balanced index or portfolio are selling their equities, which is in return making the South Korean won weaker.
And that depreciation pressure on the won echoes what is going on in India too, with the Indian rupee, and a non-negligible risk therefore that the RBI could hike next week to defend the currency. We've been talking about that. So some real parallels there. Thank you very much indeed for that, Lisa. Now, central banks globally are warning about rising inflationary risks. We heard from Minneapolis Fed President Neil Kashkari on Squawk Box Asia this morning. Kashkari says he is focusing more on inflation, with supply chain disruptions likely to last longer than expected. Take a listen.
big global companies that are headquartered in the U.S. who have global supply chains have told me it's going to take 6 to 9 months, even if there was a complete resolution, a reopening of the Strait tomorrow, 6 to 9 months for their supply chains to normalize and get back to something like normal. And so I think that these pressures are going to be with us for some time.
Inflation has been well above the 2% target for a while now. Is the Fed fulfilling its mandate?
Not yet. I mean, we are committed to it. I know that all of my colleagues are just as committed as I am to getting inflation all the way back down to our 2% target while maintaining a stable labor market. That's our goal. We have a dual mandate in America, and we have our work to do, but we're committed to completing the job.
And Neil, this is Sherry jumping in here. So what are you going to be watching out now to get to the decision on your next policy meeting, of course, in the month of June? You've pointed out how real Fed funds rate as well as employment, I mean, the labor strength is pretty remarkable as well. And sure, were some talks of softening. And tell us the latest view on that front as well. But I wonder what you're going to be watching out for in terms of thinking about whether the Fed is restrictive enough or accommodative enough, given really just sort of opposing forces that the U.S. economy is facing?
You know, just like you said in your question, the U.S. economy has proven to be remarkably resilient. Every time we think it's really slowing down, it surprises us in a good way with more strength. And the labor market has held up with an unemployment rate of 4.3%. So certainly I'm going to continue to watch the labor market. Things like unemployment claims in America have been very low. Right now, it seems like the U.S. labor market is holding up, and I'm going to continue to look for the underlying resilience in the economy. And then, of course, as we were just talking about, paying attention to what's happening around the world in terms of global events and what happens in the Strait of Hormuz. So a lot of attention on the real economy in America, on the labor market, and then paying close attention to what's happening geopolitically with the negotiations that are taking place.
Kari was just asking the hypothetical question of the Iran war coming to an end soon. What about the other hypothetical situation where it gets actually prolonged, that there are negotiations going on, but of course the Strait of Hormuz is really the critical matter for the economy and for markets? Do you think if this energy-driven inflation, if it's persistent and prolonged enough, do you see the chance for the Fed to sort of prioritize in a de facto manner prices over employment?
Well, you know, we'll look at everything, and we've said when the two sides of our mandate, the labor market and inflation, are in tension, that we will take a balanced approach. For me, as one policymaker, what I would say is inflation has now been elevated for more than 5 years. And the longer it goes on, the more we run the risk of inflation expectations unanchoring and starting to drift higher, which we cannot let happen. If that were to happen, then we'd have to respond even more aggressively. So we're much better off doing what we need to do to keep inflation expectations anchored. That means, for me, I am focusing heavily on inflation. I'm not ignoring at all the labor market. We need to pay attention to both sides. But the labor market is in decent shape right now, while inflation is simply much too high.
There's a lot to unpack from that conversation. Let's bring in Daniel Lam now, Head of Cross-Asset Derivative Strategy at Standard Chartered Wealth Solutions. Dan, welcome to the programme. You heard that conversation, and do you feel that global equity markets are woefully mispricing inflation and the risk of a Fed rate hike?
Well, basically, it is the risk that is being underpriced right now in global markets. And we have seen it because if you look at the rate expectations before the Iran war broke out, investors were expecting a 25 basis point cut from the Fed. Now they're expecting one rate hike. So it's a 50 basis point swing. And of course, we've seen a lot of gyrations between US and Iran, but there's actually no concrete agreement being put into place still. And even if there were to be a reopening of the Strait of Hormuz, it would still take time for the supply chain to normalize. So that lingering effect is something where global equity markets is not been pricing that in yet.
And how do you reconcile this divergence between bonds and equities? Dan, longer dated Treasury yields are screaming inflation is coming, and yet equities seem to move to new high after new high. At what point do they get the message?
Well, equities right now is being driven by a very, very narrow subset of stocks, right? So in the semiconductors and actually the higher end semiconductors or the memory stocks, right? Those are the ones that are driving the equity markets higher. If you look at the other sectors, actually, they have not really been performing so well. So really, it comes down to the point where investors feel that the higher interest rate that one must be expecting would actually be recalibrating the valuation in equities, because equities are being priced by the discounted rate. And if that changes significantly, there will be a time when investors realize and equities will have to correct.
You say, Dan, the fundamental themes in the markets, such as AI, remain intact over the longer term horizon. Can we be so sure, though? And isn't this rise in longer term borrowing costs going to put a brake on those aggressive expansion plans that Wall Street really needs to see amongst those AI names?
But companies are already reaping the productivity reward from adopting AI. So that must be a longer term trend. However, the prices, in many of these stocks have been rising very, very fast. And with a change in the macro environment, this can basically put a dampener to that at some point where there can be a correction.
Let's talk about that, Dan. You've been watching standard deviation, and I wanted to bring in the Buffett indicator. The total US stock market value to GDP ratio just reached 2 times its standard deviation. That is a level that historically precedes a market downturn. Is a collapse imminent, and what action then should we take to de-risk portfolios?
Well, I would say that the indicator may not be so prominent this time, in my opinion, because we are actually in this AI wave, and it is something where it is quite unprecedented. Okay, so the traditional value metrics, despite the fact that people are saying that value would be coming back, we've heard that a number of times over the last 5 to 6 years. But yes, they have come back, but those value rallies have been very short-lived. So I would say that if there were to be a correction, the S&P 500 would probably be looking at something along the 7 to 8% mark. It would not be a recessionary type of correction.
And if standard deviation marks the point where, as you say, Dan, forward returns have historically begun to degrade and the easy money has then been made, then strategically, this sounds like it's a stock picker's market. What do we need to own then in this environment? What makes sense?
Well, first of all, we will need to, again, at this moment in time, observe the progress of the reopening of the Strait of Hormuz. That's very important because despite the pullback, the recent pullback in the yields, they're still on the uptrend. So if we see the US 10-year yield going back up above 4.6% in a decisive manner, right, entering the 4.8% zone, then it is time where one would be expecting a deeper correction in equities. Like they can play that 6 to 8% play out around that time. So if you have such a scenario, one should be looking at taking advantage of the potential correction and adding back into the areas of technology where there's benefiting from the development of AI.
Yes. And what's the baseline scenario at Standard Chartered Wealth, Dan, in terms of the reopening of the Strait of Hormuz? Do you have a imminent scenario, or is it going to take weeks? Is it going to take months? What do you have in mind?
The base case scenario is that it would take a few weeks for the Strait of Hormuz to start to reopen, right? Obviously, it would take time for the traffic to normalize. It would not be a sudden recovery in the traffic like, before February. It wouldn't be like that. And we assign a probability of around 70% of that happening. But there is a 30% chance where it will be a prolonged conflict.
I see. From a global portfolio standpoint, should we be chasing the rally in the AI chip names in this part of the world, in South Korea, Japan, and Taiwan?
Well, we are long-term bullish on that trend. But like I said, at this moment in time, after such a sharp run-up, it can be prone to a correction, especially when the inflation concerns really start to filter into the equity market. It's already in the bond market, of course, right?
And if companies like SpaceX, OpenAI, Anthropic, when they come to the market, and to all intents and purposes, it's going to be a historic event, is that going to validate the AI boom, or is that going to do the opposite? Is it going to signal that we are approaching peak enthusiasm? And to what degree is this make or break for the AI trade?
Well, it would depend upon how they actually trade when they actually get listed, obviously. I would say that there is it is a trend for more of these companies to be listing. They are already important players to the industry and also to the existing players, right, in the space, right? Because I would believe that their listing would signal that the pie is getting bigger and it can grow further. That's how I see it.
I see. And let's just bring it back to the data dependency, Dan. We get US inflation data, PCE, the Fed's preferred gauge of inflation. Expectations are putting headline at a 3-year high of 3.8%, and the core at 3.3%, which would be well above the Fed's 2% target. If those numbers do materialize, then how negative potentially could that be for equities?
Well, I believe that the numbers would only get worse, right? Because if the situation persists, then it is likely to be getting worse on the inflationary front. Even if there were to be reopening, it is going to be a process. It will take time for the activities to re-normalize. So basically, we need to be prepared for the fact that the inflation is going to be at least for a few months, optimistically, right, scenario, that it will be staying higher, much higher than that 2% target. So, like I said, the bond market is already reflecting that. Equities are being masked because of the fact that the AI trend is so strong. But we basically would need to be looking at one's portfolio and be ready to be managing the risks that are arising. I would say that actually you would need to be having some dry powder there in order to be adding to the items or the stocks or the bonds that you like to buy for the longer term.
I see. Dan, final question. US midterm elections, could that be a referendum on America's involvement in this Iran conflict? And how significant would a shift in congressional control be for the markets and the macro?
Well, it is already reflected in the opinion polls. And I would not be surprised if the Democrats will be gaining much headways, right, in that midterm elections. After which, I believe that there could be some recalibration in the policies. But we're talking about November. I mean, if the war lasts until then we will be in for some major spike in the inflation ahead. So that would be a scenario where it's not a base case scenario. We're still seeing that the war would be significantly de-escalated within a few weeks.
You have to continue watching those bond markets. Dan, we'll leave it there, sir. Thank you very much indeed for joining us with your analysis and insights. Daniel Lamb there, Standard Chartered Wealth Solutions. Inside India is going for a quick break. We are back in 2 minutes.
US economy.
Here are some of the stories that we're keeping tabs on. Baiju Ravindran, the founder of Indian edtech firm Baiju's, plans to appeal the Singapore court's contempt ruling linked to the default of a loan tied to Qatar's sovereign wealth fund. According to his lawyer, the dispute relates to a $150 million loan from the Qatar Investment Authority to a Singapore-based investment firm, for which Ravindran acted as a guarantor. Ravindran says the default was triggered after bankruptcy proceedings began against Baiju in India, adding that lenders have now agreed in principle to a settlement. The once high-flying edtech company saw its valuation surge to $22 billion during the pandemic before facing mounting financial and legal troubles. Authorities say 2 people were killed after a major chemical explosion at a paper mill in Washington, D.C. on Tuesday. 9 others are still unaccounted for, likely bringing the death toll to 11 people. A further 9 people were wounded, with some still in critical condition. A chemical tank ruptured at a Nippon Dynawave packaging facility, causing it to spill millions of litres of highly corrosive liquid. Authorities say the contamination also entered the Columbia River. A probe has been launched into the cause of the explosion. And Norway has agreed to join France's nuclear umbrella, becoming the latest country to receive France's nuclear protection. The move, which was announced by both leaders at a Paris meeting on Wednesday, signals a shift by Norway towards closer defence cooperation with Europe, reflecting growing concerns in the region over US commitments to security. Under the agreement, Norway would take part in what France calls forward nuclear deterrence, under which allies are more closely involved in French strategic thinking on nuclear defence. Back to the markets, and the price of gold and silver is slumping today. Let's bring you up to speed with what those prices are doing exactly. Spot gold, 4,374, down by almost 2%, and silver down by 3.2%. Let's give you a glimpse of US equity futures, which are looking somewhat negative. So it looks as though we are going to be retreating from some of the record levels that we've seen for the major averages, including the NASDAQ. And that's probably a lot to do with some of the headlines which are pointing once again at re-escalation in the conflict in the Middle East. That's all the time that we have today on Inside India. Do keep watching CNBC Access Middle East coming up next. A US airbase and has vowed to deliver more decisive action and a response if US strikes continue. Oil prices rebounding in Asian trade, rising nearly 4%, with WTI back above $90 a barrel.
3 months into this war, central bankers are convened in Tokyo to attend a conference at the Bank of Japan as inflation grips the global economies. Two Federal Reserve presidents joined us on CNBC and had this to say about inflation.
I'm more attuned to the inflation risks in the immediate term than to the labor market risks.
I am focusing heavily on inflation. I'm not ignoring at all the labor market. We need to pay attention to both sides, but the labor market is in decent shape right now, while inflation is simply much too high.
Speaking of which, we'll be getting a glimpse of the inflation print from the stateside with the PCE, the Fed's preferred gauge of inflation stateside later on tonight. So that will be very important in terms of informing the outlook for the interest rates of the Fed. Let's get a snapshot of how the markets across Asia are doing, and in a word, cautious. Reports of US strikes against Iran undermining optimism for a peace deal. And then, as we said, there is the release of US inflation data. PCE, the Fed's preferred gauge, expectations are putting the headline at a 3-year high of 3.8%, core at an annual rate of 3.3%, and they are well above the Fed's 2% target. If that does materialize, then that will have implications for the policy outlook at the Fed. Oil prices are rising again today. Let's take a look at the two global indicators. There you are. WTI in Asian trade, sharp spike there, up by 4%, 92.31. Brent crude 98.05, also up by 4%. This on the back of Iran saying that it launched a retaliatory strike on a US airbase after the US attacked one of its airports. Iran also vowing more decisive action and a response if US strikes continue. This after a US official told Reuters that the US struck an Iranian military site that it sees as a threat to traffic on the Strait of Hormuz. The official also said that the US military shot down multiple Iranian drones. Meanwhile, President Trump discussed peace talks at a cabinet meeting overnight. He told reporters he's still unsatisfied with Iran's offer and is not in any rush to secure a peace deal. Disagreements seem to come from three key issues: control over the strait, Iran's uranium stockpiles, and Iran's access to $24 billion in frozen funds. Here's what President Trump had to say at a cabinet meeting overnight.
Would you be comfortable with Russia or China taking their stockpile of highly enriched uranium, and have they offered to do that?
No, I wouldn't be comfortable.
That
That would not make me comfortable.
Is the U.S. considering easing sanctions on Iran to allow Iran to sell its crude to market?
No, we're not talking about any easing of sanctions or giving money. No sanctions, no money, no nothing. We have control of money that they claim is theirs. We'll keep control of that money. When they behave properly and when they do what's right, we'll let them have their money. But right now, we're not doing that, and it's one thing is not contingent on the other.
US Secretary of State Marco Rubio was also at the meeting, having returned from the Quad summit in India. Rubio said there's been some progress in peace talks and that the US would prefer to exhaust all diplomatic options before escalating further.
The bottom line is Iran's never going to have a nuclear weapon. And if recent events have done anything, is just remind us once again that they are the world's leading sponsor of terrorism. And they can never have a nuclear weapon. Now, the president's preference, Mr. President, your preference has told us repeatedly, is always to negotiate these things and to figure out if you can have agreements. Diplomacy is always the first option.
Now back to this region, and the Bank of Korea has left its policy rate unchanged this morning, but data is showing that there was a hawkish split, some divergence among policymakers. Lisa Kim has the details and joins me now.
Hey Shri, so Bank of Korea delivered a hawkish hold, keeping rates steady at 2.5% as widely expected. And this was the 8th time in a row that the bank kept rates steady. And it was the first meeting that the new governor, Shin Hyun-soo, chaired. And the key takeaway is that he said during his post-meeting press conference that given the weak won, given South Korea's stronger than expected growth and higher than expected inflation, the path forward is clear. In the updated quarterly Fed-style dot plot system. So it's this forward guidance that sort of gives the board members estimates for the next 6 months. And according to that guidance, a majority of board members now expect a 50 basis point hike in the next 6 months to 3%, followed closely by a 25 basis point hike to 2.75%. And this is in line with investor expectations that the bank would hike 1 or 2 times throughout the year. And BOK revised upward its inflation forecast for this year to 2.7% and now sees the South Korean economy growing by 2.6% versus its previous estimates of 2%. And Bank of Governor Shin Hyun-soo said, according to the bank's analysis, growth might even overshoot 2.6% if the Iran war ends sooner rather than later. And as we've talked about many times on CNBC, South Korea's GDP growth has really been sustained and exports stronger than expected, all thanks to the boom in AI and this insatiable demand for South Korea's memory chips. The South Korean won today is slightly weaker and it continues to trade in the 1,500 handle to the dollar. In fact, it's weakened by 0.4%, so a lot more than this morning. And South Korean government bond yields are higher across the curve, Shri.
Yes, it's, South Korea is fortunate in many ways, isn't it? The AI trade is the saving grace given this external shock at the same time. Thank you, Lisa. Let's take a look at Treasury yields ahead of the Fed's preferred inflation gauge later today. And a lot of the action has been on longer dated Treasury yields, 30-year yielding 5.0538 and benchmark 10-year yielding 4.5321. We've also been hearing from top Fed officials at the Bank of Japan and Institute for Monetary and Economic Studies conference in Tokyo. Chicago Fed President Austin Goolsbee, who is not a voting member of the FOMC this year, told CNBC earlier that the current energy shock may not be transitory. He also spoke about productivity, AI, and what that could mean for the Fed.
I have cautioned against front loading of rate cuts and the way the voting works in the U.S. I was a voter last year. I'm not a voter this year. In the last FOMC meeting of December of last year, I dissented against the final rate cut not on the ground. I'm still optimistic that if inflation starts heading back to 2%, I believe rates will ultimately settle at some place well below where they are today. But I wanted evidence that the inflation was not going to end up being persistent. I don't regret dissenting at that meeting because the inflation has not proved as temporary as was advertised at the beginning. On AI, though, my concern is that future increases in productivity that make us rich may fuel high equity prices. They are a increase in your wealth today to know that you're going to be rich sometime in the future. And that can encourage people to spend out of this wealth in the stock market or others. And before the AI has actually increased the productivity, you can overheat the economy in the near term. So I have cautioned, I want people to just pay attention to, are you seeing big increases in consumer spending fueled by stock market wealth increases? Are you seeing data center investment driving up the cost of electricity, of construction workers, and having this short-run impact on inflation in the U.S.? I think it's quite critical that we think about that. And I think that lesson is also important for Asia in the sense that no general purpose technology stays in the country where it's invented. if you look at electricity, if you look at telephones, computers, all of those, if there is productivity growth to be had from AI, it will be coming soon to Asian countries too. And this same dynamic that people know that they're going to be richer in the future, and that could be fueling spending now, I think is worth thinking about.
And what are you seeing in terms of AI CapEx versus non-AI CapEx? Because I feel like at some point, because right now, at least in the markets, everything is running hot, memory prices going up, and a data center build out is happening. A lot of money being sucked into that. But what about non-AI part of the U.S. economy and really the global economy that should be supportive of things when AI story gets stalled a little bit, because it cannot really go up in a straight line?
Yeah, they're struggling a bit. I mean, they're grappling with the increased costs of computer chips, of electricity, of construction workers, as I described. And you hear that a lot throughout the U.S. as I'm traveling around. We're in rural parts of the district, like Cedar Rapids, Iowa, is kind of right in the center of the country. And I said, what's the biggest problem facing the economy in Cedar Rapids? And they said the data centers using up all the power, our electricity, and we can't find anyone to build out housing for our workers. So I think the non-AI economy, the hotter that gets, the more frothy that feels, they can, in a sense, pay the price. It's a little hard to separate out, though, from what was the impact of tariffs that hit the supply chain and raised the cost of production, too, and what's the impact of oil prices. All of these in surveys and just on the ground when personally talking to folks, there's a very heavy emphasis on affordability, costs, and prices as being people's biggest concern on the economy.
So if you were to vote tomorrow, if you were to be voting this year, Austin, where do you go? I mean, inflation upside, there's the risk, but then there is also the downside, growth risks.
I think the U.S. Fed has what they call the dual mandate. The law says that when setting monetary policy, we're supposed to do two things only: maximize employment, stabilize prices. My read of the U.S. labor market is it's been quite stable. And the thing that is going wrong is inflation. It was making progress. It stopped making progress last year and now has been rising. It's going the wrong way. So I'm more attuned to the inflation risks in the immediate term than to the labor market risks.
Let's bring in Kari and Joji, who was at that BOJ conference this morning in Tokyo. And Kari, you've been reporting powerfully about this. And for the Japanese public, this debate on inflation is not academic. It's real. There is increasingly a cost of living crisis developing in Japan.
Absolutely. It was there before the war erupted, and it's just compounded by the fact that Japan is so energy dependent. As I mentioned, we did have a chance to speak to two Fed presidents, and I also spoke with the Minneapolis Fed president, Neil Kashkari. And of course, as you were hearing earlier, the dual mandate that the Fed has is inflation and jobs. But there's a discrepancy on the regional discrepancy as well in the U.S. as well. So it depends. I think it's important to get a handle on how the inflation looks from the Minneapolis side as well. But here's what he had to say on that point.
We'll look at everything, and we've said when the two sides of our mandate, the labor market and inflation, are in tension, that we will take a balanced approach. For me, as one policymaker, what I would say is inflation has now been elevated for more than 5 years. And the longer it goes on, the more we run the risk of inflation expectations unanchoring and starting to drift higher, which we cannot let happen. If that were to happen, then we'd have to respond even more aggressively. So we're much better off doing what we need to do to keep inflation expectations anchored. That means, for me, I am focusing heavily on inflation. I'm not ignoring at all the labor market. We need to pay attention to both sides. But the labor market is in decent shape right now, while inflation is simply much too high.
So many variables, but I think one element that's changed and we also need to look at is change at the Federal Reserve as an institution with the new chair, Kevin Warsh, coming in. And he said many times that reducing the balance sheet is going to be a priority. So I did ask the Minneapolis Fed president whether he agrees to this, and if so, how it should be done. Take a listen.
Well, I think whatever we would do, I think we would want to do it gently and slowly, because the Fed balance sheet is so large, as compared to history. The U.S. Treasury market plays such an important role in the global economy. I think any changes that we would make, we would want to communicate well in advance and explain the rationale for it. And so I would go into such discussions with an open mind, and let's examine everything and see what makes sense for the next 10 years.
These are some of the issues that are on top of the mind of the central bankers convening here today. It's not just the Fed that's here, the Bank of England, Bank of Thailand, of course, the Bank of Japan, who's hosting, and all of them, and to some degree, Sri, are faced with similar issues.
Yes, and quite the dilemma if we do have a stagflationary situation of stubbornly higher inflation and slower growth. What do central banks do then? Food for thought. Thank you very much indeed for that, Carrie. Let's take a look at the dollar index climbing towards the 100 level. Cedric Shahab from BMI will be joining me after the break to talk global growth and inflation risks. We're back in 2 minutes. BMI. Cedric, welcome to the program and great to see you. Let's start with the Strait of Hormuz. And are markets mispricing the duration of disruption to energy supply from the effective closure still of the Strait?
I think that's a great question, and good to be back in the studio with you. So the question whether markets are mispricing the risk has one that we've been asking ourselves for over a month, maybe 2 months, because you have equities hitting new highs, yes, and you have oil markets, trading higher, but not in the danger zone just yet. And I think what markets are probably telling the world is that they are optimistic that a resolution to the conflict will happen in the near term before there's a non-linear impact on the global economy. And what I mean by that is, if you look at the ceasefire, it's clear that both Trump and Iran have been really working hard to keep that ceasefire alive, even though there were some skirmishes. And both Trump and Iran have huge incentives to resolve this conflict as soon as possible. And I think that's what markets are pricing in. And because of that, the global economy has been able to absorb the shock over the near term. However, if it were to extend for another, let's say, 2-3 months, I think that's when markets would become much more worried about the knock-on impact from shortages emerging and from a lack of oil, potentially higher oil prices, and potentially higher inflation. Because I think the big change that we've seen here is that most economists have knocked down their growth forecast a little bit, but what they've done more significantly is increase their inflation forecasts. And that now has a lot of central banks and bond markets on the back foot. We saw that in a rise in bond yields over the past few weeks, and we also saw a lot of somewhat larger than expected hikes by several central banks around the world. And I think that becomes an inflection point for markets if rates start to rise further.
The challenge, though, is even if the Strait does fully reopen tomorrow, the damage to infrastructure, to oil supply, has already been done, and it's going to take weeks, if not months, to recover. So there is going to be, quite frankly, a bid in the oil market that will continue to keep prices supported and inflation high.
Yeah, I think that's right. So it'll take maybe anywhere between 1 month and 2 to 3 months for the Strait to reopen fully and for vessels to start, the passage rates to start and the transit rates to normalize. That depends on insurance companies, the willingness of the shipping companies themselves, the crews, and the type of vessel, of course. Now, the way we're looking at it is, while there might be a continued physical shortage in certain markets, that's known. The important thing is financial markets are forward-looking. So as long as they know the direction of travel is for more transits, then financial markets, oil futures, equity markets should look through that. While there is some shortages over the short term, the financial markets will be forward-looking in that regard. And I think that will be looked at optimistically.
Again, the difficulty here is coming up with a model of ownership for the Strait of Hormuz. And there are so many different actors involved in this. Trump has already said that the Omani-Iranian model is not going to work. That's a non-starter. He's already talked about imposing a toll. He won't tolerate the Iranians imposing a toll. What is required is an international solution for an international waterway, and that continues to be very elusive.
It does, and I think that's one of the major factors which is delaying the resolution of the crisis. Now, the Iranians have been extremely adept at negotiating. Despite being in a very vulnerable position, they were able to secure basically the Strait of Hormuz passage rights, in the sense that they are able to determine whether there are ships passing or not. And so that's a fantastic bargaining chip from their perspective. Now, going back to the question of should anybody control the Strait, I think the answer is no, and that's kind of the approach that Trump and the international community is taking as well, because then it raises the question, for every single strait in the world now comes under whose control? And then that is disastrous for global trade and for people basically taxing the world asymmetrically in order to extract gains. So Iran, for example, in the Strait of Hormuz, Strait of Malacca. Do we close that one up, for example? And it becomes hugely problematic for the global economy. And I think they don't want to set the precedent, and they don't want to give Iran that leverage.
However you slice it, inflation is moving higher. Is it going to be transitory? Is it going to be prolonged?
So we think it's going to be transitory in the sense that most of the shock is coming from oil. And we can see that in the data. There have been some other factors which have impacted inflation. So for example, in the US, shelter, there was a double counting that pushed it higher. And while we expect oil prices to remain high for the near term, once we get to a resolution, oil futures will start to come down. Markets will start pricing in lower oil prices. And I think that's going to feed through to the other direction on a month-on-month basis for sure. So the energy inflation component will be transitory, and I think that'll relieve some pressure. The problem is that some economies are growing quite well, and so you're starting to see the service side of the economy still doing okay. We have a little bit of pressure from let's say chips demand. We just heard that in the previous interviews, that's pushing up costs for electricity, etc. So while the economy remains in an okay situation, that will keep inflation maybe a little bit higher than central bankers would want, but from the oil perspective, that'll come down. And so while inflation, for example, in the US can maybe head a little bit above 4% in the next few months or so, By the end of the year, we think it's going to be closer to 3.3. But that's still too high for central banks. And we've seen central banks in the Philippines and Indonesia, for example, all hike interest rates in recent months in response to concerns about inflation.
And you're quite right. And let's take the narrative to India, where this is a classic supply-side shock, which could very well morph into demand destruction or a demand slowdown. Next week, there is going to be an RBI meeting. And then on top of that, India has to deal with currency depreciation, and that raises the cost of imported inflation. Does a hike make sense in this environment?
So I think that's one of the most hotly debated questions right now, India, and there are a few reasons there. First of all, the good news is that inflation in India started the year quite low. And so the increase from oil prices has only pushed it to about 3-4%, which is lower than where it was a couple of years ago. So inflation in India is not as bad as, let's say, Philippines right now.
Yes.
The second thing is the government also has policy tools to subsidize some of the feed-through, right? And so over the near term, maybe policymakers are looking at this and say, well, we have a couple of more months before we need to really do anything. And if that's the case, then maybe we just wait a little bit. And if oil prices then start to come down, then we know we didn't have to do anything. But if oil prices remain high and they think actually this is going to start feeding through to inflation, then they still are in time to hike if needed. So I think the central bank has been given a little bit of they've been signaling a little bit maybe of a wait and see approach. But look at what happened to Indonesia. They hiked by 50 basis points. Maybe they get ahead of it. And to the point of reserves, they've been intervening. They have a lot of, in terms of the currency, they have a lot of reserves. They've been intervening in the currency. But the Indian currency has been one of the worst performing alongside the Indonesia rupiah, for example, over the past 3 months. So it is certainly something that they're mindful of.
Yes, and that's really symptomatic of some deep-seated structural economic challenges that India does need to address.
Well, it's not only India. So actually on a currency basis, a lot of people were talking about a stronger dollar being risk-off trade and money capital flight to kind of safe havens like the US. But that's not actually what we've seen. Yes, the dollar has strengthened a little bit, but what we've seen is it's a terms of trade shock, and that's being reflected in currencies. So if you're an energy exporter like Brazil, Australia, for example, your currency is a little bit stronger. If you're Malaysia, it hasn't depreciated that much. If you're energy importer like India, Indonesia, for example, South Korea, Chile, currencies have been hit more aggressively. And in that sense, I think it's a terms of trade story.
Cedric, we've got to leave it there. So always great catching up with you. Thank you very much indeed for those insights and analysis. Cedric Shihab there from BMI. Coming up on the programme, as US-Iran negotiations continue, disruption to the Strait of Hormuz has caused maritime traffic to fall to new lows. We'll speak with Parash Jain from HSBC about this after the break. River. More than 3,200 Lebanese have been killed and 1.2 million Lebanese have been displaced by Israeli strikes since March the 2nd. Palestinians mourning the loss of one of Hamas's most senior figures after Hamas's armed wing chief Mohammed Odeh was killed in an attack by Israeli forces. Odeh was the head of the group's intelligence service and was killed just days after the death of his predecessor in an Israeli strike. Sources say he was possibly the last remaining living member of the Hamas armed wing's higher leadership council. And Norway has agreed to join France's nuclear umbrella, becoming the latest country to receive France's nuclear protection. The move was announced by both leaders at a Paris meeting on Wednesday and signals a shift by Norway towards closer defence cooperation with Europe, reflecting growing concerns in the region over US commitments to security. Under the agreement, Norway would take part in what France calls forward nuclear deterrence. And Kuwait has approved the route for a new 500-kilometre high-speed rail link connecting Kuwait City to Riyadh. The rail line is expected to be completed by the year 2030, with travel time between the two capitals projected at under 2 hours. The project is part of a broader regional push to strengthen logistics connectivity amid shipping disruptions linked to the Iran conflict. Saudi Arabia has issued tenders for sections of the wider GCC railway network linking Gulf states, while the UAE recently completed its first passenger rail station in Fujairah, strategic port city outside the Strait of Hormuz. Speaking of the Strait, Iran and the US indicating they're still far apart on control of the crucial waterway. Iranian media claimed yesterday that Iran and Oman would jointly manage the Strait to restore traffic back to pre-war levels. But at a cabinet meeting overnight, President Trump dismissed those reports, saying no one would control international waters.
The Strait's going to be open to everybody.
And who would control
it? International waters. Nobody's going to control it. We're going to watch over it. We'll watch over it, but nobody's going to control it. That's part of the negotiation that we have. They would like to control it. Nobody's going to control it. It's international waters, and Oman will behave just like everybody else, so we'll have to blow them up. They understand that. They'll be fine.
And European logistics giant Kuehne + Nagel Group spoke to CNBC about how the disruptions from the Strait of Hormuz are impacting its Asian clients and how they are rerouting supply chains. Here's more from that interview.
We see a couple things. The first is the Chinese giants are rising quickly, and with their rising maturity in supply chain and their rising distribution of their product, we're seeing them take greater control over the supply chain in international markets. What that means is instead of selling goods FOB here in China, they're taking delivery of the goods all the way through to the final industrial customer in the United States, in Europe, in South and Central America. That's led to a change in the dynamic of the market. So we see a rising amount of business in our industry that's controlled, decided, shipped, and paid for here in China. And we see that in the big emerging industries of China. So in automotive, in battery production, in technology, in consumer electronics goods. And we basically see this trend where when the China-based supply chain management organization is more mature than the destination market, or where you've got rapid change in an industry, the Chinese companies are choosing to take control over that supply chain. That's leading to a lot more business activity here for us in China, and a lot of change in our ability to kind of grow our business here based on prepaid China cargo, which has been really exciting for us. And that's one of the reasons why I'm here in Hong Kong today.
Yeah, and talk to us about your shift to work more closely with some of the Chinese exporters and reducing reliance on European or American importers. What led you to execute that shift, and how has that paid off so far?
So I think we've been working on this for a little over a year.
Yeah. Was it tariffs?
So tariffs sped up the process. It's acted as an accelerator to that change that was coming. And that's really about industrial maturity and international supply chain density across the world, right? And the Chinese companies, you see them disrupting, European automotive industry. We see them taking the lead in wind and taking the lead in solar. And as part of that, the a lot of that discussion becomes how do you take control and deliver your supply chain at best quality? And that we're seeing much more control here. We have positioned that we're bringing more and more resource here in terms of solution engineering, supply chain design, these resources that we need to have here in China in order to make sure that we can cater to that market. And it's a fast growing market for us. We're really excited about the potential of that.
Let's get more on the global logistics and shipping market and industry. Bring in Parash Jain now, Global Head of Transport and Logistics at HSBC Global Research. Parash, welcome to the program. First of all, are markets underpricing or mispricing the duration of disruption from the Strait of Hormuz?
I would rather say that the shipping market is pricing it in real time. As if you see, pretty much since the start of COVID, the industry was first to recognize that chaos is no longer an exception and it is increasingly becoming a norm. And that's why you are seeing the flexibility in terms of supply chain, and sea is merging with the road is merging with rail. We are adding aviation into it. Now, if you see what does that mean on the ground, so we are now third month into this crisis, and you have seen actually different subsectors has performed the way you would have expected in a crisis scenario. We have seen a surge in the tanker rates at the start of the war, and as the supply eventually navigated where the demand is, we have seen the freight rates rolling over. We have seen the peak of air cargo rates, and now they are also slowly grinding lower, but high enough to capitalize on the fuel price increase. So yes, I think market is pricing in, but yes, there's certainly a disconnect on how equity investors are looking at these changes.
Yes. And let's talk about that. The global shipping market is sending some very mixed signals, isn't it, Parash? Current pricing suggests tanker rates are fading, dry bulk is strengthening, containers remain resilient. What do you make of all this? Which sectors' valuations appear most inconsistent with the underlying fundamentals?
And in fact, actually, and it's a great question. In fact, we have started to see a divergence within the subsectors itself. And it's not only limiting to the shipping, but also on the aviation side, right? For example, in a shipping, if you see, and the dry bulk companies who has a more exposure to the Cape size have outperformed the shipping companies which has exposure to smaller vessels. On the tanker, most interestingly, you would have expected the crude tankers to do well. And don't get me wrong, they did well. But if you see what has happened in the last 1 month or so, the product tanker guys have started to outperform the crude. And as they say, right, the biggest villain of higher price is the higher price itself. So the reason that we have a cautious view on the crude tanker shipping stocks is because if this crisis stays longer than what most people think, you have started to see that will have an impact on the demand. And you will see the excess supply eventually will lead to a collapse in freight rate, which is pretty much what some of those stocks have started to price in.
Parash, I was talking to my previous guest and asking him about his expectation on when he sees the Strait of Hormuz fully reopening, and he gave it probably a few weeks, maybe mid to late June. Does that sound right to you? And once Strait of Hormuz transit volumes do normalise, would that call into question the sustainability of the $400,000 a day Middle East Gulf VLCC rates that we have seen?
So certainly, I mean, 400,000 we have seen, it was at that moment. I think what market is pricing in is that once the Strait of Hormuz opens, there will be a pent-up demand because most of the countries will try to build a strategic reserve, which would be somewhat higher than the pre-war scenario. But what market need to bear it in mind that the capacity that we have lost, the peak oil production may take more than several months to get back to the pre-crisis level. And that's where we see a disconnect between the supply and demand. In terms of the timing, I mean, to be honest, anybody's guess is as good as anybody's guess. What I have learned since COVID is that more often than not, any of these crises last longer than what most people think. Whether it was COVID, whether it was Russia, Ukraine, whether it was Red Sea, and now it's the Strait of Hormuz. So when we advise to the investors, our view is that your base case should be that these things will last longer. And based on that, you plan your investment thesis and probably hedge your bet in a different scenario outcome.
And Parash, we heard from President Trump reject outright the Iranian-Omani model for ownership off the Strait of Hormuz. Is there an ownership model or a structure that the global shipping market perhaps favors, or are they largely agnostic about that as long as tankers and container ships can easily pass?
It's all about setting precedent, right? Because mind it, from the container shipping perspective, or Strait of Malacca, right? Now, does it mean that if the Strait of Hormuz has a new model emerge, will it have a rub-on effect on the other choke points in the world? So it's an uncharted territory, and to be honest, I don't think that I have a strong view, or anybody would know actually what shape or form it will take in the coming days or weeks.
Let's go back to the divergence that we've seen in these markets. Tankers have enjoyed the most obvious geopolitical tailwind, yet non-Middle East Gulf rates are already below pre-conflict levels. Dry bulk rates continue to strengthen, though. What is that telling you, Parash,
yes,
about these markets?
It tells you that the ships follow where the dollar is. So the freight rates went up. The ships started to sail as fast as they can. As the export out of Gulf reduces, the ships started to reposition themselves to the Atlantic. So the freight remains higher till the time ships relocated to the place where the oil is. As soon as those ships were made available in the Atlantic, you have started to see the supply exceeding demand, and therefore a decline in the freight rates. With respect to bulk, actually the dynamics are slightly different, because typically they carry somewhat lower value cargo. So a higher oil price incentivized ship owners to sail slow. And that coincided with strong grain growth, strong iron ore growth, probably a bit of coal trade started to warming up in an absence of gas. We have seen Korea is importing coal. We are talking about some of the mothballed capacity in Europe is being reactivated. So the dry bulk, because the expectation was very low, it's surprising you on the upside. On the tankers, there was so much bullishness and optimism, not only from the ship owners, but also from the industry guys to the investors. Probably the risk reward certainly still remains on the downside.
And just a quick one on tanker rates outside the Middle East Gulf, which have fallen below pre-conflict levels. Is that an early sign that the market is already pricing in normalization?
On the contrary, actually, what market is pricing in now is that this status quo will remain. Because hypothetically, let's say one day the crisis gets over, and the 8% of the capacity which is trapped on the other side of Strait of Hormuz releases, oil production in the Middle East gets back to the normalcy, you will again see a trend of lot of the capacity from the Atlantic will revert back to the Gulf region. And at that point of time, again, you will see, because the demand will be in the Gulf region, all the vessels are in the Atlantic. So again, you will see a surge in rates. And then as the time goes by, you will start to see freight rate normalizing. So I think it's very, very dynamic. And in fact, the one thing that we have often asked, why equity investors have never been appreciative or never made enough money in the shipping, is because of the duration mismatch. A ship owner can take a 25-year view, but as an equity investor, probably 25 weeks these days looks too long.
Parash, so let me put that money question to you in that case. If you had to invest in only one of these segments within the global shipping industry and logistics for the next 12 months, which would it be, and what is the key variant perception at work here?
Yeah. So, I mean, see, it all depends on what are our base case assumptions with respect to what's going on. But there are certain themes which has emerged in my wider coverage. And what we've been saying is that the companies like shipbuilding, they are an intended beneficiary of this extended disruptions. We are seeing probably some of the aircraft lessors will get a boost because of the strong demand of the narrow body new tech new tech planes. On the other hand, some of the global businesses like some of the global freight forwarders, some of the global port operators who have exposure to the non-US, non-China trade routes, those would be some of the consistent winners and which can withstand the either outcome of this crisis. But just focusing on what's going on in the Strait of Hormuz, where we stand today, our preference is that bulk are better positioned. Containers in a short term has an upside, whereas tanker is where we see the most downside.
Interesting point on shipbuilding. Why are ship owners, ordering so aggressively despite the geopolitical and the macroeconomic uncertainty?
So this very good point, actually. If you look around all the previous down cycles or a crisis versus this is very, very different. This time around, shipping industry has made a lot of money. Everybody is flushed with cash, and which means that more capital is chasing fewer slots in terms of the shipyard capacity, because shipyard capacity has gone through a 15-year of down cycle. And on the other hand, if you see this particular cycle, while the asset prices are at a record level, whereas if you look at the steel prices, because of what's going on in China, steel prices are at pretty much a break-even level. There is not much labor inflation. There is plenty of labor available in China. So it is pretty much a perfect playground for the shipbuilders. And we have seen how these stocks has performed, whether they are Koreans or Chinese.
And that's interesting, isn't it? Chinese yards have captured a 71% market share. Are Korean and Japanese yards losing competitiveness, or are they choosing to focus on higher value vessels?
It's a combination. I mean, it's the trend which probably is unlikely to revert. What we have seen is in the last 12 months since the onset of USTR disruptions, the Chinese shipyard has gained the entire lost market share. The Japanese shipyards were the losers, because bear it in mind that there is not much capacity to be come out of the Korean shipyards or the Japanese shipyards, whereas we have seen some of the mothballed shipyards in China has been reactivated, especially in the north of China. You are seeing a productivity gain also. And in terms of quality, I mean, we have seen like 20 years back, China were building the small bulk vessels. Then they moved into the larger bulk and tanker. Then they pretty much dominate now the large containers. So far as gas carrier are concerned, the Koreans still have a dominant market share and an edge. And probably 10 years down the line, probably we will see even that will be tilted towards the Chinese shipyards.
And a final question, Parash, on profitability with regards to container shipping. What's the biggest threat to margins? Is it lower freight rates or rising operating costs? And how much pricing power ultimately does the system have?
So, I mean, everything boils down to demand and supply. I mean, we have seen shipping lines making money in 2020 when the global demand was down. We have seen shipping lines losing money when Brent was $20 back in 2016. So at the end of the day, the industry has an ability to absorb every shock, whether it's a demand shock, whether it's a supply shock, whether it's a cost shock. As long as demand exceeds supply, they have a pricing power.
Parash, we'll wrap it up there. So always a fascinating conversation with you. Thank you very much indeed for those insights. Parash Jain there from HSBC Global Research. Now, as we tail into a break, we are taking a look at cryptocurrencies. Bitcoin near a 6-week low. Access Middle East will be back in 2 minutes. to create shared progress. Our China reporter Lane Yu has this story.
Hey, Sri. So Germany's economy minister, Katharina Reiche, visited Beijing, joined by dozens of business leaders. So this is a trip coming after Chancellor Merz's visit just 3 months after, and also comes at a critical juncture where the EU is set to debate its China policy. You have major member states like France, Italy, Spain, and the Netherlands pushing for a tougher stance to address things like China's overcapacity. But notably, Berlin is not part of that call. So we're seeing a growing divide within the bloc on how to approach China. Now, the minister said, "We seek dialogue with China because fair competition is needed." She said, "Competition is good and ensures that we improve together, but it must be designed to mutual benefit." Now, another central point of discussion for Germany is securing a reliable access to critical minerals in China. This is what Minister Reiche said in Beijing. Take a listen.
Competition makes us stronger, cooperation creates stability, and innovation creates shared progress. We have talked about critical raw materials. Our companies, not only those that have invested here in China, but also downstream companies, need access to critical minerals, to rare earths, because the modern world, modern technologies, are inconceivable without these raw materials. I have explored with my counterparts ways to create access that our companies can rely on so that China and Germany can grow together.
So the minister and her delegation met with China's Vice Premier He Lifeng and the Commerce Minister Wang Wentao. And the Commerce Minister had some pretty strong words saying, quote, protectionist EU trade restrictions have seriously disrupted cooperation between Chinese and European companies. But he said that China is willing to expand areas of cooperation and narrow the list of differences. Now, with this widening divide within the bloc, we see the German minister making her position clear, saying that thousands of German companies depend on being able to export to the large Chinese market. But of course, underpinning that is Germany's growing trade deficit with China, which reached a record 87 billion euros last year. So we'll see how that debate this Friday shapes up, and it will reportedly review a proposal to have these resilience tools compelling European importers to diversify supply chains. Sri, it's back to you.
Elaine, thank you very much indeed for that. Now, before SpaceX filed to go public, it took on a $20 billion bridge loan, and that payment is due in just over a year. The company plans to use the IPO proceeds to fund growth, not to pay down that debt. CNBC's Leslie Picker takes a closer look.
SpaceX is known for its engineering talent, but pour one out for the financial engineers, too. Following SpaceX's acquisition of xAI in February, the company secured a $20 billion bridge loan to retire $17.5 billion of high-interest junk debt, accumulated largely through the buyout of X, formerly Twitter. The bridge loan dramatically cut SpaceX's interest costs, with the legacy bonds carrying rates as high as 12.5% and the new bridge loan at 4.58% as of late March. This is a huge balance sheet cleanup post-xAI merger. If you recall, the $44 billion buyout of Twitter in 2022 became the worst hung debt deal since the financial crisis because banks couldn't syndicate amid deteriorating performance and a jump in interest rates. Wall Street held the debt for years, tying up capital that could otherwise be deployed elsewhere. The same banks that orchestrated the bridge loan, though, Goldman Sachs, Morgan Stanley, Bank of America, Citigroup, and JP Morgan, are also the lead managers of the IPO. So this is ultimately a fee bonanza for them. SpaceX was hit with a penalty for early repayment of the junk debt, but that's been mostly negated by the interest savings. So why does this matter for the IPO? Well, in the prospectus, it says that the bridge loan is, quote, required to use the net proceeds of the IPO to repay the loan within 6 months following receipt of such proceeds. The same is true for the cash of other types of financings as well. So in other words, even though the S1 says the use of proceeds are for funding their growth strategy, including the expansion of AI compute infrastructure, enhancements to launch infrastructure and launch vehicles, increases in scale and capacity of satellite constellations, there's another less sexy, down-to-earth, near-term potential use, which is paying off debt. For CNBC Business News, I'm Leslie Picker.
That's all the time that we have today for Access Middle East. Europe Early Edition is up next. Have a good day.
credit.
Welcome to Indianomics. What's puzzling about the rupee fall in the past 15 months is that it is happening at a time of modest current account deficit. Current account deficit, or CAD, is the extent to which current outflows like imports, interest payments on loans are higher than inflows like exports and remittances. Historically, over the past 30 years, India has run a CAD of just 2 to 2.5% of GDP, and we have had enough capital flows to fund it. In 2013, CAD went up to 5% of GDP and we had a rupee problem. But in FY25, India's CAD was only 0.6% of GDP and we still had a problem. Likewise, in FY26, CAD, or current account deficit, is only about 1.3% of GDP. We still have a falling rupee because capital flows are not enough. The problem is, historically, we always had enough capital flows, that is FDI and FPI inflows, to bridge the current account deficit. But in the past 2 years, we are not able to get capital flows even to fill smaller current account deficits. But then we can't do much about capital flows if investors are chasing AI stocks or commodity markets. What we can control is our exports and imports. Hence, the Indian government has signed a host of FTAs to boost India's trade. India signed 9 free trade agreements in the past 5 years, and 11 more are in the pipeline. The question we are asking today is, will more FTAs help us to bridge the current account deficit? Will they increase capital inflows in the form of FDI? Will they give us more services exports? Joining me are 4 experts: Arpita Mukherjee of ICRIER, Amita Batra of JNU, Rupa Chand, formerly of IIM Bangalore, and Professor Pralok Gupta of the IIFT, Indian Institute of Foreign Trade. Gentlemen and ladies and Mr. Gupta, thank you very much indeed for your time. Well, let me start with Arpita Mukherjee. Ms. Mukherjee, you know, I was looking at the data from UAE and Australia. Those are the two countries with which we first signed FTAs. They become effective in 2022, I believe. But if I looked at it, 22, 23, 24, 25, 26, it is not as if exports have grown a great deal. I mean, they've grown in some years, but, you know, to Australia, for instance, exports have grown by just 3% in FY26, 3.96%. It's not as if the FTAs have done wonders. Are the FTAs taking time to generate exports? How should we look at what to expect from the free trade agreements?
See, basically, the exports happen from the free trade agreement based on tariff phasing period. So you have to wait for 3 to 5 years to see a change. Having said that, the two countries that you selected are actually a very low tariff country. So they any which way had very low tariff. And the FTA that you selected with Australia is actually a mini deal. It's not a very comprehensive FTA covering wide range of products on both sides. Secondly, after the trade agreement is concluded and signed, it takes time for the implementation, and based on the phasing out, you see the benefits. So if you are entering a zero duty immediately on signing of the agreement, that will show something, or else you are going for like 5-7 years phasing out, then you will see the growth in exports slowly.
Okay, fair enough.
These are two things you have to take into account, and don't take all trade agreements from the account of, you know, that they will really boost export. It also depends upon the market. There are markets where you know, the custom duties are much lower than India. In most countries, they are lower than India. So, you know, when you're doing a free trade agreement, India may have to reduce the duty more than those markets. But there are many other gains of the trade agreement, like you bring in regulatory parity and all of that, that we can discuss later.
Fair enough, fair enough. Professor Batra, would you want to add to this? What's your take? Is my whole premise to look at FTAs as a solution to current account deficit all wrong?
Not at all. Yes, exports are expected to be pushed up because of an FTA. But as has been said already, there has to be a distinctive, higher preferential margin that we must be able to access the other market with. In case of Australia as well as EFTA, you see the tariffs on the other side are low, preferential margin is low. The incentive for our exporters is low. Plus, there is also another aspect, you see, which is that when we look at competition in these markets, you know, particularly when we're talking about Australia, there have been some gains, as you mentioned, in the textiles and clothing sector. But these are far smaller than the rate at which you see a competing nation like Vietnam gaining in Australia. So these are, you know, Vietnam is a country that's already present in these markets. It dominates these markets. And so there is existing first mover advantage for certain other countries that you have as competition. So export competitiveness, building that up for us as a prior to export and FTA benefits is very important. The second aspect that you mentioned in terms of the capital account bit of the overall balance of payments, I'd like to touch upon that too, because an FTA is not just supposed to be, I say supposed to be, just export push through the preferential access, but also the linkages that it provides any country in terms of integrating with global value chains. EFTA has an investment promise from the other side, but the commitment is another aspect. And so are the UK and the, you know, the coming in EU, European Union FTAs, you know. With all these, what we need is an additional component which ensures investment is part of the trade deal or as a separately negotiated parallel agreement. And that will come in when we have our own template, that is the bilateral investment treaty model of 2015. Worked upon, that was promised in the budget of 2025, but we've yet to see the outcome of that. So it's the trade investment linkage that must be promoted and that must be protected and be a part of the FTA trade deal to give us the real benefits in terms of enhancing our exports and attracting FDI.
Okay, fair enough. Let me get Professor Gupta in. Professor Gupta, as has already been said, I am prematurely looking at the goods data alone. We have to look at investments and services. So if you can enlighten me on either of them, have our FTAs already signed or to be signed concentrating enough on promise of FDI? I think with the Europeans, there is some $100 billion commitment. Can you enlighten us? If we are not able to narrow our current account deficit, will the FTAs at least bring in enough capital flows to bridge that deficit?
Yeah, thank you, Lata. Just 2 points. One, before coming to your question with respect to, because you started your show with linking FTA journey with the current account deficit.
That's right.
So it is very important to note that our renewed journey for FTA, it started in 2020. So at that time, we were not facing any pressure on the rupee. So it's more a part of that. Exports are part of our more growth strategy when we are talking about the 5 trillion economy. But essentially, what I'm trying to say is that it's not that because CAD is high, so we are focusing on FTA. We have started FTA journey much ahead. And coming specifically to your question on the services and investment, yes, on the services sector, there are significant commitments from our FTA partner countries. So from like European Union, we have around 144 subsectors that have been committed by European Union out of the around 160 subsectors in the services side. The same is true for UK also. So more than 135 subsectors they have committed. And one thing which is very important to note in the services, that there is a commitment, there is a liberalization or commitment on a foreign direct investment in the services sector, which is in the trade parlance called Mode 3 or commercial presence. So India has made commitments on Mode 3. That means India has committed to allow foreign direct investment from these countries. So there is an expectation that significant FDI in the services sector will flow.
Yeah.
Second, on the 100 billion in the EFTA agreement that you talk about, the Switzerland, Iceland, Norway, and Liechtenstein, there is a provision that these countries will make 100 billion investment in coming 5 years. And if there is a shortfall, then the balance that have been achieved in the FTA that could be recalibrated. So it's a more like incentive or facilitative element that these countries, the private sector, are more promoted to make investment in the country. So I would say that these FTAs are geared towards having a multi-pronged effect on the economy in terms of investment, in terms of increasing exports, in terms of increasing imports to ensure the raw materials for India. For example, in the Australia deal, we have good provisions for the raw materials like cotton, chemicals, and different kind of raw materials so that supply chains are completed. Also, there is a mutual recognition agreement like with the Australia. You mentioned some data on the Australia. So last year only we signed a mutual recognition agreement on the organic foods. And so India's testing, India's standard that would be accepted in India.
Fair enough.
Now, see, where is the market for organic food?
Yes.
The market is in the developed countries. Yes. Now, if these kind of things are happening in the FTA, they will give benefit in different to the country.
I take your point, sir. If it has only happened last year, then I'm counting my chickens too quickly. We will have to give it time. Professor Rupa Chadha, thank you for your patience. Can you tell us if the FTAs are geared towards having more GCCs and other kinds of services? Is there evidence already?
Okay, so thank you very much, first of all, for having me on this show. First of all, the whole perspective of looking at an FTA in terms of its benefits is not about reducing deficits. And as previous speakers have said, it is much wider than that. It is about promoting exports, but it's also about increasing inputs and having, supply chain diversification, getting access to critical inputs, reducing manufacturing costs. So there's a range of things that you actually want from the FTAs. They're geopolitical, of course, as well. And second thing is that having a deficit bilaterally is per se also not bad. It could be because you're actually getting access to better quality inputs and that feeds into better quality exports. You could be increasing your bilateral deficit, but actually increasing your exports to third market. Now, here coming to the services question that you specifically asked, yes, of course, we've seen that our surplus is there in services. We are seen to be competitive in services, however, not a sufficiently broad range of services. So we tend to focus on IT-enabled and professional services. So I would look at services much more broadly than, again, just professional services and IT services. And I would look at imports of services as well through Mode 3, which can enhance our overall economy-wide competitiveness. So what do I mean? I mean, for instance, logistics. That's a very important sector. Many of these sectors are actually open to FDI. Telecommunications. So what I'm getting at is that look at the service sector both as an enabler for exports in other areas, as well as our exports, which we already have, which we are doing very well at in areas like DTCs and IT services, professional services.
Ma'am, I have to run into a commercial break. Sorry for interrupting you. We're going to come back and take a more detailed look at all these verticals that you all have spoken about. Mutual investments, getting into global value chains, more services, more investments, all those questions after the break. Welcome back to this very special Indianomics. I have four trade experts, Professor Arpita Mukherjee, Professor Amita Batra, Professor Pralok Gupta and Professor Rupa Chanda, who have invested a lot of their research efforts on FTAs, designed them for India. Some of them, they've been part of the negotiations. They're asking whether at what point in time the FTAs will ensure that we are able to either get enough capital flows to bridge our current account deficit or to narrow the current account deficit itself. Ladies and Professor Gupta, thank you for your patience. Arpita Mukherjee, to start again at what is our current problem. I agree with all of you that we did not design the FTAs at a time or with the intention of narrowing current account deficit, because at that time, that was not the problem. But right now, we have that problem. So by when do FTAs mature enough for us to be able to milk them, to give us either exports or higher investments? Does it take 5 years, 10 years to really marinate?
Lata, that depends upon when did you sign the agreement, when the agreement got implemented. So if you sign the agreement, see, there is a gap between the signing and the implementation. If you look at UK, it is almost a year. EU, it will be almost a year. So there is a gap between the signing and the implementation. And then after the implementation, there are trade partners have 5 to 7 years. In some cases, earlier FTA, we had 10 years to actually see the entire benefit. So there is a time period that is there. During this time period, let us understand, if you go back to your question of export versus import, during this time period, you also have to see that these countries are doing trade agreements with many other countries.
Yeah.
Some of them who have signed agreements before us, like Amita pointed out, and their implementation has already happened, whereas we are in a phase of implementation. So if you are looking by country, you need to also, the other thing is that if I am catering to Australia, I need to actually think what Australians will consume and like. They have a limitation to how much they can consume Indian products. Like, if I am going to sell basmati rice to everybody, there will be a limit to which they will consume basmati rice. So am I able to move up the value chain from a raw material intermediate producer to a final product that is needed by those markets? So this is also very important, and that's what I think Rupa was trying to push, was that whether my domestic economy is gearing towards the need of the partner country and customizing the product that is needed there.
Okay.
The moment we customize the product that is needed there, you will see a growth in our export. It takes a time for the industry to rethink, understand a new market, look at it from a liberalization perspective, that I'm going to now get a easier access to this market and then move forward.
Fair enough. Ma'am, I'm sorry. I am out of time. This is a small show with too many good experts. We'll have to debate on a later day. But Amitabh Batra, when we did the ASEAN FTA, we got into trouble with a lot of Chinese goods coming, because the rules of origin were not very clear. Are we now ironing that out? Can we say that the new gen FTAs are better designed to ensure that our goods go to the destination countries more safely and we are not flooded with third-party products?
Thank you, Lata, for that very important question. I'll answer it in two ways, and be a little more specific. One, to also your earlier question, I really consider the UK and EU FTA, both of which to be yet implemented, to be more substantive, and I think to be more benefit yielding. Because both these have in them elements that can bring us value chain integration and possibility of immediate benefits in terms of 100%, for example, in case of textiles and clothing being brought to, of our tariff lines in that sector being brought to zero on immediate effect.
Okay.
But as I said earlier, there is competition, and so we need preparation. This preparation is very important. We have time as far as the EU FTA is concerned, and we need to bring our exports up to that level which will be accepted in those markets. There is a lot of potential in these markets. There's a lot of consumption, but we have to remember that there is also a lot of emphasis on sustainability related regulatory standards in both the UK as well as in European Union. So prior preparation is important, When you talk about rules of origin, I think it's very important, A, that we not be flooded, B, that we are able to send our exports to the right destination in the right manner. As far as flooding is concerned, I have to say what the UK, for example, has adopted recently in terms of reduction of its quotas. India has somehow taken that as an issue to delay the implementation of the India-UK FTA. Now, I wish we had not done that because the issue of there, as far as dealing with the reduction of quotas for steel imports is concerned, should have been taken separately at the WTO, which we are. But we should have gone ahead with the FTA implementation, which was to otherwise come in May, because it has benefits of value chain integration, particularly also in a sector that we are very good at, such as automobile components.
Okay.
Although that would have been phased out over 10 years, but it would have given us a very, very good...
You know, Dr. Batra, I will have to give you more time because this is a large topic, especially our relation with Europe. Unfortunately, the clock is ticking. Just 1 minute each to the other two guests. I'm sorry. Pralok Gupta, what's your sense in terms of when we will start getting the full benefits of these 9 plus 11, 20 FTAs? Do you think India's trade gallops by the time we get to 2030?
See, I think earlier speaker also pointed out that we are talking about this number 9 and 11 FTA, but only 3 FTAs, UAE, Australia and EFTA. They are right now in the implementation stage. Okay. The others are either just signed, not yet implemented, or still negotiated.
Yes.
To say that when they will come into implementation. But I say that their effect come into play in the short period, in the 3 to 5 year, but there are also long-term benefit in terms of increased whenever professionals move to their countries, in terms of increased remittances flow, and also the innovative approaches that we now have in our FTA. For example, in the Australia FTA, we have post-study work visa.
Yes.
Our students going there, they will work and send the remittance here.
Yes, yes. Fair point. Got it, sir. Got it. I'm sorry, I'm out of time. Rupa Chanda, you can add one more sentence to this. Out of time.
Okay, so I will just say that for at least the UAE and the Australia FTAs, we are seeing some increase. Now, to what extent you can say that's due to the FTAs, that's always difficult. You have to look at utilization rates. But really, the benefits will come if you, in parallel, also have domestic reforms, scaling strategies, SME integration strategies. It would take at least around 3 to 5 years, as Pralok said, to see some benefits, but the longer term benefits of leveraging investment, technology transfer, digitalization, integrating services with manufacturing, these are really the things that will pay off in the long term. And there are many intangibles that will come in terms of quality, standards, skilling, capacity building, etc., which you cannot quantify with any bilateral trade
superb.
deficit.
That's an excellent last sentence to wrap up this discussion. We should not be counting them prematurely. It's just that there is this big problem of rupee and current account deficit sitting on our head, and we get these high, headlines of FTA. We try to link the two. We should know that this is a longer term effort. Thank you very much, ladies and Professor Gupta, for joining me. We will invite you for a more detailed discussion later on. That's it on Indianomics. Thanks for watching.
where are we? Are we in the early stages? Are we in the mid-cycle? Are we in the late stage caution cycle? Where are we?
Yeah, thank you so much, Prashant. Very good evening, everyone. Pleasure to be here. When we talk of credit cycle, being from a credit rating agency, the way I look at credit cycle is what is the status of the credit quality landscape or credit conditions. So it could be benign, it could be risky, and so on and so forth. So today, the way I look at it is we are in a benign credit quality environment. And if I look at, say, corporates or even financial sector entities, balance sheets have improved over time. So if I look at CRISIL's rated universe, which we rate around 7,300 active companies, and if you look at, say, the leverage levels, the median gearing has halved over the last decade, come down from 1.1x to 0.5x. Interest cover ratios have more than around double, 2.7x to 5.2x. And if I look at financial sector entities, again, asset quality has improved, provisioning cover has improved, companies have a lot of cash on their balance sheet. So overall, we are in a I would say, benign credit quality environment, but we need to keep at the back of the mind that long-termism has to be key in our approach or assessment and analysis, because we need not be lulled by the fact that the last few years we've not seen too many defaults. But if I look at a 10-year horizon, we did see some defaults, large-scale, high-profile defaults actually, which actually paralyzed the market to some extent for some period. Today, we should not forget those. Credit cycles come up and down. Credit quality can deteriorate, and we need to keep that at the back of the mind. Robust credit assessment is the need of the hour. But today, as I said, I think we are in a benign credit environment.
Benign credit environment. Suyash, you want to sort of jump in there? Your assessment?
So Prashant, I would agree, and there are 3 or 4 highlights or aspects that I'd want to point out. First is, I think it's becoming very much more sector specific, because given the context of the war, and so there's multiple shocks that the system is facing over a period of time. The other thing is, over the last few years, you have had a very large retail leverage cycle, but the starting point was very large or healthy amounts of capitalization. So clearly, you're not seeing much there. And you also had, corporates starting with very benign balance sheets, and you haven't had much of a capex cycle, which would draw that, kind of resourcing out. But I would say, where we are now, and not really from a credit deterioration standpoint, but the right pricing of credit, we are in essence in the midst of a funding shock, which is coming from a sustained period of balance of payment deficit. And, so the country level lack of dollar funding is percolating into liability side, funding, I would say, stresses in terms of availability and cost of capital across the board. And on the other side, you are seeing probably a once in a decadal, if not more, shock from the commodity cycle suddenly flaring up. The lack of the India-US deal probably pressuring the SME, MSME sector. So not so much of the credits that we as mutual funds get exposed to, because most of what we are talking about may not be issuers in the market. But I was just caution, that things are different for different people now, and there is a generalized, need to right price. Because if you're the holder of capital, you are, basically the setter of the narrative right now. Because in essence, what we are facing is a bit of a paucity of capital.
When you say a bit of a funding shock on the liabilities side, is that chase for liabilities was there even before, or this is something which has happened now because of what's going on?
So, used to be a...
because I thought the liquidity was ample. Or that's not the case. Or you're saying it's ample for some, but not for many others.
So where we would distinguish is, the availability of what we call liquidity under the liquidity adjustment facility of the RBI, which you measure as net repo, reverse repo, and the actual presence of enough liability side on balance sheets. So basically, despite 4 lakh, 5 lakh crores of surplus liquidity in LAF levels, what we all understand is banks don't create or destroy liquidity, neither do corporates create or destroy liquidity. So what is lacking at this juncture is probably, and this is a 2-year-old problem now, that the BOP level stress is, giving rise to what is otherwise known as the impossible trilemma, which is that, if your external account is under pressure, that shows under rupee pressure, and that goes against the independence of monetary policy. So what you're seeing is the 5-quarter repo rate is basically irrelevant for the market. And therefore that fundamental anchor of where rates should be versus the repo rate for the time being is lost. So I'm coming not so much from, that there is large-scale credit stress building, which clearly it doesn't seem to be. I'm just coming from standpoint of right pricing of all spread across the curve, because still, this BOP stress is with us. Probably the funding stress is also with us.
Fair enough. And we'll come back to some of the macro points in just a bit. But Kruti, you want to sort of address that? Just a quick assessment.
So, like rightly pointed out by both of them, but also I would like to go back to the few panel discussions that have been there before this, right? It's a matter of trust. And we've seen that come back in the bond market after a long time. Bond markets have gone through 2013. They've gone to the other NBFC crisis. But every time that we have come into the market, we've come back with stronger regulations, stronger systems. And not only in India, anywhere the function of a market liquidity or function of market building up is the function of regulations, which is why we see more active markets in some regions and we don't see active markets in some region. So we've seen worst of it in 2022, we've seen worst of it in 2013. We have certain things in place where regulations have also come in place, and at the same time the government support has also come at right time. We see that announcements happening. So yes, there is a stress, there is economic stress that we see because of balance of payments. Obviously, we see other credit to deposit ratio has also widened a lot. But given that the systems are in place and we are now, before we used to be more reactive, now we've become more proactive when it comes to regulations also or any measurement that has to be taken. Therefore, this feels that we will go through this cycle smoothly rather than, there obviously will be pockets of it, because ultimately credit cycle is a function of what derives from the economic measures, right? So how long this situation goes on, obviously it will be a derivation of it, but if it is something that we can contain it or it is short-lived, then we will see that we will flow through this cycle very smoothly.
Fair enough. I mean, I think for about 2 years, credit growth was a little lower, then it started picking up towards the end of last year. All the way into February, it was looking fantastic. And then, of course, late February, this entire thing started, and credit growth, etc., has taken a bit of a hit. I mean, your first thoughts on that exact question, which is, where are we in the cycle?
Yeah, I think the best of balance sheets improvements are behind us, which does not mean that balance sheets are looking bad right now, but incremental improvements are very difficult to come by from here on. The second is, if you just segregate corporate credit and retail credit, on the retail credit side, cash in the consumer hands is slightly better right now in the last 6-8 months. That's what you refer to when you talked about the consumption cycle. But there is a K-shaped element to that, so we have to be careful on that side. There are parts which are doing very well, there are parts which are not. The last point, I think Suyash and everyone has already spoken. I think I would agree with Suyash's point. While the balance sheets are good, we are today as an economy struggling to fund a 13% credit growth, which means that somewhere the market infrastructure is becoming an issue. This is a macro structure issue. And the second macro structure issue which we need to address is this complete breakdown in terms of transmission, at least as far as debt capital markets are concerned, vis-a-vis the policy rates. I can amplify Suyash's point by telling you that today banks are borrowing 3-month money at 225 basis points over repo. The last time that happened was in a crisis period. So somewhere I think we need to manage the macro level issues properly at this point in time, so as to ensure that the liquidity issue does not convert into a credit issue in the near term.
When you said that we are struggling to fund a 13% credit growth overall, I mean, just is it because of some of these rate distortions across the curve? Is that the issue here?
No, so very frankly, I think banks are possibly the only large providers of credit at this point in time because of various structural issues. Debt capital markets have still not reached a point where you can use them as a fallback mechanism for availing credit at all points in time. We are at best seasonal fair weather friends in most of the times. In any kind of a macro stress which we are going through right now, the moment you see liquidity getting uneven across the ecosystem, wherever you see some amount of friction in terms of liquidity, which is essentially the friction flowing out of the BOP issue, you are suddenly seeing banks struggling to fund a credit growth which is actually much lower than what we were used to funding in the last 10 to 12 years. So it is essentially a market, I don't know how to put it, a market infrastructure or macro market level issue that we are facing right now.
Suyash and Amit both have raised the question of the macro level stress, if I can put it like that, which needs to be solved. So let's jump straight to that. I mean, I don't want to use the word crisis type situation, but it's been a stressful situation. Maybe things are, things have come up a little bit from extremely stressed levels over the last maybe 76 hours, maybe a little more. Suyash, but what needs to be done, in your opinion? I mean, what's the repo is at whatever 5 or the 10-year is at 7. As Amit said, you're borrowing 3-month money at 200 plus basis points over the repo rate. Are we looking at what are we looking at? I mean, 5th of June is the policy from the Reserve Bank. What should we expect?
So Prashant, used to be a time not so long back, in fact most of our careers, what we used to track as the fundamental point to be bullish or bearish fixed income was the status of country's current account deficit, right? And actually somewhere in 23-24 we became extremely bullish on interest rates because we saw what we thought was almost a structural compression of a current account deficit, courtesy the services trade balance moving from a 5 billion surplus per month to 15 billion surplus per month, largely owing to the GCC phenomenon. And that looked sustainable to us. However, the last 1.5 to 2 years is not about current account, but the funding of what is even a modest current account. And to us, the starkest, measure there is what is known as basic balance, which is net FDI plus current account deficit. So that tells you the sustainable level of current account that the country can run. And the basic balance has actually been negative for almost 2 years. So then we started to hunt for reasons as to what could be changing, because certainly nothing much was changing for us. Our inflation credibility is fine, fiscal credibility is fine, growth matrices have been okay. So something has changed for the world. And there are 3 things that we can distinctly figure out that has changed in the world. The first, and I think it's very, very underappreciated, although we talk about it, is that the average level of global rates has set up. So, in the post-COVID, post-Russia-Ukraine inflation shock, we used to say that, Fed has hiked, US rates have gone to 4 to 5%, but they won't sustain there because those economies are not built to handle these rates. But guess what? They are thriving in those rates, right? So, if you're any sort of a global asset allocator, the risk-free rate that you now have to beat is higher. And that may not be showing as, debt flows, but certainly banking flows, challenge in ECB raising, etc. So, the capital account is reasonably fungible. The second thing that has turned is now you have competing themes for capital allocation around the world that are very powerful. So look at the AI theme. You're talking about $1 to $5 trillion companies, right? So it's no longer, emerging markets growing at 10%, attracting capital from the rest of the world. It is, these large balance sheets that are, posting 15, 20, 25% growth rate, not to mention the AI capex cycle that has started in the US. So if you're a global portfolio manager, you have high global rates and competing themes around the world. So probably 10, 12% nominal growth rate is not good enough. And the third point, which, also needs to be thought about, is that the second largest economy in the world is sitting on this massive excess capacity. So how can you really have a broad-based manufacturing capex cycle anywhere else in the world, but for the themes that are topical today, right? So if you have to lift 200, 300 basis point investment to GDP, I'm not talking about specific sector, capex, but aggregate 200, 300 basis point, you could potentially argue that if not for the capex associated with AI, the narrative is just not there. So it's basically this combination of 3 things, and that has now been in play for last 1.5 to 2 years, that is essentially leading to cheapening of your asset base. Now the problem is cheapening itself is not good enough. You need a narrative alongside the cheapening, and a sustainable turn to this can really happen only with 2 things. Either global rates for whatever reason start to come off, or the AI theme starts to fatigue itself. You may get a temporary reprieve with the war cessation, because that is, to us, the fundamental issue with the war from just the market standpoint is not the inflation impact, not the growth impact, but the BOP impact, the balance of payment impact. See, at this juncture, I would probably, most of this panel would agree with me, nobody even cares if RBI repo rate was at 6%, right? Provided in the journey to 6%, they did not destabilize our rate hike expectation. So it should not be an intermeeting hike like what happened in the last cycle, but nothing is being priced of 5 quarter. So look at term spreads, your back end of the government bond curve is sitting at 770. The post-COVID high, when fiscal for India peaked at 9.2 and Fed funds rate peaked at 5 quarter to 5.5, the long end of the government bond curve peaked at 795. We are at 770 now. Right, so nothing is being priced off it. And to my earlier point, the term spread market is showing stress. To Amit's point, the AAA blue chip funding market is showing stress. And therefore, any sort of capital allocator has to do right pricing today.
So just to finish that loop, there is of course waiting for the AI trade to fade off and oil prices to fall and the war to settle down or excess capacity to be used up. Those are external, not some, right now, say for example, out of Mumbai, the RBI, what should we expect? Just to close that loop off, because do you have to react in some way? to what's happening right now, or wait it out?
No, I would say, given that average inflation forecasts have to invariably move up, and RBI is first and foremost an inflation targeter, they should start the rate hike cycle going. But at the same time, ensure that they don't unanchor markets' rate expectations. So you don't need a fresh pressure point coming from mixed commentary from the RBI. So you start the rate hike cycle going just to, continue to be credible as a conventional inflation targeter. But it won't solve much for the time being. What you could potentially hope for is a benign confluence of events. And I am not operating via perfect wisdom. I'm sure there's a big piece I'm missing here. But what we can think as a benign confluence of events is some sort of a dollar bond strategy to whatever extent jumpstart it with a $30-40 billion flow. The cessation of war that takes commodities, so let's say oil back to 85-90. And then at some juncture, if the shock to the US economy, because that's also a K-shaped economy, starts to show in their labor market and Fed rate expectations were to turn again, then you could potentially get a window where dollar depreciates. In 2025, dollar depreciated, we didn't benefit. A lot of other EMs did. But hopefully this time around, because we are cheap enough, that could potentially show with us. And so you need that jump start to happen, and from there you can build that narrative.
So start the rate hike cycle and probably a dollar debt issuance, which brings in a chunky amount of money, and then wait for some of these other things to fall in place, hopefully. Fingers crossed. Yeah. Just to sort of, you addressed that same point, so I just want to come back to you. If you want to add something to what Suyash said, and we'll move on to the next topic.
No, I think we can move on because it's about regaining the status as the inflation fighting central bank. I think they need to speak that language. They don't need to spook the markets. They need to start early so that they don't overreact at some point in time. But just to add one point, I think, yes, there is a larger macro issue around BOP and liquidity impact, etc., etc. There is also internal micro issue in terms of money flowing within capital markets to various segments. I don't want to repeat what Lata has already said. You need to address that sooner or later. Believe me, there is money flowing into such segments where you get taxation benefits vis-a-vis debt markets. That is not funny any longer. You are actually curtailing flow of credit to where it is required.
Which means, just to illustrate that point.
Just to illustrate that point, everything in India other than debt.
I see. The tax issue, which is
everything under the sun is taxed differently, and not all of it is productive.
Okay, yeah, 100%. I think, and that's a jab at equities, maybe.
No, it is not. When I said everything, it includes everything that is non-debt.
Yeah.
And nothing against any other asset class. Everything needs to grow, but debt also needs to grow. I think we have created a market architecture issue now in terms of the simplest solutions also not being solved through debt. Everyone is going to everything other than debt, even to park 1 month money today. So that's the situation.
Krishnan, just to sort of come back to the where money is going, who's being able to access money, are investors sort of concentrated in what is perceived as safety in that sense? I mean, the AAA and are other segments kind of below that found wanting for money, or you think it's kind of evenly distributed? While from the top it looks like, well, as you said, it's pretty benign, but what's happening under the surface?
I think that's a very good question. From my perspective, I see a paradox. When I talked about benign, I was talking about from a credit quality landscape, situation is benign. But at the same time, if I look at the bond markets, they are very muted. Last 6 to 9 months in terms of issuances, it's actually negative vis-a-vis similar period of the previous year. But just from a background, a more long-term picture, if we have to kind of have a very strong, broad-based economic growth and a resilient financial system which supports our move towards Viksit Bharat, what we need to have is the banking system and the bond markets both complementing and competing with one another and ensuring that there is a steady stream of low-cost funding to India Inc. Now, today, if I look at, while banks are reasonably doing well on major parameters, deposit growth is an area where they are still struggling with. Today, the gap between deposit growth and credit growth is around 300 plus basis points, which is not sustainable for a longer period of time. So they are, as Amit pointed out, looking at short-term CD raising. Some of the private banks are looking at securitization. They can issue bonds and so on. But unless deposit grows in a sustainable manner, credit may not grow to a large extent. Now, coming to the bond markets in India, historically, it has been narrow. Access to bond markets have been to AAA and AA credits only. 90% of the issuances are in these segments. And we need to take a series of steps in both the supply side and the demand side to ensure that we have a more vibrant, deeper bond markets. Today, if you look at the US, the corporate bond market as a percentage of GDP is 45%. India, it's 16%. Securitization market in the US is 53% of GDP. India, it is 2% or less than 2%. So unless we grow these, for instance, securitization and covered bond from a supply side perspective, if it has a proper policy support, it can help lower rated credits, the mid-rated credits, access the bond markets. Today, an interesting study that we did was for A-rated corporates. The risk-adjusted return for investors is actually higher than in AA and AAA rated credits. And if I look at today the balance sheet, the debt protection metrics, gearing, interest cover, etc., for A-rated credits, it is actually has improved substantially the last 10 years. Today, an A-rated company is looking more like a AA-rated company of 10 years back. So that's how it is. And in terms of universe, if I look at our universe, we have 1350 A-rated credits. AA and AAA put together is 950. So that way diversity is also there. So unless we start moving down the credit spectrum, more from a patient capital perspective, also insurance companies, pension funds, it will become difficult to broad-base the bond market. Other thing, of course, tax-related disparity is there. Other thing is the retail investor base in bond markets, while marginally growing, but still it's well below what it should be. And today, some option can be a tax benefit to them in, say, infra bonds. For instance, in Brazil, last decade, there was an incentive on infra bonds, and we saw a large proportion of retail investors investing there, and that segment itself picked up. We need to figure out some way of getting retail investors into the market, have a broader bond market, and the bank loan also needs to grow. So all that needs to happen for a smooth flow of credit into the economy.
welcome to the Editor's Playbook. Today we discuss something that is hot topic from the White House to the Vatican. Well, it has to be artificial intelligence, but we dive into the India stack and the fuel powering the world's AI engines. Now, foreign portfolio investors have pulled out over $24 billion from the Indian equity markets since the start of 2026. A major driver behind this exodus has been the global reallocation of capital towards artificial intelligence and tech-linked assets. But this, again, is something where the debate is split wide open. But consider this, Taiwan's equity market, where Taiwan Semiconductor Manufacturing Company accounts for more than 40% of the benchmark index, has now become the world's fifth largest stock market, powered largely by the global AI boom. Taiwan's weight within the MSCI Emerging Markets Index has also surged sharply over the past several years. Meanwhile, AI-driven demand has turbocharged memory chip makers like Micron Technology, as memory increasingly becomes one of the most critical components of the AI revolution. In fact, NVIDIA, SK Hynix and Samsung Electronics, three companies at the heart of the AI boom, have each added between $690 billion to $750 billion in market cap just this year alone, as investors aggressively chase AI-linked growth. So which brings us to the key questions. How many trillion-dollar companies do we have in India? To be sure, the Indian government has placed significant bets on semiconductors and data centers, but have we truly unleashed the genie yet? And perhaps more importantly, can an AI deficit eventually become an economic problem? Joining us on the show today, Prashant, Rima, Sriram and Hormuz. Rima and gentlemen, thanks very much for joining us on the Editor's Playbook. Prashant, let's get straight to it. Do the Indian stock markets have an AI problem or not? Where is India placed on the global AI table?
I think we do for now, Shireen. Great to be back on the playbook. And yes, I mean, I think it's very clear that we do have a problem, whether we like it or not. Let me just start with a data point, which I think helps focus the mind. As someone was saying, I guess exaggerating a bit to make a point, there are only three stocks in Asia which are attracting all the capital. There is Samsung, there is TSMC, there is SK Hynix. These three, the foreign holding in these three companies, Shireen, is 750. It's about $1 trillion. The three foreign ownership, foreign value of foreign holding in these three companies is $1 trillion. The total value of foreign ownership in India is $750 billion. So, that just tells you the size, scope, scale, etc. Now, to your specific question, does India have, listed AI plays, especially from a market standpoint? And what I've done really is looked at, the different layers of where, what AI is. Because when we talk about AI, largely, the conversation revolves around LLMs, etc., the large language models. But let's take it from the top, right? So first, of course, is the global AI capex. Who's doing 90% of the capex? It is three companies: Microsoft, Amazon, Google. And when the others like Oracle, etc. But these are the three which account for about 90% of all the capex. One layer down, of course, we don't have a play here, obviously. Second is the AI accelerator sort of layer, which is essentially the chips, the GPUs. The big ones, NVIDIA is the big daddy. There is Broadcom and a bunch of others. Again, we don't have a foot here. Memory comes one layer below. As you were just saying, there is Samsung, there is Hynix, and there is Micron, etc. You come to then you come to the advanced packaging, which is, what we call OSAT here. And, we are trying to build businesses here. Keynes, for example, is listed, and maybe you got one or two other, SEG Power, for example. But, the big ones are Semco, LG, Doosan, etc. These are the big ones, right? Then you come to one layer below, which is the network fabric. And here, again, LG, OE Solutions, etc., the big ones. Here in India, there are companies like Sterlite Tech, maybe an HFCL, which are trying to pivot away from telecom to data, providing network fiber for data centers. But again, very, very few. Then you come to the data center build-out itself, right? Which is, I missed one layer, which is, of course, the package chips have to be put together in an AI server. We have maybe a NetWeb, for example, but the big ones are Semco and some of the others. Data center build out, yeah, we have companies. We've got about 1 gigawatt of capacity. We have ambitions to go big, but again, it's a few here, few there. Then you come to the grid electrification and the power story, and maybe you have a few companies, again, not particularly, they're not Indian companies, at least those who have the technology. We talk about this HVDC technology, but that is Hitachi and GE Vernova, right? Nuclear is one level lower in the US, for example. People are talking about data centers having their own captive capacity. Maybe in India, because of the law has changed, we will get some action happening there. But the point is, if you look across the value chain and the hundreds of billions of dollars flows from right at the top, US, right? And those three companies which I spoke about, and it flows through across the system. And who's sending all the equipment needed? I mean, who's essentially getting all this money? Or the capex. It's not US companies. It is companies largely based in Asia, based in Korea, based in Taiwan, and I mean, whether we like it or not, perhaps based somewhat in China as well. Those are the guys who are sort of, recipients of these, whatever. I think the number for 2026 in terms of capex is some $750, $800 billion, just about 5 or 6 companies in the US.
Just give us that FII number again, Prashant, the FII holding as far as these AI companies are concerned?
Yeah, just 3 companies, Shireen, right? That is the three Asian companies, TSMC, SK Hynix, and Samsung. The total FII holding in these 3 companies is $1 trillion, $1 trillion. The total stock of FI money in India is about $750 billion.
Well, that tells you the story, but let me bring Hormuz into the conversation since we are talking about $1 trillion companies being minted overnight, 2 of them being minted overnight, Hormuz, and that gives you a sense of the size and scale that we're also talking about.
Absolutely, it does. And, the market is working on a very simple principle, right? You give us the numbers, we'll reward you. And you give them a theme. Whenever you speak about something like this, the easiest example to give is the new age companies that listed in India all the way back somewhere around 21, 22. At that time, they were loss-making companies. Eternal is a case in point. That one point, the IPO price was around 75, 76 rupees, went up to 130, 140. Then when the numbers were not showing up, the street smashed it down to 40. When the numbers started to show up, it went all the way up to 360. Yeah. And that's the case with these companies as well. So it's not as if the street is blindly chasing a theme just because it's the hot topic right now. You take a look at the numbers for these companies over the last 3 quarters. NVIDIA's revenue growth 2 quarters back was 122%. On that base, it delivered a 94% revenue growth in the quarter prior. And in the most latest quarter, it still delivered a 53% revenue growth on that base as well. So it's not as if you would have a company who would grow 20% one year and the next year they would say, oh, we have a high base, so we'll grow only 6 to 8%. They are delivering the numbers quarter after quarter. Same is the case with Micron. Same is the case with AMD. Numbers are coming in, and that is exactly the reason why the stocks are doing what they are. Micron's market cap at the start of the month was $750 billion. Yesterday, it went up to $1 trillion. And that's because UBS came out with a note and they said that the stock can triple from current levels. And they said that their target earlier was 535. They raised it to 1625, which is more than 100% even from where it closed yesterday. So that's the kind of, and at the end of the day, you put your money where the mouth is. So if those are the kind of stocks that are delivering you the returns, it is only obvious that the money will go there. There are 2 stocks that are powering the Korean stock market, that's Samsung and SK Hynix, and 1 stock that's powering Taiwan, and the Magnificent 7 is powering the S&P 500 and NASDAQ to record highs almost every day. So numbers are coming in, and no matter what the doomsayers say, okay, AI is going to be, they are resembling the dot-com bubble and so on and so forth, but till the time the numbers keep coming, the market will keep rewarding them.
Shireen, just one thing.
You're absolutely right. And Prashant, I just wanted to make a point, which is why you see whether it is the Jensen Huangs of the world sitting there and saying, or Jeff Bezos, both who were on CNBC saying, look, we don't believe that this is a bubble. And to Hormuz's point, and that is because the earnings continue to show up there, at least at this point in time. And, you can argue whether this is going to hit a roadblock. Is it overdone? But at this point in time, the numbers are matching expectations. In fact, for many, ahead of expectations as well. Go ahead, Prashant.
No, Shireen, the point about what Hormuz said, right, that many making the comparison with the 99 tech boom. Back then, it was, it was valuations which were absurd and there were no numbers. We were talking about 100p, 200p, all kinds of numbers. Take a P multiple of the latest minted $1 trillion company, Micron. And this is not now. The average forward P multiple for Micron over the last 12 months is 10, right? That is because over the last 12 months, the earnings for Micron are up 10 times. So the P multiple is stayed at 10. And that is
also the company that pivoted to Bitcoin storing, right?
No, that's MicroStrategy.
MicroStrategy, okay.
So that is the point, right? Which is it's valuations, and we've looked at these numbers. I'm actually just take a look at the P multiple for the Korean stock market. It is, I think, about 8 times, 7 times, 8 times or something, right? So it's backed by earnings. I mean, of course, we can ask the question, and it's always good to look over your shoulder and look for signs whether this is getting. Because if the earnings stop coming or the earnings start to decelerate a little bit, look, for example, memory, Shireen, at the end of the day, it was always a commodity. But because there is just physical shortage of it, and prices are being, prices have gone through the roof, these companies are making money hand over fist. So if the earnings start coming off for the top layer, which is the 3 companies or 5 companies in the US, then they start cutting back capex. I mean, the entire flow-through will start to look, it'll be lesser. The flow-down will be lesser. And at that point, we'll start to wonder whether this is excessive or not.
But at least for now, these companies Micron...
I think the question mark there on the capex continues, but I'll get Rima to weigh in on that. And also, Rima, put this in context of what we are seeing as far as Indian markets are concerned.
Well, just to add to that point about Micron, and all these companies have orders booked for the next 3 to 5 years. Earlier, when Micron was considered to be a cyclical play commodity, you could replace one memory chip with another one in the CPU and work would be done just fine. So it was dependent on the vagaries of demand and supply and commodity prices. But now with GPUs, these memory chips are highly complex, personalized and customized, which means they also command a pricing power. But just to get back to that point about the AI haves and have-nots, and India currently is in the have-nots. We've got about 15 companies in the $1 trillion list. There is no Indian company in the top 100 companies in market capitalization. And since we are talking about the 2 newly minted $1 trillion companies, SK Hynix and the other one is Micron, at the start of the year, in 2026, when we began, 1st of January, the market cap of these companies was about $300 billion. Today, it's $1 trillion, which means they've added $700 billion. India's largest company by market cap is a Reliance Industries, and their market capitalization is less than $200 billion. It's followed by an HDFC Bank at 123 and a Bharti at $118 billion, which basically means that one company, say a Micron, has added $700 billion in this year alone. That is equivalent to 3 Reliances and 1 Bharti in terms of value, which has been created at a valuation level, Shireen.
Well, yes, we'll talk valuations and through the course of the show. But, Sriram, I know you believe that India has a play and India has a right to win in the AI era, despite what the markets may be telling us at this point in time.
Yes, Shireen, it's interesting how you can spin a narrative. I mean, and that's exactly what we are seeing that's happening, right? Prashant explained it in 6 or 7 layers, how you want to divide the AI industry. I would borrow from Jensen Huang, who divides it into 5 layers: energy, technology, infrastructure, LLMs, models, and applications. And if you look at it in that sense, India has a play in 3 out of these 5 sectors. If the argument is that India does not have an AI play, it's essentially centered around the fact that we don't have semiconductor chips, neither do we have foundational models, right? And that is true for every country except 4, right? US and China have models, Taiwan and Korea have chips. Any other country you take, you can make this argument against it. But that has not, for example, Brazil, Thailand, Indonesia, a bunch of these countries have actually seen net inflows into their economy. Despite, I mean, they're not talking about, is there AI or not? Do they have chips? Do they have models? So I think the narrative is that AI is a global phenomenon. And to address what Hormaz is trying to say, right, that NVIDIA has given you a growth on top of 100% growth, and it's 2 years of back-to-back phenomenal growth. That is what happens when you have a monopoly. You have pricing power because you're the only player, and I think that is the one thing that the Indian government is trying to avoid. I think we have a philosophically a different approach towards building AI. Time will tell whether it is good, bad, whether it works or not. But I think in principle, it makes sense to me.
through the start of the year, every time we see something from Claude or we see something from OpenAI, the meltdown that we see as far as the Indian IT services sector is concerned, I mean, that's real. It's been something that we've been talking about, and it's something that's very visible in the markets. Now, again, the question, though, is what does it mean in the near term? What does it mean in the medium to long term for the Indian IT services industry, for this ecosystem that has been a job creator, that has been a forex generator as well?
Well, I just want to point one data. So HCL Tech, so that's the first company, a tier one company, in its conference call today, in its conference call earlier, spoke about 40% of the industry is AI disrupted. So that's the only company which has put out a number which can shrink 3 to 5% for the next few years. He said 55% is AI augmented, and that has to play out, and that can grow 10%. And only 5% of the IT industry today is AI native, and that can grow 30%. So as things stand today, what HCL Tech is telling us is that 40% of the industry, IT industry, can shrink. Right? And this is an industry which has seen hyper growth. It's slowing down, and this would be the 4th consecutive year of a slowdown. And the problem comes back to jobs, right?
They are the ones to blame. I said this in few playbooks earlier also, right? If you have 500,000 engineers in your team, you should have built a ChatGPT, but you didn't.
Right? Even a Meta is laying off, right? You can always make that argument that global tech companies are laying off.
But having said that, in the same software industry, I believe in them, that, tomorrow when the dust settles down, they will be able to generate more value out of AI, hopefully. Maybe it won't be the same players. Maybe it will be someone else.
But there was a fortune.
And I just want to bolster the point that Sriram was making in the context of what we've seen coming in as commentary from Uber, saying, look, the cost of tokens is not giving you the kind of returns on investments or productivity, and perhaps that is going to be a question mark, and perhaps in that context, with the talent that we have, and with that being one of our strengths, this hybrid workforce that is being reimagined at this point in time, can that be a strength, Prashant Rima Hormuz?
On that token point, Shireen, so there are two impacts, right? One is actually that news that Microsoft and Uber, etc. This companies are blowing up yearly budgets in 3 months, right? But there is another way to read it. So the other way, one is of course saying, well, it's too expensive. The other is, well, people, engineers, etc. are loving it so much that they're actually blowing through the annual budget in 3 months, right? That's the other way to look at it. That it's so efficient that, but the cost is very high. That's the point.
And Prashant, you'll have to see it as a life cycle also, right? Right now, the AI is in that age where it needs semiconductor, it needs LLM. And as it matures, these are the things that they are going to ask for applications, and that is when Indians come into the picture.
Absolutely.
So I think there is a point, right? Yeah. There is a cost and there is a value. So yes, the cost of tokens is going up and the cost of using AI is going up dramatically. But the question is also the value. By using AI, if your productivity is going up to such a great extent, your go-to-market comes down, you can do the work instead of 3 months, you can do it in 1 day. So then it adds value at the end of the day. So there's a difference.
We have evidence of that. I don't know if Hassan Karmali is in our production control room or not, but the amount of graphics that we can churn out now within minutes, what would have taken us an entire day or a couple of days, we're being able to do in minutes. So the productivity gains are there for everyone to see. But it comes back to the cost aspect. Yeah, Prashant, go ahead.
So if, say, for example, just to complete that point about tokens, right? The biggest risk is China, which is, of course, maybe a step behind US. They come out with, with significantly lower models, and the cost drops. It's going to be great for AI productivity and everybody who loves AI, but that may actually be the primary risk to this entire AI super cycle, because the industry right now, Micron is priced a certain way. They're expected to make all these, is because there is, it's an industry built for scarcity. Correct. And if scarcity goes away, suddenly this entire thing will look very, the AI will be real and the productivity gains will be real, but what happens to financial markets and, this entire big boom we are seeing in AI-related stocks, that is another thing. Just one more thing. I heard something very interesting from a consultant who's working in this space. He said, he told me two things actually stood out. One was that there is especially amongst listed companies, and he was not necessarily talking about, India, he was talking about companies in the Middle East where he primarily works, and in the US as well. there is real FOMO. Listed companies want to come out and put out a press release saying, well, this is what we're doing with regards to AI. This is our AI unit. Everybody wants to be seen to be one step ahead, right? And not like have a lackadaisical attitude, or at least not seen to be having a slightly relaxed kind of approach here. So that was interesting. And second, he also said that a lot of layoffs, etc., which are happening in the US, and I think Rima has been talking about this for a while, they are showing up in India. Those jobs, for example, someone pointed out and I checked it out, it's correct. LinkedIn just opened their largest campus in India, in I think Bangalore or Hyderabad, right?
Bangalore, Hyderabad,
Gift
City.
The cost is so significantly. You have to pay $100,000 or whatever in the US, and here you can pay $30,000, $40,000. I mean, so it's a no-brainer in that sense. The old story. I mean, the wage arbitrage. But that is also getting accelerated because of everything which AI is doing right now.
DeepSeek moment. You remember January 2025 when China came out with a much cheaper version of ChatGPT? There was actual consternation amongst the US markets, and the US exceptionalism in tech was questioned.
And to add to that cost bit, right? Because the cost bit right now, the market is appearing to overlook that factor, because all of these companies, all the big tech, the Magnificent Seven, all of them are funding this 180 billion, 200 billion capex through their own cash. And they're generating so much cash every quarter that they don't need to. The only company that perhaps went through the debt route was Oracle. They announced that some $35-40 billion debt financing, and the stock got smashed for a couple of days, and then everybody forgot about it. So
That's the problem, Armas. Things people are forgetting in this euphoria.
No, but that's how it is. People forget. Until the times are good, people forget the concerns.
Precisely.
So as of now, till the time the companies are funding it through cash, and as long as they are getting what they want, they are ready to pay that extra premium, and so do we. We get that. If we have that convenience factor, we are ready to pay that extra buck as well.
This line that it's being funded by cash is thrown quite loosely. There is a significant amount of credit funding that has gone into this AI capex, or not all of it is cash funded.
Even Meta, etc.
And that is a significant risk, again, forgotten by the markets.
Well, when times are good, the market tends to forget. When times are not so good, the market will remember. But, to the point that you were making, Prashant and Rima, about this, ostensibly being a scarcity play as well, which is showing up in the kind of valuations that these companies are enjoying. And many researchers, AI researchers, argue that, look, DeepSeek may not necessarily be an exception, that this model of heavy compute, etc., is probably also in the enlightened self-interest of these companies to play on, to be able to extract the kind of valuations that they are enjoying. So that is something that we're going to have to keep a close watch on as well. Can you actually deliver the same outcomes with less compute, with less costs? And I think that is up for discussion, debate, and evidence. But DeepSeek certainly is one of the companies. But this is not a debate that's over by a long shot. It is going to be a discussion that we will continue to have. But Prashant, the quick final point on India and the markets, in light of everything that we've seen before we close, and of course the Pope getting in on the AI debate as well. We'll end with that. But Prashant, the quick final word.
I just think, Shireen, it is, you don't, as I said, you don't have to make money buying an AI stock, right? But yeah, I think it is. I mean, I'll give you an example, Shireen, right? We are dependent on oil. Oil hurts India because we import big amounts. I mean, 5 million barrels every day, right? 80% of our oil is imported. But so is Korea and Taiwan. But guess what? They're running current account surpluses. And this year, both countries, current account surplus as a percentage of their GDP was projected to be, last year was projected about 5-6%. It's going to be 20% plus. Current account surplus as a percentage of GDP with oil at where it is, right? So this is so there are all kinds of implications of this.
We're out of time. We are going to continue our conversations on the Editor's Playbook. If you enjoyed watching this show, then send us your feedback and your comments. Tell us what you'd like us to talk about on the next one. Till then, from all of us here on the team, goodbye. Thanks very much for watching, and see you soon.
Hello and welcome. UBS is holding its Asian Investment Conference 2026 in Hong Kong. It kicks off today and runs for the next 3 days. Joining us now are Divya Nagarajan, Head of India Research UBS, and Sunil Thirumalai, who's the Executive Director, GEM Equity Strategist at UBS. Divya and Sunil, great to be speaking with the both of you as we kick off. I think 3 days of pretty interesting conversation. And this, of course, this is the first in a series of conversations we'll have with many from your teams. Well, there is so much ground to cover with respect to what is going on in the investment world. But let me just sort of start by getting a FII temperature check, if I can call it that, with respect to Indian markets. I mean, the temperature surely isn't running high, but how far below normal are we right now? Divya, why don't you go first?
I would say about 45 to 50. I think what we are beginning to see is that the earnings season has been pretty good so far. And I think people who have stayed away are now trying to see, can we look at some bottom-up ideas? So we are definitely seeing pockets of interest emerge, especially from an FII perspective. They're looking at value bottom-up stories that can be earnings compounders over a long period of time. So it's still early days, but I would say I would put it at an optimistic 45 to 50 compared to where we've been in the last couple of months.
Sorry, I said the range was 90 to 100. When I heard 45, I had a mini heart attack. I think you meant it in. You're saying it's picking up. That's basically what you're saying. All right. I mean, it's looking the trajectory.
I would have put it lower a couple of months ago, but I think with the strong earnings season coming through, we're definitely seeing more incoming requests from foreign investors.
Yeah. And, guys, we're speaking to you on a morning when Taiwan has overtaken India's market capitalization. So we just looked at the live numbers, 4.95 trillion, and we're at about 4.92 or so. So it's quite incredible, right? But there's one stock there, and TSMC, which is outsized part of the index. I mean, same thing with Korea as well. Actually, both a few weeks ago, both Korea and Taiwan were within 10% of India's market cap range. And Taiwan, of course, has now bridged that. Sunil, so come in there. Is that the main challenge? This entire AI trade and all these large stocks like TSMC, which feed into the big AI boom in the US? And so far, we don't have a foot in the door there, at least in the listed universe.
Yes, so I think just to take a step back and get a broader perspective, for the last 2 to 3 months, we've actually seen meaningful outflows of foreign money from all of EM, all of Asia, not just India. It's, Korea has seen big outflows, Taiwan has seen big outflows as well. But the drivers for those outcomes, in spite of that, we've seen, as you mentioned, Korea and Taiwan have done well, and India has, kind of underperformed. So there are a few, angles to that. AI is a very important aspect, as you mentioned. There does not seem to be any letting of demand from the US hyperscalers in terms of their capex, and hence the demand for the upstream companies in North Asia. And yeah, of course, India is kind of missing out on that. And added to that, is also the oil price spike and then the Iran conflict. While even the two markets in the North Asian markets that we are discussing are also dependent on imported energy. They're not energy surplus economies. They are importers. They've been able to manage it probably a bit better, and for sure for these specific industries, they are being considered as strategically important, and a lot of support being given to those. So yes, I think AI trade is pretty important for this divergence where India has underperformed. We're not sure if that's dying out anytime soon.
Sunil, the reason why there have been large outflows, I mean, actually, out of markets like Korea, Taiwan, etc., is it? I read that for large active EM investors, there is like a 10% limit on a single stock, and because these are essentially, such large trades, TSMCs, it's like the right. So, is that the reason why perhaps there has been some selling out of those? So, occasionally we see these kind of sharp outflow numbers, and then they come right back.
Yeah. So absolutely right. I mean, it's not that I think it's because of the single stock limits. TSMC is beyond 10%, and Samsung is less than 10% for an EM investor, but it's catching up pretty soon. So there would be some funds which are above who would have been overweight Samsung, for instance, and they are being forced to sell. So I mean, I think that is definitely there. So it's not that. So which also means that if there is any correction for some reason in some of those stocks, you could see some buying coming back immediately. So that would also provide some floor to those stocks. So there is this technical factor at play as well.
Sunil, can India have a bull market in the absence of an AI play or the AI ecosystem? What is your own view?
Well, okay. So I think a bull market for India is an absolute return concept. It's not a relative return. So it's possible that EMs do well. India may underperform because of whatever AI trade that's happening elsewhere, but it can still have a positive return year, right? So I think the two are not really mutually exclusive. If you have decent earnings, if you have it is a domestic story for India given the way the index is. So if you have decent earnings growth, if you have you're beginning to see banks pick up on credit growth after a while, they're gaining market share against the bond market. And if they are, able to, manage their margins, and probably see some increase in margins in a rising rate environment, all of that is good, right? You have other themes like defense, renewable energy, etc., that are picking up across the market. So I don't think, and importantly, keep in mind that after COVID, the foreign investor, the impact of the foreign investor in determining the direction of the market has kind of reduced a bit. It's not gone away, but it has reduced a bit. And if the domestic money is supportive and if the earnings start recovering, there's no doubt why India can't have a positive return year. And outperformance versus underperformance versus the rest of EM can be for various other factors.
Okay. Divya, you said that the foreign interest in India is picking up, albeit slowly, but it's still picking up. There are certain themes, bottom-up ideas that they're looking at. Do you want to tell us a little bit what is catching their interest? Are there any sectors or themes?
I think as Sunil spoke, Rima, I think financials is definitely an area we're seeing a lot more interest, both on the banking and non-banking side, surprisingly. And again, it's for the reasons that he mentioned earlier. I think the credit growth is picking up. We were also, I think, just coming out of a few years of cleanup on the NPA side. So the sector is actually in a good place and in a much better place, I would have said, than if this crisis had happened a year ago. It would have been a different story. But now the sector is actually in a much better fundamental space. So I think banking financials is definitely a place that we are seeing interest. But also smaller mid-cap names, which have been, again, out of favor from a foreign perspective for a while, where there are compounding stories, sustainable earning stories, we're definitely seeing interest. There's a lot of questions around what's going to happen around energy security. What is India doing on renewables? Will you fire up thermal? Will you fire up nuclear? So there's definitely a lot of interest around energy security as a theme and renewables as a theme. So definitely in areas of interest there.
Divya, you'll also believe as a house that the AI theme has still a lot more legs to go. How long do you think this can run? Can it run for another 1 year? We're talking about 3 years, because that in a way determines India's relative performance. What is your own view, or the emerging market view at UBS? Divya?
Yeah, so let me sure, let me take that. So I think the way we would look at it is that the timeline or looking at when this trade ends essentially depends on when the revenue monetization hope for the US hyperscalers disappears, right? I think there is some level of monetization that's happening today. Not a whole lot, but it is picking up. Every new model release that comes out and disrupts a particular industry, like we've seen the legal industry being disrupted, consulting industry, and so on. Every new model release that comes out is basically a motivation for those model developers and the infrastructure providers behind them that there is revenue to be made. As long as that hope is there, I think money will continue to flow into those markets. Now, at the end of the day, keep in mind that the entire AI value chain from the hyperscalers to the providers at the semiconductor providers on the upstream, they're actually making, as a group, a lot of free cash flow. So they're not burning money in the traditional sense. They're not. It's very different from the .com period when the cable make companies were investing a lot of money, getting into a lot of debt, and so on. That's not the situation. So that basically means that this could have some room to go. The opposite scenario, which would be relatively positive from the Indian market's perspective, would be if the very quickly these companies realize that the revenue upside is just not there. People are not willing to pay, and the token budgets are getting exhausted, but the token costs are not coming down. The unit costs are not coming down, just like technology costs normally fall. And hence, there is a big challenge in revenue monetization. I think that's what I would watch out for. Right now, it seems like they are making, decent FCF as an ecosystem. And, that should give them some room to continue with this.
Well, interesting point there. Hold that thought. We're going to take a quick commercial break here, come right back and continue this discussion. Welcome back. We're in conversation with Divya Nagarajan and Sunil Thirumalai of UBS. The UBS Asian Investment Conference kicked off in Hong Kong today, and we're talking to them about all things investing. particularly with regards to where India finds its place in this big AI boom, which is underway globally. AI boom in India is not a prerequisite for markets to do well. But let me flip that. Is a AI sell-off elsewhere a prerequisite for foreigners to come back in a large way to India?
So to a large extent, global equities are kind of geared up and leveraged to this AI trade. So if you're talking about a serious unwind, that would be bad for equities globally, right? So you could see a relative outperformance of India, but I'm not sure we can be very confident of India having big upside.
It's not my case that we see a global sell-off in India is up, but generally, relatively, we'll stop talking about this for a bit. We'll start talking about, the good old, all the sectors that are top sectors here. That's what I meant.
But I would just add at the starting of of this question you mentioned about the AI trade not being there in India. India can still benefit if AI diffusion and adoption happens 100%. At an economy level. It's a very solid 5-year story. And hence those things will start showing up in our market in other sectors over time. But I just want to point that out.
Yeah, no, 100%. Divya, so run us through, so banks is one, right? You said that energy securities comes up, and I think you've got positive views on names like ONGC and some of the others there. So just talk to us about where to which are pockets you'd pick out and sort of look deeper, study more for ideas.
So I think there are two parts of this conversation, right? The here and now versus what happens if the conflict drags on. So let's leave the conflict dragging on situation aside for now. So I think banks we've talked about, energy security we've talked about. Actually, if you look at the consumption stories, I think consumption's also been picking up. I think if you look at the consumer sector, especially the big staples names have actually done pretty well compared to our expectations. So that's another bright spot right now, assuming that story doesn't get derailed. But I would argue that if inflation comes back, then some of these big, large consumer names could be a little bit more resilient. We also like the short cycle industrials because there's been inventory replenishment, and I think we're seeing that inventory ordering pick up. And that's, I think, a place that we like as well. Long cycle capex could get pushed out more because we have uncertainty going on, but I think the short cycle industrial capex is where we expect to see continued positivity. The last place I would also say is defense. I think we are in an increasingly uncertain multipolar world, so I think that continues to be a secular area of spend for governments across the world, and the Indian government, I think, is no different there.
And Divya, on IT, not in the near term. In the near term, the market narrative is very simply put that Indian IT is an AI loser. But we've seen the Indian IT industry navigate through various technological changes. And if, as Sunil said, that AI diffusion takes place, and AI adoption picks up, maybe the Indian IT companies do have a role to play. Which side would you bet on, Indian IT over the medium term, valuations aside, just purely on the basis of a business case, on the kind of growth numbers that we have on account of AI 3 to 5 years down the line? Would you be bullish or bearish on IT?
That's essentially taking a call on whether generative AI succeeds on its promise or not and how it plays out. But I think taking a balanced view here, I would say that the companies are much more faster this time around in preparing themselves and disrupting themselves. So you have many large companies have already started reporting AI revenues. So you can see how they're investing in it, how those revenues have started to grow. We're seeing very healthy double-digit QOQ growth in what these companies report as AI revenue. That being said, there will be some disruption on the existing base, which I think will have some impact over the near term. But overall, I think the companies are definitely preparing themselves to see how they can stave off being disrupted to the extent that they can. The caveat here is the technology itself, because the technology, as I said to you when I was there last, is still very young. And as the technology evolves, I think its capabilities seem to be evolving by leaps and bounds. And that, I think, adds a little bit of uncertainty to the level of preparedness that the industry can have on this. So net-net, I would say we are slightly cautious and we like the smaller names because I think they're a little bit more nimble and agile compared to the large caps.
Sunil, say the same. I mean, I just want feedback from foreigners on IT. What do you hear? IT services in India.
I think that's a uniformly negative view right now from a foreign investor perspective. Sorry, Sunil, go ahead.
Yeah, I would agree. It's generally negative, and I think there's also a lot of people are looking forward to just the IT companies themselves messaging and clarifying what their strategy is better. And I think that would really help if over the next, let's say, 1 or 2 quarters, their own strategies are more clearer and put out there. But yeah, I mean, I think there is a lot of skepticism.
Divya, at a slightly high level, I mean, if you pull back a little bit, right, with if AI really is going to change the world, I mean, we thought technology will change the world, now AI will change the world. AI technology did change the world. So if, there's generally, we don't know, right? I mean, it's a debate. Will it create more well-paying jobs? Will it sort of, create, what will it do to effective demand, right? Demand at a certain price point in countries like India. Is that a question which comes up at all? I mean, it's a question which everyone is there somewhere, but no one is really sure how to answer it or how to frame it. Divya, if you can take that.
So let's look at the bull case, right? The bull case is that the IT outsourcing exports. It's not just the Indian companies anymore. We have these big global GCCs that also export IT services from India. If that story remains intact, we don't have to worry about consumption. The sector adjusts. There's a short-term blip, and then we move on. And then the India story, the consumption story, everything continues. If you go to the other end, the scenario there is that if it disrupts jobs, and the white-collar jobs in India are largely concentrated around some of these sectors, then what happens to the ripple effect on the overall economy? Then you could have second-order, third-order impact. So I would say these are the two ends of the outcome. We would hope that we end up towards the positive end of the spectrum, where the industry and the export services adjust, and therefore we find some way. Sunil, I think, please feel free to jump in. But we've also seen how India's leapfrogged technological advances and moved. Like, for instance, I never had a landline because we moved around a lot, and then we went straight into mobile phones and mobile payments and everything else. Could we have something like that benefit India? Could AI actually end up being a benefit for India, where we leapfrog certain parts of our evolution?
Yeah.
I think that's an interesting question as well.
No, I think that's, Sunil, if you want to come in. I was talking to someone in a top consulting firm who consults in the digital AI kind of adoption thing. His perspective was there's a lot of FOMO right now as well, especially if you're listed. What is your AI strategy? What are you doing? So maybe that, but it's real, but there's also some level of FOMO. But yeah, Sunil, jump in if you want to.
I mean, if I may quickly add, I don't think we have the kind of confidence or visibility that we'll get into a situation where large corporations suddenly come around and say, I'm firing 90% of my staff. No, I don't think that's so that economic disaster where there are no jobs and companies are just focusing on cutting down staff. I mean, that's a very, very far away, low probability event where we stand right now. What is more likely is that companies use the available AI tools and the upcoming AI tools to become slightly more productive. Cost of delivery of products or services to their customers comes down, and hence their addressable markets go up. That's how I'm thinking about it, at the moment, because that's what is visible right now. That's what we are seeing, within the companies that we study or within our own organization. But I don't think we should, start factoring in situations where, 90% of white collar staff in India will get fired and, it'll all be done by AI. No, I don't think that level of confidence we have on the technology right now today.
Divya, you just briefly spoke about consumption. I wanted to understand about how you approach gold as an asset class, and also in terms of theme. Some of the jewelry stocks, they pulled back because of those duties that were imposed. But otherwise, the gold appeal seems to be quite strong. So your take.
Well, I don't claim to be an expert on gold. I think India has always been a gold-hungry country. But I think the gold is also, as long as there is uncertainty around what the Fed is going to do, I think the gold prices will remain volatile. That's our house view. I think Bhanu Bhaveja, our strategist, when he was here, and I will quote him, he said gold could have, we've seen a lot of volatility and a spike up in the last few months on gold on all these concerns. But we do think there's some upside left, but in the short term, I think the uncertainty around interest rate hikes in the US will keep gold volatile as well.
So, Divya, my question was on the jewelry stocks. Do you believe that they fall well into this consumption basket? Some of them are not very, very cheap. The largest player in there, which is Titan. And the other ones, at some point of time, they're given a bit of a heartache. So, your view on the stocks?
So I think it's, as you correctly said, very stock specific. There are some that are well-managed companies and have navigated gold prices very well. And there are others who are still kind of finding their feet in terms of managing those idiosyncrasies. So I think it's going to be very company specific there.
Sunil, if the war comes to an end tomorrow, do you think the Indian markets rally hard? Will foreign investors, because energy security is one of India's vulnerable points. So if the war comes to an end, what kind of upside do you see immediately in the markets?
There will be an upside, yes, of course. But I would go back and see how much has the market actually fallen since February 26th. When we had no clue that this war is going to happen, right? So I'm not sure if anything beyond a 4-5% kind of a upside, based on this. Then you come back to fundamentals. Then you come back to relative earnings growth. India versus other markets, and within India with sectors and so on. So it is definitely a good sentiment positive, but I don't think. Just like tariffs last year, which was a big headline news, but the markets largely shrugged it off. I think that's been, what we've seen in the markets across global markets when it comes to oil price impact as well. So yeah, that will be a positive, movement, of course, but I don't think it'll be a whole lot.
Divya and Sunil, when are we seeing the first AI agent sectoral researcher? At one of the sell-side firms? Will it be in UBS? At UBS, I'm sure there is one already somewhere. Divya?
Well, I think the way I would think about it, not to alarm any of our population or sell-side brethren, I think it is definitely a good helper. I think it can definitely help us kind of get to the market faster. And I think we do at UBS have a lot of programs that help analysts kind of publish faster, respond to market reactions faster. And we also have AI avatars. So the next time, hopefully, my avatar is speaking to you and not me. But that being said, I think for regulatory and for whatever logical reasons, I think I would like to hope that human brains don't get replaced. And therefore, our analyst community and our sell-side brethren, I think, can rest in peace that there is the human value and the logic that we bring that still continues to be accelerated by AI rather than replaced by AI.
When I heard that rest in peace, no, but point taken. I hope we're all here, a year from now when you sort of join us for the next leg of the conference next year. Thank you very much. Great start, and wish you all the best of luck at the UBS Asia Investor Conference. Thank you for joining us.
Thank you.
We have with us a very special guest, the chairman of the Vedanta Group, Mr. Anil Agarwal himself. Mr. Agarwal, a busy day. Glad you could take out time to join us on CNBC TV 18. Let me first talk about the one issue that's been on all of our minds, demerger. This was a big issue on the agenda. You seem to have finally crossed that threshold. Tell us one question that we're all asking. What's next?
Thank you very much for inviting me. CNBC is my favorite channel.
Glad to hear that, sir.
Board. Very nice. We have grown in our natural resources. Since I left Bihar till now, I only looked at below the ground. So we have developed very beautiful business, and it was very important to each business is so good, so that can be by itself, Vedanta by itself. So we have demerger has already happened. I'm thankful to all the regulator or whoever was there and the court and everybody. So we have 4 big company. One is the Aluminium Vedanta Aluminium.
Sure.
Which is a phenomenal company. This will be world largest company in the private sector. We started with the 1 lakh ton of aluminium production from Bharat Aluminium. Now we are producing 30 lakh ton and going to produce in 3 years' time 60 lakh ton. The lowest cost of producer. That story doesn't end there. We will create 1,000 industry downstream. We are creating an industrial park because aluminium users are tremendous. So all the downstream 1,000 industry will be developed, so people will come and set up the industry and we'll support them in every respect. Then we have oil and gas. Oil and gas, my heart and soul is there. India has tremendous reserve and of oil and gas, hydrocarbon, and we were the only people in India producing oil in private sector. It was not an easy job. We are looking for producing 500,000 barrel to spend $5 billion in 3 years' time, 3 to 5 years' time, to produce 500,000 barrel at the lowest cost. We will have producing sweet crude. We have a complete pipeline. We have every kind of opportunity. We have a tight oil. I have a shale gas. I have a shallow water. I have a deep water. I have a big block in the Assam northeast where the first oil was produced. We are in the process. We are looking for government to give us a lease, long lease. So we are comfortable because then we can make a big investment.
Okay.
So aluminium, oil and gas, power is very important. At the moment, our power company produce about 4,000 megawatt, going to produce 20,000 megawatt. For that, all brownfield. All brownfield. We are looking forward. One of the best company. We have all coal linkage. Coal is not going anywhere, and we should be very proud of our coal. Coal, we have coal. What India has is sulfur-free, and I have always been advocating that coal is not going anywhere. We are a poor country. We are going to make sure environmentally we 100% take care of that. But we will make a power company about 20,000 megawatt power plant. That's what we are looking at. We have a iron and steel company, which is a phenomenal company. It is around Tata Steel, Bokaro Steel. It has infrastructure. We have a gas pipeline to produce 15 million ton of steel. At the moment, we are producing 3 million ton. We have another million ton in Goa, so 4 million ton we are producing. And we are going to produce 15 million ton, all green steel, electrical steel, or special steel. So we are the largest producer of iron ore, we will 100% backup of coke and the iron ore. So looking forward, this steel company still has a great demand in India. And then we have Vedanta Limited, which will have Africa largest zinc company. Very, very, very proud of having a zinc company. We have a 65% of Hindustan zinc. We have a FACOR, which make, we also, critical materials. So this is a Vedanta Limited, again, very flagship company. So these are the company demerger. All the share will be in the process of issuing. By next month, all these 4 companies will trade by themselves. It will have a very strong management. And this will be company which is what we require, natural resources in India. And we will proceed in that direction.
I don't want to come in there in the middle, but that's an important clarification that you're giving. Can we take it as a confirmation that perhaps by next month we'll see these individual demerged entities also being listed?
Absolutely. By next month, all the individual entities will be listed.
That's fantastic. You've given us a very comprehensive roadmap about how each of these companies in their individual spaces can grow up to be bellwethers. You talked about subject to support from the government, you're looking to make big investments. So tell us, can you give us some glide path, some indication as to what is the kind of capex that you're looking at, say, over the next 3 to 5 years?
They're looking to spend about $20 billion. And we have a very good internal profit generation in the company. Internal accruals are very, very good. Some equity, some debt we might have to take, but $20 billion investment will be there, and probably we will increase our production by 2.5 times of everything.
But you're saying mostly through internal accruals? Any numbers that your team has run by you?
No, we will be having about $10 billion EBITDA.
Okay.
$10 billion EBITDA. So I don't know that financial detail, but I was not ready. But $20 billion we spend. Fund will never come on the way. Government is with us, and this all will be India. And by this, I'm looking forward at least 5,000 downstream industry to come in with our product. For me, most important, which gives me joy, to develop the downstream industry.
You've talked about previously, we've heard you speaking when you say that Make in India push has been very good. It's yielded results when it comes to smartphones, electronics, even the defense sector, it's done very well in terms of indigenization. But that you classify as above ground Make in India. The question that you asked previously is, what about below ground Make in India? Again, tell us, is there a need for perhaps a Make in India push even for below ground resources that you manage?
What we're talking at is self-certification, what government... I'm very thankful to Prime Minister Modi, Amit Shah ji. They always think how the business can be developed, the employment can be developed. And what we are looking at, simple policy, trust-based policy. Trust-based and court. Court also has to... What Indian courts are there is worldwide, people are very proud of. It's very important. The time is the essence because India can't wait now. Time is the essence. All economic, whether it's a court, whether it's a regulator, more and more trust-based it be given. Entrepreneurs should be given a recognition. Manufacturing people must be given a recognition. You know, because they are pay the highest tax. You will not believe every year I'm paying 60,000 crore tax. When I set up all this industry, I raised $35 billion abroad and brought the money here and invested all the money in all these companies. So these are the, and it's not me. Every individual is like me because we have the DNA of entrepreneurship.
Right.
We have a DNA of the women working very differently. So these things were being encouraged nowadays. Tremendous opportunity. We will, as far as Vedanta is concerned, we are very clear how we demerged identity will work. Very strong management. For me, it's a very inclusive.
Sure.
Because for me, last person working in my company, I cannot ignore him. He's also very, very important for me. And I'm very proud of my people and my team. We are ordinary people. Vedanta means what? Ordinary. But we deliver extraordinary result.
Well, you are anything but ordinary, Mr. Agarwal. But let me follow that up with another question that's close to your heart, what's on import substitution. I came across some very interesting numbers. We have an import bill of roughly around $800 billion. Half of that are below ground resources which we end up importing. So whether that's oil, gold, bauxite, for example. So we're talking about nearly $400 billion every year. What is the missing from our picture? Take oil, for example. We've not been able to build up capacity here within the country. What is the rationale? What's required from the private sector, from the government?
We have to be very, very careful of the world. World does not want us to produce. They want India to be a market. Middle East, all world they develop 2 hours away to supply into India. The Gold Council, they just want to supply to the gold, whether it's a copper. We have a tremendous bauxite. I just read in the newspaper, you know, the largest company has gone to Guinea to produce alumina. Why? India has the largest deposit and the best bauxite because we have to simplify our policy. Land is required, everything to be digital. Seller is ready, buyers are ready. We have to address I'm just thinking big way, is our system.
Okay.
System. Our bureaucrat officers are very qualified. They are most intelligent people, but they have to let go. They have to rethink inclusive. How do we recognize is very, very important. Your government companies, what is it called? All the government companies? Public sector. Public sector, very important. Government has to take a decision. Everything has to be privatized.
Okay.
Everything has to be privatized. No one person will be retrenched. I can see 5 times more production can come up. It is very important that we take decision. In fact, I'm for gold company, nothing producing, copper company. I'm ready to take challenge on anything. Let the parliament decide and trust. And I will do everything for my country. So, and the court. Courts are, judiciaries are very important. Time is the essence. We have no other in the world, the judiciary, what we have, nobody has. But for the, to take country forward, to create job, to develop the economy, is very important. The decision, we don't waste time, we move forward. Where else we'll find Prime Minister like Modi, Amit Shah, these people, what they have done in West Bengal. West Bengal was the hub for the industry. Hub for the industry, what they don't have. It is all, everything, Bihar, this, you talk about Assam, these things, what they are addressing now, will develop.
You spoke of reforms. I want to get in your reaction on one particular aspect. You've previously spoken of how this 50-year lease that we currently have is not quite working. We need a lifeline. As long as the life of the mine is, that should be the duration of the lease itself. Are you calling for a complete overhaul of the current mechanism that we have for auctioning, for allocation of mines, of resources, of natural resources?
Beautiful question. You know, government has all the powers. Give a long rope. What is this short leave, 50 years taking back? People will run away. Nowhere like this is in the world. You are unnecessarily hanging the short. Tata Steel, we will, huge plants are there. And then you make a policy that you will take back the mine and you re-auction. Does it work? We have to come out with a long lease, whether it's oil, and there should be one policy below the ground. For the oil, you have a different policy, and for mineral, you have a different policy. Below the ground, simple policy. For us, only one objective. How do we stop import and start producing? And this can only produce by the private sector. It's very important. And public sector must be privatized.
Okay.
And the court must be very conscious that time is the essence, whatever it comes to, whether any NCLT or this, they're doing a fantastic job, but time is the essence.
Okay. Okay. You've mentioned privatization twice, so I'll just labor on that point. You talk about completely privatizing as far as all the PSUs are concerned. Will you be...
There can be exception. I'm saying generally. Because no democratic country government doesn't run the business.
So if the government were to take up on your suggestion, which is greater divestment, greater public sector assets put on the market, would you be in the market in line for perhaps some of these government assets?
My shop is open. I'm not going to go to hunt. But something comes to my shop. Any customer comes, any opportunity comes, for my shareholder, I will look at.
Fair enough. Just a couple more questions, Mr. Agarwal. One question is that you've talked a great deal about privatization. You've talked a great deal about regulatory reforms. One low-hanging fruit, to your mind, that you will recommend to the government can be put into action as early as tomorrow. What would that recommendation be?
Anything which we are importing.
Okay.
Anything which we are importing, and there is a black and white, there is nothing left. What entrepreneur can do, you know, we have proven from, one example is Bharat Aluminium. One example is Hindustan Zinc. They are the only two companies I have taken. Anything, and if you see the privatization of the airport has happened, privatization of anything, then you have trust. I really salute all my industry. They were from where to where, whether it was a telecom, whether it's airport, airline, any steel production, anything you entrusted to the or corporation, whoever trusted, they have delivered.
Sure. That brings me to my one final question. I'll end you by asking, we're living in tumultuous times. There's geopolitical sensitivities. There are factors, some beyond our control, some in our control. With all of these multiple moving parts, one commodity that you're bullish on for perhaps the next decade or so?
I'm very bullish on aluminium, copper, oil and gas. All three critical metal, very, very important. And fourth is, we can be the largest producer of arm and ammunition. The kind of factory we have, massive, if they can be modernized and privatized, we will be the largest producer of today's digital technology given. But we have to be, Parliament has to be together. Everybody has to be together, one way, one goal, to make sure that we will produce arm and ammunition here. And we run our, whatever strength we have, we leverage that 100%.
Fair enough, Mr. Agarwal. We'd like to thank you for joining us, for sharing time with CNBC TV 18. You've given a lot of insight as to the recommendations for the government, but clearly close to your heart, import substitution, and of course, perhaps some form of regulatory changes as well. Mr. Agarwal, we'd like to thank you for joining us and sharing time with our viewers right here on CNBC TV 18.
Thank you very much.
T-cycle.
Iswara. Supporters protest outside his house demanding that the Congress make him the next head of state. ED files FIR after violent mob attack outside Pinarayi Vijayan's residence during these raids. Probe agency says that attack on probe team was planned and not spontaneous. After Madhya Pradesh High Court quashes anticipatory bail of Tushar's mother-in-law, CBI reaches Giribala Singh's residence, custody likely today. Vijay Sharma's father speaks to CNN News 18, says he has full faith in the CBI probe to find out the truth of what happened to his daughter. A day after meeting Prime Minister Modi, Home Minister Shah and Finance Minister, Tamil Nadu Chief Minister Vijay leaves national capital, won't meet anyone from the Congress party. Next date of meeting with Sonia Gandhi likely next week. No end to TMC implosion. Now veteran Rajya Sabha MP Sukhendu Shekhar Roy launches an attack on the party's functioning, saying that he believes the TMC will disintegrate because leadership has failed to accept defeat. NIA filed charge sheet in the 2025 Pahalgam terror attack. Explosive details reveal accused Bashir allegedly harbored terrorists before the attack. TRF handler Sajid Jatt was the one giving instructions to 3 armed terrorists. And tensions between US and Iran have sharply escalated. Both sides accuse each other of fresh attacks. Iran says recent US-Israeli strikes have targeted military sites and violated the already fragile ceasefire. Well, let's get you started with some breaking information that's now trickling in. Siddaramaiah is the outgoing Chief Minister of Karnataka. He's making way for DK Shiv Kumar, and he was the one who proposed DK Shiv Kumar's name in that breakfast meeting that he held with his entire cabinet this morning. He was the one who proposed DK Shiv Kumar's name as the one who is going to be succeeding him. Let's listen into what transpired in that interaction between the two leaders over breakfast this morning. We'll try and get you the audio of that conversation that took place between the two leaders there. The Chief Minister at the moment, Mr. Siddaramaiah, he is going to be resigning in about an hour and a half's time from now. And the one who is going to succeed him at the moment, his deputy Shiv Kumar, is going to be the next Chief Minister of the state. Afreen, my colleague, now joins us. Afreen, at 2:30 p.m. is what we're learning is when Siddaramaiah would be going to the Lok Bhavan to submit his resignation. But a lot of bonhomie was witnessed during that breakfast meeting this morning. There were all smiles. There were blessings that were given by Mr. Siddaramaiah to DK Shiv Kumar as his successor. In fact, he was the one who proposed his name.
Well, absolutely. We saw that the images, the visuals, the videos that have come in from the Chief Minister's residence during that breakfast meeting. We saw both the Chief Minister and DK Shiv Kumar in such a cordial manner. We saw as soon as DK Shiv Kumar went there to the Chief Minister's residence for the breakfast meeting, he touched his feet, he touched Siddaramaiah's feet, he hugged him, and we also saw a visual where both of them are shaking their hands like Siddaramaiah is congratulating DK Shiv Kumar, and it makes it all true, all real. The speculation that has been going on for months and months that DK Shiv Kumar will step up and take the Chief Minister's post, it is finally happening. And Chief Minister Siddaramaiah, we're learning, will go to the Lok Bhavan at 2:30 and he'll tender his resignation there. He'll give it to the Secretary of the Governor, since the Governor is not in Bengaluru. And at 3 p.m. he's going to address the media. He's going to talk to the people of the state about all the speculation that has been rife all these months. Finally, all of that comes to an end with that press meeting at 3 o'clock where he'll address the media and the people of the state about his decision of resigning and making way for DK Shiv Kumar to be the next Chief Minister of Karnataka.
Well, we continue our rolling coverage here from outside the Chief Minister's residence. In fact, in just a while, in roughly around 1.5 hours, we will see Chief Minister stepping out of his residence for the last time as Chief Minister, heading to Raj Bhavan and handing over his resignation to the Secretary of the Governor. And 3 o'clock, he'll be back here. He will address a press conference at his home office where perhaps he'll be flanked by his cabinet colleagues, including DK Shiv Kumar, is what we are learning. But it was an emotional moment for several of those cabinet ministers who were present at that particular meeting inside the residence. In fact, we'll also look at what happened after that meeting. In fact, several ministers, as I said, were emotional. Santosh Lad, another minister who's very close to the Chief Minister, was in tears while stepping out of the Chief Minister's residence. That has been caught on camera. Santosh Lad, remember, has got extensive backing from Chief Minister Siddaramaiah, and he was the Labour Minister. Several reforms that he had pressed for and cleared by Chief Minister Siddaramaiah during his tenure. He was very emotional. So were several other cabinet ministers, many of them first-timers, many of them who served earlier during the first term of Siddaramaiah as the Chief Minister.
Your first thoughts then after that?
Okay, Afreen continues to be with us. Afreen, it's an emotional moment for several of these cabinet ministers. As I mentioned, some of them are first-timers, some of them, this is the second time they've been working with Siddaramaiah. They've served in his cabinet between 2013 and 18 as well. So clearly, many of them seeing this as an end of an era. All right, we'll get back Afreen Hussain on the live broadcast, but that was the sentiment that was there in the house, in the residence of Chief Minister Siddaramaiah when that breakfast meeting took over. In fact, the details coming in suggest that it was Siddaramaiah who told his cabinet colleagues that the Congress High Command had asked him to step aside, and they decided to go ahead with DK Kumar as the next Chief Minister. He told them that he will follow the diktat of the High Command. He's resigning. He will extend all possible cooperation support to the next person who gets picked as the Chief Minister, and he ended that breakfast meeting. Much before that meeting started, there was a small interaction that DK Shivakumar and Chief Minister Siddaramaiah had before they got into the press conference, into the conference room where other ministers were present. We've put out that video as well, where Siddaramaiah is seen congratulating DK Shivakumar and having a conversation with him. Afreen Hussain continues to be with us. Afreen, emotional moment for several of these cabinet ministers who believe that it's end of an era with Siddaramaiah stepping away, and although he'll be active in politics, but not active in electoral politics.
Well, absolutely, Harish. Remember, Siddaramaiah is a tall leader. He is a mass leader. He's had extreme following amongst not only the people, but also his cabinet colleagues and the MLAs. He has had the support, and he is popular amongst most of the MLAs. And this is indeed a heart, an emotional moment for all those who are loyalists to Chief Minister Siddaramaiah. And it is indeed an end of an era. Such a tall leader, such a tall OBC Chief Minister that Congress has had in Karnataka. It is an end of an era, and it is such a smooth transition that is going to happen. There were, speculation that he's going to have a long list of demands that he's going to put in front of the High Command. He's going to ask for his son to be made the Deputy Chief Minister, and more such in the list. However, we are seeing that a smooth transition is taking place. The Chief Minister will be going to the Governor's office at 2:30. It has been confirmed, and he'll tender his resignation. He'll hand it over to the Secretary since the Governor is not in the city. And we saw the visuals, the images, they speak for themselves, Harish. No need for us to describe it, but let me tell the viewers that it was indeed an emotional scene, seeing DK Shivakumar bow down and touch Siddaramaiah's feet when he went to the Chief Minister's residence for the breakfast meeting. He also hugged him. You can see the bonhomie between them. It is emotional scenes were witnessed at the Chief Minister's residence, is what we're being told. Several of his cabinet colleagues were also teary-eyed, is what we're getting to know, considering that Siddaramaiah will not be involved in active electoral politics. He will be in the state politics, however, not in the active electoral politics. And several of the MLAs and ministers have told CNN News 18 also it is impossible for them to go ahead and conduct the 2028, fight the 2028 assembly polls in Karnataka without Siddaramaiah's support. He has such a large fan base in not only the northern part of Karnataka, in all over pan Karnataka. He's had a following. The Ahinda umbrella that he carries with him. The followers from there, he has had such massive following and popularity amongst all sects and all people across Karnataka. So it is indeed the end of an era for Karnataka's Chief Minister Siddaramaiah, Harish.
Absolutely. Stay with us, Afreen. Just a while ago, I spoke to Karnataka Health Minister Dinesh Gundurao. Remember, he served under Siddaramaiah twice in the first term between 2013 and 18. Now as well, he's been the health minister for the last 3 years. He says everybody there was emotional. He himself was controlling his tears, and he said it's an end of an era, but they do hope that Siddaramaiah continues as an active politician and will serve the Congress party. Let's listen in.
Breakfast meeting is over. The Chief Minister will head to Raj Bhavan in a short while. Your first thoughts, sir, after that entire interaction?
CM today with his council of ministers, I think, I mean, the way he handled it and the way he spoke, I think it just shows what a great personality he is. You know, being in power for CM for now 8 years, he's seen and been an opposition leader. And the way he spoke to us, it was like very touching, I think, and very frank and, you know, very moving. And he was also, you know, very clear about, you know, his thoughts. And we see many a time that in such situations, how political leaders can play truant. But, you know, his was so clear. And he thanked everybody. And he said he'll remain an MLA for 2 more years. And he will work with the party. And you know, he will continue to, you know, the bigger battle is to see that, you know, this this kind of hegemonic kind of approach that BJP has got. We need to stop that, and we need to win the next election, and we'll all work together. So he was very, very clear about it. And he also said that High Command has said that next DKS should become the Chief Minister, and let's all work together. So, you know, I think it was a very, I think, you know, we have such great regard for Chief Minister Siddaramaiah ji. But today, I think, you know, we went up another level altogether. Because, you know, he's a mass leader, a popular leader, everything, you know, and he's a charismatic leader. But the way he handled himself today, I think just shows what a great human being he is and what a great person he is. There was no animosity, no, you know, feeling of ill will, no feeling of hurt. It was something which it moved everybody, I think. It just moved each and every person who was sitting in the room.
So you've served under him twice, in the first term between 13 and 59 in this current term. There's so much chatter on whether, you know, he wants to go to the Rajya Sabha or whether he prefers to be here in Karnataka. This is something he's spoken multiple times on, him wanting to be in Karnataka. How do you view that, sir? I think that's something that...
I don't want to speculate. See, those are his personal decisions. I don't want to get into that. But I would only say that the way he handled himself, I think, has just elevated him in the eyes of the people. He is shows that he is the leader who's cut above, I think, most of the political great leaders that we see here in Karnataka today. He is above all of them. And cutting across party lines, I think there's nobody who is like Siddaramaiah in Karnataka today. And I think he's proved it again today by the way he's handled it. And he's shown that he's also a disciplined person. The party, he's always said that whatever High Command tells me, I will do. And when High Command asked him, he just followed the, you know, follow whatever they said. And, you know, sometimes people expect that, you know, he might do something, he might create some problems, some trouble, there, but there was no even a small inkling of that. And I think it just shows his commitment to the ideology, to the party, to the cause. For social justice, for working for the poor. Even today also he reiterated all that. We need to work for them. We need to work for the poor people. We need to see that whatever the Congress ideology is there, in that same vein the government should function. And it was something that I think was just incredible. Just being there, it is an experience I think which one will never forget in our lives. Being in that room and listening to him speak, I think it will always be there in our memories.
True. My final question to you, sir. Emotional moment for a lot of you, his cabinet colleagues. We saw, in fact, some of your cabinet colleagues also almost in tears.
Yeah, everybody was moved, I think, in the hall when we were sitting, and even I was personally like almost felt the tears coming out. But yes, of course, I controlled it. But it was moving because we worked with him for so long, and I worked with him as a MLA, then as a minister, as a working president, as a president of the party.
Yes.
We worked together, and so many. And he was such a open-minded person. Like I would say, as a minister, he never. I think every minister shared the same experience. That he never interfered with the ministers. He used to suggest certain things to be done and tell certain times, to do certain things. But if he went and argued with him and told him, sir, this is not correct, we need to do it like this, he never forced anything to be done on any issue. At least I have seen as a organization person and as a ministerial colleague with him, working under him, that never once has he, when I felt strongly about a certain thing, he never overruled me. You would have had a different opinion, then you would have said, okay, fine, you go ahead and do, And that is a shared experience every minister. I don't think a chief minister who gives so much freedom to his ministers and who gives them, the space to do what they want, I think is very rare. And that is what I think was a common thought that every minister had in today's meeting.
Absolutely. Thank you, sir. Thanks a lot for speaking to us.
Thank you.
You wanted to say something?
All right, that was Karnataka Health Minister Dinesh Gundurao speaking about what transpired at that meeting inside the Chief Minister's residence. In fact, now indication that in a short while from now, the Chief Minister will be heading to the Raj Bhavan. But important point that Dinesh Gundurao made, and I'll take it to my colleague Pallavi as well. Pallavi, Dinesh Gundurao spoke about how the Chief Minister perhaps is not keen on moving to Rajya Sabha. But he said, I do hope that Siddaramaiah will be active and will ensure that he will campaign for the party. He will, in fact, propagate the Congress's ideology. That's something even Siddaramaiah mentioned in this meeting. And he also said, I hope he'll be active nationally as well. Perhaps that will be the next big point that the Congress will look at. How Siddaramaiah will involve in Congress's activities, whether he'll take up Rajya Sabha seat or not, that's a different matter. But how he will remain active and also relevant in 2028 and 2029.
Well, I'm coming to you from Bengaluru itself. In fact, this is right where Siddaramaiah's residence also is, and that's been the hub of action. The fact that the Congress party has not been able to take this decision for a good 3 years just goes on to show the kind of apprehension within the Congress as far as the Siddaramaiah factor is concerned. He's no pushover politician. He's very shrewd. He's astute. Until now, a large number of MLAs have always been by his side. I still remember that when we were in Delhi, and that time there was this whole discussion going on that who's going to become the chief minister. DK Shivkumar was closeted inside his, inside Karnataka Bhavan, and that is when we had gone to meet him. And he also had his fair share of supporters who were insisting that as a KPCC president, and also the fact that he had been given a commitment that he would be made a chief minister, why should he miss out? But there were hard realities on the ground which made the central leadership opt for Siddaramaiah as the chief minister. First, the community he comes to. The second, of course, is that the kind of grassroots politician that he has been. That's precisely the reason why it was often difficult for the central Congress leadership to bite the bullet. When Rahul Gandhi, this avatar of now trying to bite the bullet, taking a decision, but more than that, the Gandhi family realizing that this was the best time to go and fulfillment of their commitment. Unlike in Punjab, where they had made the mistake, where just 3 to 4 months before elections, they had a change of guard. This time round, they realized that if the decision or the change has to be made, it will have to be made now. But also Siddaramaiah is not someone who can be overlooked. What is it that they can offer him? And more importantly, what is it that he's going to be ready to accept? Obviously, he would want to have a grip over the new government which is going to be formed. He would want his people to be accommodated in meaty portfolios in the cabinet as well, and of course for his son as well. So that is also going to be a huge challenge for the central leadership as to how much can they ignore Siddaramaiah's pressure.
Absolutely. Stay with us, Pallavi. My colleague Shireen Elizabeth, in fact, has spoken to Ashok Patan, the chief whip in the assembly. Remember, he is a close confidant and a loyalist of Siddaramaiah, and he said that the chief minister would be submitting his resignation later in the day.
After 2:30, 3 o'clock, press conference will be there in the Krishna office of the CM.
Okay.
4 o'clock, he is going to Delhi.
Okay, sir, will he be taking Rajya Sabha seat or will he continue to be actively involved in Karnataka politics?
No, it is a personal view, madam. I think as for my knowledge, he will not accept mostly. Because it is his personal view. No, I cannot express what he has told to High Command. He is going to meet Rahul Gandhi to tell thanks for cooperating the up to 8 years.
Sir, it was a long stint of Chief Minister Siddaramaiah. What is the message that you want to give to the viewers? How, his governance have been something that has been upfront and very, very absolutely perfectly that he run the government. So is there some message that you want to send to the viewers?
No, he has given a very good government still now. I think our Congress government will continue the same thing, development and other things. They will continue. Whoever come to chief for the party, he will continue.
Sir, no name is being mentioned, but everyone knows that.
No, not yet. No. Everybody knows that DK Shikumar will be there, but officially they have not announced.
Okay, so today, at what time are you reaching? Governor is not in Karnataka, sir.
No, I think we are going to meet the concerned officer. There will be there. I think the letter will be submitted to him, and we are going back to press conference. From there, he is going to Delhi.
And when is the vote taking ceremony, sir? Any plans on that?
No plan. Still now, officially name is not announced. After announcing the name, we'll call for the CLP, and in the CLP we will elect a new leader unanimously. Afterwards, date will be fixed, consulting with the governor.
Okay. One last question, sir. Cabinet, who all are going to be now part of the cabinet, and how many deputy chief ministers? Lot of talks about.
No, that has been madam. After CMs decided, no, they will decide after that.
Okay. Thank you,
madam. Thank you. Okay.
That was Ashok Patan speaking to my colleague Shirin Elizabeth on what transpired inside in that meeting. Afin Hussain continues to be with us from outside DK Shivkumar's residence. Remember, DK Shivkumar has gone back there. There are a bunch of his loyalist MLAs who were waiting. His brother, DK Suresh, also was there. Afrin, now the expectation is that DK Shivkumar would be looking at an auspicious time to take oath. Whether he'll find one on Saturday or Sunday is what we'll have to see. He's also likely to consult his astrologer, also the Swamiji from Nanavinakare Mat, Ajaya as well.
Well, absolutely, Harish. We are getting information that he may go to the Matha in Tumkuru, where he consults with his astrologer. Remember, DK Shivkumar is highly religious, and he looks for auspicious times before doing important things, and this is such a big moment for him. He is finally going to be the Chief Minister of Karnataka. Indeed, we think that he's going to go to Tumkur, consult with his Swamiji, with his astrologer before making a move. Is he going to get an auspicious time on Saturday or Sunday? That is yet to be seen. It would only be revealed after he meets with his astrologer and he gets an auspicious time to go ahead with the vote-taking ceremony. However, the information that we are getting is that the CLP will likely be held tomorrow, and DK Shivkumar's name will be given by Siddaramaiah himself. There was also Congress leader R.V. Deshpande, who was here at DK Shivkumar's residence, and when we asked him, he said that I have information that at 3 o'clock Siddaramaiah will be tendering his resignation, but he says that no discussion has happened about when the CLP meeting will be called. He says that as of now the governor is not in the city, and Siddaramaiah will be going to the governor's office and giving his resignation. However, no call has been made about when a CLP meeting has to be called and when the decision will be taken to call out DK Shivkumar as the next Chief Minister of Karnataka.
All right, stay with us, Afrin. There's another piece of breaking news that's coming in linked to the same story. This is coming in from Yadgir district in Hyderabad, Karnataka region. The supporters of Chief Minister Siddaramaiah have staged a protest demanding that Siddaramaiah continue as the Chief Minister and not resign. This is members of the Karnataka Pradesh Kuruba organization and Siddaramaiah supporters who staged this dharna. The protesters have termed it as condemnable to seek resignation of Siddaramaiah, despite what they describe as a clean track record and good governance. Quickly coming to you, Afrin, before I go to Pallavi, we will see some of these supporters coming out and showing their displeasure. He's a man who has appealed across communities and across different regions of Karnataka.
his base
All right,
across
we'll
all
go to
communities
Afrin
and
short
across
while.
all parts
But
of
Pallavi,
Karnataka.
speaking about this transition, you've tracked the transition in several states. Some of them have been disastrous for the Congress party. But in this one, so far, looks like they've ensured that this is a smooth transition.
You're absolutely right. So far, the transitions, the attempts have not been very successful, or if they have been done, they've done in a very shoddy manner. Punjab is one example. I remember we were all in Punjab when there was a lot of pressure on Captain Amrinder Singh. But one difference I find is, Harish, that in the case of Captain Amrinder Singh, there were MLAs one after another who were actually coming out in the open and criticizing him. So at that point of time, the High Command understood that, you know, the die is cast. It's going to be very difficult for Captain to fight back, and that is when they had that meeting and Charanjit Singh Channi was made the Chief Minister. Rajasthan, another attempt to come about a transition of power, that couldn't take place because Ashok Gehlot continued to have the support of a large number of MLAs, and in stark contrast, Sachin Pilot was seen as a weaker leader. So therefore the central leadership, and I would say the Gandhi siblings, when they were trying to make an attempt to ensure a similar kind of a transition takes place, despite that rebellion or the failed rebellion, that couldn't happen. In Karnataka, the sense we get is that it is something which was in the works. It hasn't happened overnight. The media may have come to know about this overnight, but they had to go inch by inch, Harish, so as to ensure it doesn't turn out to be ugly. I mean, who would have thought a meeting ostensibly to be called only as far as the Rajya Sabha elections are concerned actually became all about the transition of power. What is very important is that they don't want any ugly scenes. You're not seeing that happening over here. You're not seeing the MLAs coming out and protesting, objecting to Siddaramaiah being removed, apart from one or two sporadic voices. That is because the central leadership is now trying to gain control of the situation. They're also going to dictate what kind of a cabinet can be formed. Rahul Gandhi made it very clear that this is my wish list, and while we are going to listen to what Siddaramaiah has to say and what the new CM has to say, some concerns will have to be addressed. And that is the reason I would say it is a return back of the high command culture once again, at least to Karnataka, to ensure that things work out and the transition takes place smoothly.
Work as a minister, as a chief minister, lot of programs for the poor, the needy, the agriculturists, farmers, and the development of the state.
So did you meet with DK Shivkumar? Did you congratulate him? What was it like here?
Naturally, I've just gone to congratulate him and wish him, nothing more than that. I have not discussed any politics with him.
So do you have any, do you think that Siddaramaiah will take the national politics? Will he go?
I don't know. As I know, I think he has said no.
Right.
But I don't know ultimately what he will do.
Right. Sir, any idea when the CLP meeting will be called? Is it going to be
No, it has to happen at the earliest, no?
Right.
How can you delay a decision?
Likely tomorrow, sir?
No, that I don't know. Ultimately, there is a procedure to be followed, and they will have to do it.
Right.
Thank you.
So much, sir.
If I'm not wrong, that was possibly Mr. R.V. Deshpande that my colleague Afrin Hussain was speaking to. But several of these ministers who attended that breakfast meeting had come out, and many of them were in tears. Possibly many of them might not make it to the new cabinet that gets formed under DK Shivkumar. We'll continue our rolling coverage of this leadership shift that's happening in Karnataka. Historic day, important day for the state, and several of the leaders of the Congress party will continue tracking that. Time for a short break now.
You don't.
A warm welcome to Scorebox Europe. I'm Steve Sedgwick with Karen Cho and Ben Boulos, and these are your headlines. Oil prices whipsawing. Crude, as you can see on the screen, up 2.4% as Kuwait defends against missile and drone threats. And the US bombs Iran hours after peace talk. Comments from Marco Rubio sent prices plunging.
The bottom line is that we prefer the negotiated diplomatic route, and we're going to give it every chance to succeed. You know, you're giving it every chance to succeed.
European equity markets touch weaker today following declines in Asia as hostilities in the Gulf heat up, while traders also watch for today's US inflation print. Federal Reserve Governors Neil Kashkari and Austin Goolsbee sound the alarm on inflation, warning CNBC on the impact of price pressures.
The inflation all around the world is much too high. We're all trying to assess, none of us are foreign policy experts. When is that conflict going to get resolved?
We had a tariff increase in inflation, which was supposed to go away. It hadn't gone away yet, and then we added this one on top of it. So that's a little more disturbing situation.
The EU reportedly plans a more aggressive push to loosen its dependence on US tech and back European champions. The CEO of Mistral AI tells CNBC he welcomes the bloc's strategy to prioritise artificial intelligence.
Europe is starting to be looking at AI as a strategic asset the same way it has looked at gas. And that's, I would say, there is a realization, even in the policymaker side, that something needs to be done. But really the companies, I would say, are the ones that are making it happen.
Morning. Okay, let's have a look. Crude prices pushing higher this morning after Iran's Revolutionary Guard said it had targeted a US airbase in response to what it said was a US attack in the south of the country. This according to the state news agency Tasnim. Now, it's not immediately clear which base was targeted in Iran. The report comes after Kuwait's military said air defences were engaging hostile drones and missiles. The origin of the attacks was not immediately confirmed. Well, overnight, the US carried out fresh strikes on Iran, targeting a military site believed to threaten American personnel and commercial shipping even. A US official told MS Now. MS Now contributor Inzamam Rashid joins us from Dubai with the latest. Inzamam, this is a tit for tat at the moment, but is there a great escalation, or is this just quite low level at the moment?
Well, look, this is a ceasefire now, which pretty much hangs in the balance, because this is the second time this week that we've seen exchange of fighting between the US and Iran, the second time in just 48 hours, in fact. And I think it's causing great concern, not just within the US and Iran, but also across this region, the Gulf nations now embroiled as well after Iran has attacked Kuwait today. And I think it just gives you a sense of how fragile this ceasefire has been ever since it was implemented on the... Unanswered. Now, earlier this week, Tehran said that the US strikes, which the US claimed were defensive strikes in the Strait of Hormuz, were a blatant violation of the ceasefire. We've had no official statement from the Ministry of Foreign Affairs, who put out a statement last time when the attacks happened just a couple of days ago. I think the big question now is where do the peace negotiations go as a result of this? Because at the weekend, there was a lot of optimism around the framework, this MOU that could potentially be signed between the two sides, which would effectively bring the negotiations to bring a conclusive ending to this conflict. The big question is now is where are we with that? Do these attacks and these strikes impact those negotiations? As we heard from Marco Rubio yesterday, he said that diplomacy is very much the route. But once again, we've seen military action being taken. And I think that's a big question mark as to how we move forward in this conflict.
Excellent work, Inzamam. Thank you very much indeed for that. Inzamam Rashid, MS Now contributor. Karen.
Conflict casting a shadow over the markets today, and you can see Europe is on the back foot. We are seeing the FTSE 100 trade down close to 1%, so very much hugging that 10,400 level. The rest of the markets, so we're modestly downbeat on both the German and Italian stock markets, but now the selling accelerating on the French stock market. It was down roughly 0.4, and now just over 0.5%, so it's giving back yesterday's gains plus some as we move throughout the morning session. The sectors where we're still seeing some strength, any patch of resilience is really around technology, up 0.6%. Again, Wall Street, we saw some fresh records inked on the S&P and the Nasdaq, a very strong data center story that's still being unfolding, and the high bandwidth memory around the chips. So that sector's resilient. Elsewhere, it is mostly a sea of red, and you can see the selling concentrated in some areas in particular. If we flip that chart over, you can see media stocks have been down about 2% this morning, and as we take stock of them, now down 1.8%. The healthcare basket down heavily, along with what we're seeing elsewhere across the board, food and beverage, and to the household goods insurance sector. Now moving on to the charts. To US futures on the back of what was 3 different boards bouncing into record territory from the Dow to the S&P to the Nasdaq. It does look more tentative this morning. Very slim ranges, so not exactly backing too far off the records, but certainly the tone is red this morning.
A pair of Fed officials have warned on inflationary risks, with the Chicago Fed President Austin Goolsbee telling CNBC that energy inflation from the Iran war has lasted longer than anticipated, creating a stagflationary shock for Asian economies. His Minneapolis counterpart, Neil Kashkari, said consumer prices are still much too high. But he hailed the resilience of the US economy, saying the labour market appears to be holding up.
The U.S. economy has proven to be remarkably resilient. Every time we think it's really slowing down, it surprises us in a good way with more strength. And the labor market has held up with an unemployment rate of 4.3%. So certainly I'm going to continue to watch the labor market. Things like unemployment claims in America have been very low. Right now, it seems like the U.S. labor market is holding up, and I'm going to continue to look for the underlying resilience in the economy. And then, of course, as we were just talking about, paying attention to what's happening around the world in terms of global events and what happens in the Strait of Hormuz. So a lot of attention on the real economy in America, on the labor market, and then paying close attention to what's happening geopolitically with the negotiations that are taking place.
Meanwhile, Cowrie asked Austin Goolsbee whether he thinks the current energy-related shock is transitory.
I certainly hope so, but I'm not totally convinced, and it's worth at least emphasizing that the initial estimates in the market, in the futures markets, and of predictors were that the price would be a lot lower than it is today. So it's already proved more lasting than it was initially forecast. And that's a little dangerous for exactly the reason you highlight in the U.S. context, that we had a tariff increase in inflation, which was supposed to go away, supposed to be a one-time increase in the price level, that the inflation part would go away. It hadn't gone away yet, and then we added this one on top of it. So that's a little more disturbing situation, more concerning situation. And if you look in Japan, or if you look throughout Asia, where they're much greater, to a greater degree, energy importers, it's more just a stagflationary shock of the old-fashioned variety. So we're trying to think through the implications.
And we are set for a slew of economic data stateside this morning at 8:30 Eastern. We'll get weekly jobless claims expected to come in at 213,000. We're also watching out for the first quarter real GDP data expected up 2%. And we'll also get the Fed's preferred inflation gauge with April's PCE print expected at 3.8% on the year. Let's get to James Pomeroy, who is a global economist at HSBC. James, nice to see you. Just in advance of this interview, I was trying to find out when Trump first turned on Powell, who, of course, was his pick to be the chair of the Federal Reserve. And I haven't found a date yet, but it's been a long-running feud, that's for sure. Do you fear that actually history will repeat itself with Mr. Trump and Mr. Walsh if the latter proves not to be, and I'll use Elizabeth Warren's words here, a sock puppet?
It's going to be an extremely challenging time for whoever's in charge of the Fed, whoever would be in charge of the Fed, given the economic data the US is facing. If you look at the balance of risks, we've just heard from those Fed speakers that actually you've got still a very resilient economy. Consumer spending is holding up, investments holding up. You have got a labour market that, yes, has wobbled a little bit, but is not sort of screaming you need to ease policy. And of course, now you have that higher inflation rate that's coming through for a number of different reasons. And so there aren't really the obvious conditions for rate cuts anytime soon. So it becomes very, very difficult to justify that if you're a voting member of the FOMC. And I think that's the biggest challenge that Kevin Walsh is going to face, is actually how easy would it be to cut rates? You need to almost look beyond the current data, which is very, very hard to do. So our expectation is that rates are going to stay where they are for some time, because there's not a natural trigger to cut rates, and there's not necessarily the real sort of booming economy that suggests that rates need to be any higher right now.
As an NPC watcher myself, and have spent many a time in a happy 2 hours lock-in without my phone before the NPR, one always sees there's dissent de rigueur on the MPC, but actually dissent historically has not been such a natural phenomenon in the FOMC. But we are beginning to see signs of that already. Do you expect that to be more the norm now, that actually Messrs Kashkari or Goolsbee, whoever it may well be, are actually going to be voting against the chair potentially?
Yeah, I think that's certainly likely. And what's interesting at the moment is if you speak to a whole range of different economists and you ask them what would they do in this environment, there's a broad range of different views, be that in the US or here in Europe, because you have got an inflation shock. But it's an inflation shock that is not necessarily just going to push up inflation. It potentially also weakens growth. It's an old school sort of energy shock that is a squeeze on household incomes. It's a squeeze on companies, and that should weaken the economy. And in that environment, actually, it's not so obvious to me that rate rises are the appropriate choice. And the central banks are going to find this very, very difficult, because there's not too distant past where we had a very, very high rate of inflation and central banks were slow to react. And this time around, they're probably going to be a little bit more aggressive, particularly in Europe, in terms of responding to that. So you can make a pretty strong case, I think, for being quite aggressive in terms of rate hikes because of that inflation shock. But you will get some economists and some members on various monetary policy committees around the world who say, actually, given the growth risks, given the challenges this creates for households, maybe we shouldn't raise rates. Or some people might even say maybe you could justify cutting rates. I think that's a hard one to justify right now. But I think that's the world we're in. Is there's a lot more range of opinions that you could form about what the right course of action is in terms of the macro outlook. And as a result, you're more likely to get divided monetary policy committees, not just in the US, but globally at the moment. And I think we're seeing that in a lot of the voting behavior right now, and it'll probably carry on for some time.
James, I mean, just stepping back from the sort of day-to-day, week-to-week, month-to-month picture on inflation and looking at sort of longer term, in the US, inflation has been significantly above target for more than 5 years now. It's climbing. We know it's climbing, whichever measure. And if the PCE comes in along the consensus expectations, it'll be 3.8%, moving even further from the 2% target. If they're not going to raise rates now, then when? What is then the circumstances that will make them feel, okay, now's the time to raise? Because the labour market's holding up pretty well. The equities are powering ahead. The stock markets are powering ahead. It feels like the economy's running quite hot. If they're not going to raise rates now, when?
I think you've got to look at what the drivers of that inflation are. And a big part of the US inflation story for some time on the core inflation and the core PCE, more so on the core CPI side, has been rental inflation, which we know has still got some disinflation to come through it. So that is a counteracting force. You've also still got the impact of tariffs on that inflation. You know, it's not been universal. It's been very sort of product by product specific. Certain products that are heavily imported into the US, so certain tropical fruits, for example, are a fantastic example of this, but also you've got a lot of products that came in from China that were facing higher tariffs. These are one-off shocks, but the nature of the way tariffs have been implemented and will be implemented this year is you just get a continuous string of those one-off shocks. So it looks like persistence, but actually they're little shocks that are affecting different products in different ways. And that keeps that inflation rate slightly sticky. But again, that's not necessarily something you react to in terms of monetary policy. Similarly with that rental story, that's just a mechanical thing keeping inflation high. Whereas if you look at sort of broader core goods inflation, you look at some of the broader sort of indices of inflation in the US, it has been relatively contained for some time. And that's a world we're still sort of expecting to persist at the moment. If you look at the pockets of inflation we're likely to see during the course of this year, is very much concentrated in energy, some potential tariff impact. And of course, what we're seeing at the moment is this huge increase in software and accessories inflation, which is sort of AI-led. That's not necessarily something that spills over into broader inflation expectations or broader inflation. So you might have what looks like on the face of it sticky inflation, but the composition of that inflation is really important. And that, I think, has a big impact on what the appropriate policy setting is. And in our view, actually, you look at all of that in unison, it's a world where the Fed can sit where they are for now. They don't need to rush into rate rises because this is not a sort of universal, broad brush increase in core inflation.
Yeah, James, unless, of course, you're buying electronics, then you might see the impact of those chip prices. But can I ask you about consumer sentiment? Because that's been declining. We've been talking about it all morning. You're seeing it stateside, around a 70-year low on consumer sentiment. You're seeing it in France, where we're right back to 2023 levels. Does that have some bearing on inflation expectations, and how quickly does that self-correct if we see events in the Middle East change?
I think it does. What we're hearing from a lot of companies at the moment is that they are reluctant to pass on any cost increases if they don't have to, because consumers are not in a position to want to take those higher prices. That, of course, keeps a little bit of a lid on those inflation numbers. And if you look at what's happening in the PMI data, not just in the US, but globally, is you've seen this sort of surge in input cost coming from those energy prices and some other materials out of the Middle East. But also that hasn't necessarily translated into big pickup in output prices. And I guess for now, there's a sort of a squeeze there that is coming through. There's not that ability to pass on those costs to consumers because of that slightly more depressed sentiment. But also at the same time, I think there's a lot of concern from consumers about the labour market. And you can see this in things like quit rates. You can see it in the confidence surveys about the labour market, which means actually the willingness and ability for people to change jobs or to ask for pay rises is much, much lower. And so in that environment, you're not going to get the sort of wage inflation spirals that you've had in sort of recent inflation periods like we had back in 2022. And that environment is very, very different. And this is where the AI story could overlay onto that as well, potentially keeping some downward pressure on the labour market, on wage growth, and that stops some of those sort of spirals getting into place. And I think that allows central banks a little bit of breathing space to look through some of this sort of input cost shock, because you're not necessarily seeing those second round effects or those spillovers into the labour market that a lot of central bankers are worried about. And that's particularly going to be the case in the US, where the role of AI is potentially a bit bigger than it is here in Europe.
James, I just want to focus on that comment around the breathing space for central bankers, because the commentary we've had from those we've spoken to on the channel, whether it's from the ECB over to the Fed, it feels as though we're now getting to the point where on borrowed time, that the macroeconomic forecast that saw this benign scenario where everything's sort of washed out by the end of June, we're getting past that now. So when it comes to the hit to growth and the inflationary concerns becoming baked in, how much time do we really have before some of those macroeconomic forecasts start to change?
I think you're in this sort of phase one at the moment where you've seen this huge cost shock inflation, and central bankers are rightly being wary of watching for that spilling over into the rest of the economy. Now, some central banks like the ECB and potentially the Bank of England might feel they need to go a little bit earlier. That's certainly our forecast, that they say, you know what, we're better off getting ahead of this, getting some rate rises in, and we don't necessarily, we can undo them if we need to further down the line. But actually what I think a lot of economists and central bankers are looking for is the signs of this becoming embedded or hitting those other parts of the economy, starting to hit hit some of those sort of pricing strategy behaviors, starting to hit the labour market and wage setting behaviors. So far, there's no evidence of that. Now, there's a risk at some point that it starts to happen. When it does, you're talking about an entirely different inflation paradigm. But our concern is not just about the inflation shock on the upside, it's the growth shock on the downside. And if you've got softer growth, if you've got consumers that are squeezed, there's not necessarily going to be that spillover anywhere near as forcefully. And that means that, yes, you might get some rate rises from central banks for getting ahead of this, but they can also take them away quite quickly if and when that cost shock, that energy shock dissipates, because you haven't seen as many of those second round effects. And that's sort of how we're sitting with our forecast. Yes, we think central banks are going to raise rates in Europe and in many other parts of the world, but it's not going to be that forceful. And there's a chance actually that they can undo those rate hikes next year. Whereas in the US, where you've got that trade-off, a little bit more of a sort of balancing act between the labour market and inflation, you're able to sit and look at this for a little bit longer, and there's no need to rush into rate rises.
Very nice, James. Thank you very much for your time today, sir. James Pomeroy, who is global economist at HSBC. Coming up on the show, ousted BP chair Albert Manifold calls the allegations against him, quote, lies, in his first direct statement since his removal. We'll discuss after the break. Megan Hill is just crack on with the broader scheme that she started with as well. It's a little bit he said, she said at the moment. I don't know if this is going to get litigious, and that's so we have to be very careful what we say. But the company, according to what the FT and the Journal have said, had its reasons, stroke grounds for his removal. Mr. Manifold denies it, and he claims, disputes all of those claims over his departure there as well. And again, it is. He says it's possible, though, that in my determination to drive change on cost, performance, the balance sheet and shareholder communications, I pushed hard and challenged people directly. Yes, it is. So he's saying, I was strong, I was robust, I was pretty challenging, but I didn't overstep the mark. Where that line is, it perhaps may, I don't know if it's going to turn litigious or not.
It may do, and don't forget Manafort's reputation is at stake here. To be such a successful chairman and to be so successful on many different companies, for these allegations to surface and then for him to be removed from such a key role, it could, of course, end up in the courts. But I mean, these are the points here around to why the business was becoming very well regarded. The cost reductions, simplifying the portfolio, strengthening the balance sheet, what has been a lot of fat in the business, but behind the scenes and this look in, and given there's been a number of changes, we mentioned the 3 CEOs and the 3 chairman roles that have turned over in the last number of years, it does suggest that something is perhaps amiss when it comes to leadership and culture at the business.
Yeah, and I suppose the pressure really is on the board now as they search for the next chair, whoever will replace Manifold, because, as you say, this turnover, it starts to look somewhat farcical if, that level of churn continues. But I think what will be interesting post his departure is what this does to Meg O'Neill's position and how much potentially it strengthens her and gives her greater leeway to push ahead with the turnaround plan, which has been well received by investors, as you were saying. After lagging behind Shell, BP's shares have outperformed Shell so far this year.
We were talking about that yesterday, and I 100% agree that it does potentially change the optics for her and whether it makes it easier to stay in the position. But the other point is that if things are broken behind the scenes and if change management is that difficult to bring about because there's so much pushback, so many obstacles internally, is her challenge just as difficult today as it was the day before? I mean, that's what's sort of coming through in the commentary here, is that there is a problem with enacting change. And we know cultural change, transformational change at a company can be incredibly difficult if the culture is not right. Is that what we're touching on here? I mean, that is one of the dangling questions.
It's a very interesting question because it's been around all century. But the truth of the matter is, when you actually, I know it sounds crazy, but it's almost like it's been unlucky. I mean, when John Brown left, again, he was a brilliant CEO. John Brown, Lord John Brown, who left, he had to step down because there was a court case in which his evidence was disputed, and he stepped down. When Tony Hayward stepped down, it's because he said something pretty useless and wasn't handling the Macondo Deepwater Horizon very well. He said, I think he said at the time, I just want my life back. Which, given the fact that people lost their lives and it was causing people's economic hardship as well, it was seen as very bad comments as well. Bob Dudley and his team steadied the ship for a long, long time as well. And then Bernard Looney, well, again, is it a culture issue that someone didn't tell everyone that he'd had relationships with other employees? Again, I don't think that's so. And then the Murray Auchincloss thing, I think Murray was a great guy. Behind the scenes, he was never seen as the strongest CFO. I think he did a lot right, and he laid the foundations for Meg O'Neill. So I'm kind of saying, look, people appear to say there's a pattern here. I'm not sure there is a pattern. I think it's just a series of very one-off events. They just all happen to BP.
Back-to-back crisis events too. If you go from one crisis to the next for the company and battling macro events, does it make it very difficult to get the house in order because you're focused on one event to the next?
Yeah, I mean, and again, I'll just say, what was the problem with Bernard Looney? Actually, that a lot of people didn't like his strategy. Yes, there was things that he should have disclosed during the selection process of him as a CEO, and that's why he lost his job. But as we're seeing here with Mr. Manifold's comments and with Murray Auchincloss's strategy and then Meg O'Neill's strategy, people just didn't like the strategy. That's why the shares were under pressure, not because Bernard Looney had undisclosed relationships. Yeah. I kind of almost think they've been unlucky. I don't think there's having dealt with BP quite closely for 20 odd years, I don't think I didn't get the impression there's a culture problem. It's just a series of one-offs. Maybe I'm wrong. I could well be. Coming up on the show, robots in the workplace. We'll talk humanoids. Barclays had a huge load of reports last week, which came in my inbox as well. Anyway, Barclays says we are about to hit automation 3.0. What on earth that means, we shall discuss after the break.
Now, watching us here on this very special show, India's Consumption Trends 2026 with Nilesh Shah. We're discussing a transformation that's quietly reshaping India. Because if you really want to understand a country, and India in particular, look at what it spends on and where that has changed. So let me quickly set this conversation up with some very fascinating data points. For years, food dominated India's household budget. Nearly half of what India spent went into food. But the share of that in urban spending has fallen from 48% all the way down to 39%. That's a complete rewriting of the Indian wallet. Where has this money gone instead? It's gone to mobiles, OTT, eating out, rent, experiences, and automobiles. In many ways, India's new essentials are data, devices, deliveries, and experiences. And perhaps no statistic captures this shift better than this. Apple India is now projected to generate revenues of 1.5 lakh crore rupees, which is nearly 2 times that of HUL. Over the last 5 years, Apple India has seen a revenue growth of 6.5 times versus HUL just 1.5 times, which raises an important question. Is India becoming a premium consumption economy? Even smartphone volumes, they're largely flat, but the premium share of smartphones has increased from 20% to 26% over the last 5 years. Urban wealthy incomes have grown at roughly 18% CAGR, whereas urban mass income has grown at just 6%, which means India's consumption story is increasingly becoming K-shaped, something that we speak about. Affluent India and mass India are moving very differently. We're also becoming an experience economy. Concerts, travel, dining out, OTT. Foreign travel spending alone over the last 8 years has increased by 450%. The Indian wallet is becoming increasingly premium, both digital and global. But beneath all of this sits another reality. India's data bill has grown much faster than our wage bill. That's not all. Retail F&O traders have lost nearly 3 lakh crore in the last 4 years, 91% of total losses. Digital fraud losses have exploded from 8.5 crore to nearly 23,000 crores as we speak. So while India is consuming more and aspiring more, the pressure on household balance sheets is also rising. Which brings us to the big question. Is this broad-based prosperity, or is India's consumption boom increasingly getting concentrated at the top? To take this discussion forward, we have a very interesting panel lined up for you. Nilesh Shah, the Managing Director at Kotak Mahindra AMC, Archit Varsne, who is the Research Analyst at Kotak Mahindra AMC. Along with him, we have Manish Khilnani from Bizom, and Arjun Vaidya, who is the co-founder and managing partner at V3 Ventures, known very well to be the D2C face of the country as well. Thanks a lot, gentlemen, for joining in. And, we've seen all the data. India's moving from just being a regular consuming economy to being an experience economy. Nileshji, I have to ask you this. From a listed company standpoint, what are the themes that you're looking at when you're looking to play this shift, and how much of that is already played out?
So one, we have seen that consumer staple is not growing as much as the consumer durable. This is also reflected into listed space, where consumption of staple is not growing and hence not getting same valuation as, let's say, consumption of durables. The second side effect I will call that investors continue to lose money in speculation, in digital fraud, in Ponzi scheme. And that amount over last 3 years could be upwards of 5 lakh crore. That is more than what you spend in a year on buying of consumer staple, from detergents to soaps to shampoos to perfume. Now, if there is a way in which we can plug that leakage, we can educate speculators not to lose so much money but spend money for their family, then suddenly we will see a trade where consumer staples, consumer durables will do better, and capital market related entities may not do as well.
Right. So, I just have to ask you this question as well. When we speak about consumption in India, the new age consumption, there are various listed plays here. You do have the platform players, you do have beauty and personal care specialists, you do have travel and tourism players, etc. as well. But oftentimes the growth, the potential is overestimated in the stock market. Do you think that is the case? Or maybe these guys will still continue to surprise positively?
No, I think these guys will continue to surprise positively because you can see on the companies which are driving the premiumization trend, whether it's within the Alcobev, you have seen a few companies who are doing very well on premiumization trends, or whether it's a footwear sector where you are seeing multiple premiumization play where your ASPs or the footwear's ASP has been growing much faster. But on the other hand, the mass players are struggling. So I think this trend will continue, and possibly you will look forward that the premiumization plays will continue to do better, and mass segment may continue to impact. And just to put that into perspective also, right, if you look at the last 5 years data of urban wealthy income growth, it has grown at 18% CAGR versus the urban mass people have grown at only a 5% CAGR. Similar trend is also witnessed in the rural India as well. Rural, if you look at rural wealthy people, they have grown at roughly 11 to 12% CAGR, and the rural labor class has grown at a 5% CAGR. And I think this differential will expected to continue as well in futures. And we think that premiumization as a trend will continue, and there will be few companies which will be beneficiary of that, and there will be few companies who will be at the receiving end of the debt. Yeah.
The K-shaped recovery, we're not sure whether that's good from a societal standpoint or not, even if it is from the premiumization standpoint. But, I have to ask you this, Manish, you track the sales data of all the consumer companies very closely. What have been the major shifts that you've noticed over the last few years?
I think the biggest shift that we have seen over the last 5 years is this whole consumer wallet changing from largely pulses, going beyond pulses to categories which are far more aspirational, far more lifestyle based, far more wellness in general. Earlier, when we used to see a lot of your household spends were spent on pulses and basic essentials in general, today we see a lot of spends happening on premium personal care. A lot of them have spent on premium home care items in general, right? So those are a couple of trends. Premiumization for sure has been around for past couple of years now. Indian consumers are clearly willing to spend a lot more today. Specifically on, say, for example, the data that we recently saw is around dairy. Dairy has been growing at about 18 to 19% from past 3 years uniformly. Largely around products like your curds, yogurts, as well as value-added products in general, largely because of this whole protein favoritism in general. Premiumization has been growing largely around your healthy lifestyle changes in general.
As the person who's been tracking all of this from the closest quarters is Arjun out here. And this is where it's important, because when you say that, staples aren't growing and a lot of the larger players aren't growing, we are premiumizing, etc. A lot of the incremental share over the last, I think, 5 or 6 years has gone to D2C companies, new age companies, and you've been tracking that. Among the earliest investors, I remember in something like a Lahori Zira as well. So what have you noticed about India's consumption patterns, and more importantly, what is the next billion-dollar category according to you?
Look, I think firstly, I really enjoyed reading the report because that 2000 number was when I was in school, right, which was 48-50% GDP spent on food, and then to see it come down. The other very interesting stat was the iPhone stat. If you asked me 5 years ago, I would have still said India is an Android market. So I think there is change, there is aspiration. And I think that aspiration is coming out now in a lot of categories, not just in food. Like in food, of course, consumers are trading up. He talked about protein, etc., all of that. I've come on Mangalam's show, so I had to wear shoes. But I'm wearing shoes from an Indian brand that costs 6,000 rupees. When the business pitched to me 2 years ago, 3 years ago, I said nobody will buy it. But now whether it's shoes, watches, sunglasses, apparel, even personal care. I'm an investor in a bunch of personal care companies. India's always been a hot country. But sunblock and sunscreen has gone through a massive uptick in consumption. And that's because people care about their bodies and their selves so much that they're having this. So I think you're seeing the customer becoming more discerning. The customer with digital payment becoming a little bit more flexible on their payments. But the important thing to talk about with the iPhone stat as well is a lot of this consumption is also being funded by EMIs, right? And so it may not necessarily be just prosperity, but maybe when I went to the US, I remember growing up, I would only see loan ads on TV, and I'd come back to India and say, this is not the case. But today, a lot of the appliance consumption or the luxury consumption, even travel consumption is being funded by income that's not necessarily yours. So that could be something that in the future may be a problem for us as well.
That's a great point that you made, and that actually sets us up for the next question as well. Up until now, Nileshji, the going was good. As the old cricket ad said, when Yuvraj Singh said, "Jab tak balla chal raha hai, sab sahi hai." But now, the last couple of years, the market hasn't given the sort of returns that it did in the previous 2 years. No other asset classes have given those kind of returns. And there is this fear of inflation in the very near future. Do you think this premiumization trend, which has accrued over the last few years, will continue, or at some point it will start hitting demand as well? Because in the same report, we've seen savings come down and loans as a proportion of people's spending increase.
So undoubtedly, Mangalam, we are at a crossroad. On one side, EMI burden is increasing at a faster pace than the income. That's why savings on financial side are falling. But it is a case of P&L weakening, not the balance sheet weakening. Indians are sitting on the highest amount of gold. Gold now is 125% of our GDP, or even more. Will people convert gold for wealth effect or not? जब शेयर बाजार ऊपर जाता है तो रियल एस्टेट में तेजी आती है. गोल्ड के दाम ऊपर जाते हैं तो क्या होता है वो आज तक किसी को नहीं मालूम. So if households convert wealth of gold, silver for consumption, we will see demand continuing. But if they keep that as a holy cow, then we will see some moderation in demand because one, inflation will rise. Second, interest rate could rise, which will have adverse impact on the EMI burden.
Right, we take that point. In fact, you've given us a bit to think about. What we'll do is we'll take a short break, come back, continue this conversation with the expert panel that we have on consumption. Welcome back. You're decoding India's consumption trends 2026 with Nilesh Shah. We have with us Archit Vaishnav. We also have with us Manish Khilnani and Arjun Vaidya. We've been discussing, how the setup has been so far. Premiumization is good, but you touched upon a couple of points. One, the fact that, currently there may be an impact on demand because of inflation. And secondly, a lot of this is funded by private credit. So let's discuss what could go wrong from here on. Because, as we speak, a lot of people, he was saying that, a stat that you had with the salaries of people and the phones that they have?
Yeah, I think back when I was running a retail sales team, I did an exercise, and that time it wasn't iPhones, it was more Android. but I had 22 sales reps and I benchmarked their monthly salary versus the price of their phone, and it was 2.5 times their monthly salary spent on a phone. But India's leapfrog laptops and our entire lives live on our phones. So I guess people are flexing their phones or having expensive phones.
And what was your stat here?
I think so about 4 lakh people use Bizom application every day for punching their orders. So we continuously also try and monitor what phones they are using, what is the battery percentage usage and stuff like that to ensure we optimize that. Right from 2018, we had looked at about 3% of users were iPhone users. Till 2026, we look at about 17 to 18% of users have been grown to iPhone.
6x growth.
Absolutely.
That's a 6x growth. And these are people who are actually funding this via EMIs, etc. Do you think that could at some point come and become a bit of a tension part for the market?
So in some sense, it's a cycle. More consumption will create more jobs, more demand, and so on and so forth. Overheating is not warranted because then the cycle breaks. Underheating is also not warranted because then the cycle doesn't gain the momentum. We need that perfect pace at which EMI burden is not crushing, pace at which consumption doesn't slow down so that no new jobs will be created. How do we achieve that equilibrium? For India, every problem there is a solution. We should explore it. The one solution which is important is the amount of losses Indians incur in speculation, in digital fraud, in Ponzi. In last 3 years, 22 to 25, collective losses, some reported, some unreported, is 5 lakh crore. This money in 3 years is more than what 145 crore Indians spend on buying toothpaste, shampoo, detergent, and perfume.
So basically you're saying that do not gamble, do not speculate, do not do anything. Just
spend on your family.
Spend on your
then
family.
Then consumption is perfectly fine.
That's interesting.
Good old Indian values.
I have to ask you this question because you are tracking this space very closely. Everyone's talking about discretionary versus staples right now. Staples have underperformed for a while. And now with the inflation cycle coming in, a lot of people believe that maybe staples are the place to be. Where do you stand on that?
No, absolutely. While it doesn't, I don't want to choose between staples and discretionary, but I think both the segments will do well. There will be few companies within staples who will do well. There will be
what would they be?
No, I think I'm not allowed to speak names, but I think there will be particular companies who are following the trend of, let's say, premiumization. There are companies who are following the trend of what he was saying, that face wash or sunscreens have taken up. So there will be few D2C listed or, let's say, beauty companies who are expected to continue to do well. And I think there is a separate section of the society. So to just give you two things in that perspective. One, so if you look at the tax filers' growth over last decade, they have gone from 4 crores to 8 crores, right? But if you look at the taxpayer growth, the people who have paid tax more than zero has been hovering around somewhere around 2.5 to 3 crores. So that means that same people are earning more, they are spending more, they are paying more taxes. And that also shows the trend that income growth is deepening rather than, let's say, widening or broad-based widening. The second important trend is also, just to put in perspective here, is that India's foreign travel spends over last 11 months have been 1.4 lakh crores. This is similar to the amount the whole building material industry in India have. So think about it.
So don't take a holiday now, instead paint your house is what you're saying.
No, I'm saying that
take holiday in India and paint your house.
But it's not that Indian holidays are cheap either. But I have to ask you this, since you're talking about premiumization, a lot of these new age companies, we've seen, beyond a certain point, beyond say 100, 200, some even 300 crores, they struggle for scale, and eventually they end up selling to some of these larger, incumbent players who then also struggle to scale that company up. How do you navigate through that?
See, I think when I was building 2016 to 21, that number was 100 crores. And we would get 100 crore was like this thing that we would chase and not be able to get. That 100 crore has now become 250, 300 crore. I think as the market cycle progresses, it is very easily believable that you will create 1,000 crore type companies. If you are taking a sliver of the market or niche in the market, don't expect to create a 10,000 crore business. If you're doing premium shoes or premium handbags or premium luggage or premium ice cream or some sliver of the market, don't expect to get 10,000 crores. But is it believable that the company can reach 500 crores, maybe 800 crores soon? Yes, that is true. On the point of getting acquired and then the legacy company not being able to run it, I think that is a function of this company or these companies getting the capabilities to be able to run new age businesses, which they will get. So I think when I sold my business, I thought 100 crore was the ceiling. 100 crore is not the ceiling. The ceiling may be 300, 400 crore today. But 1,000 crore is not so far away.
That's too small a check for someone like him to write, right?
That's why we are trying to write those checks.
You have those these companies which are doing extremely well, but they're in their own right. The incremental share is what they're taking away from the legacy companies. But now a lot of these legacy companies are also getting into the same categories. You have Horlicks Protein, you have Glucon-D, which has come up with a sports drink, and you have Amul, which has gotten into protein, etc. as well. Do you think they will be able to now beat the new age companies?
I don't think so. It's new age versus old age company. It is smart entrepreneur versus dumb entrepreneur. They could be present in both the sides. Point is, how will you communicate with consumer? There was a time when having your product across shops was the cutting edge. Now the world is moving to digital, especially in newer product. Will you have communication to talk to millennials, to Gen Z? Or will you treat them as your old customer? Product innovation, communication, digital, all those things will decide whether new age company wins or old age company wins.
So if you had to bet on a couple of themes from this space, because he's not giving me any names, you can give me some direction. I'm not asking you for names.
So essentially one play is that which are the companies which old age company will be interested in buying out. A strategic buyout will always be at a much higher than the market valuation. So think from a buyout point of view. The second thing could be some of those categories where margins are very high. For example, perfume. Now, traditionally, it has been a category which has been dominated by multinational company. They charge higher premium. But we have seen in some of the food businesses, local companies have outwitted multinational company. Could there be a local company in that space which can do better than the multinational
Titan
company?
Having
I'm not recommending.
No, I'm just thinking what you're saying. But just a final point from all you guys. Consumption is a function of the income that people make. If not an income, it is probably potential future income, which is why EMIs, etc. On the one hand, you've said that people should stop speculating, and that's one part of the income, which is perhaps can be driven towards consumption. But on the other, there is artificial intelligence, because of which employment is not increasing at the pace one would expect. And a lot of the IT jobs are, not seeing the kind of income growth at the pace that it was earlier. Do you think that could impact consumption, premium consumption at the urban end at least?
So my feeling is that if you look at IT engineer at entry level salary, that has grown at 1.5% since 2000. There's hardly any big handle difference between what you get in 2000 joining an IT company and 2026. The jobs are coming from the global capability center. Now, if we can leverage AI in GCC, we'll end up creating far more higher paying job than what IT sector is creating. So AI is an opportunity of a lifetime or a threat of a lifetime. I'm not sure which side India is leaning towards.
All right, just as we wrap up, let's ask everyone for their final word, a one-word answer. What do you think is the next billion-dollar investment idea in India?
D2C brands.
D2C brands. Which sector, which category?
Yeah, I think health, wellness, sports, nutrition, lifestyle, that's fragrance, sunglasses, watches, etc. And pets is going to be big, but it'll take some time.
All right. What's the one category where you've seen the maximum growth in the last 2 years?
Wellness, pharmacy and wellness is something which
Pharmacy and wellness. What about you?
I think Alcobev is one of the premiumization trend which is happening, creating a particular D2C brand. There is no one present. It can be a billion-dollar opportunity.
A D2C brand in Alcobev. This is so interesting. Wellness, pharmacy, and then from Dawa you've gone to Daru directly. What about you? I'll give you the last word.
I'll back my analyst.
All right. On that note, ladies and gentlemen, thank you so much. You're decoding India's consumption shifts and trends in 2026. This is the start of a conversation as we progress towards 2026. Look at the next few years. We'll continue to have these conversations periodically. Thank you for watching.
Hello and welcome to this very special conversation. I have with me Mr. Abhay Soy of Max Healthcare talking to us. Mr. Soy, thank you very much for joining in. And just to give it some perspective, we are at your Nanavati Hospital, which is your flagship facility in Mumbai, in a newly launched wing just 2 to 3 months ago. I don't know if I'm in a hospital or in a motel at this point, but we'll discuss that in a bit. I want to start this conversation by asking you about the dismissal of this PCI order which has come through, which would be a relief for companies such as yours.
At the outset, a very, very warm welcome to come. You come, made the effort to come to one of our 3 new facilities. Let me do a quick plug. Nanavati is one of them. Delhi Saket, we've just rolled out our other flagship facility in Delhi, and Mohali, Punjab. Yes, with respect to the first, the question that you sort of asked me about the CCI order, which came out yesterday. So the CCI Commission has dismissed all allegations against private hospitals, and that they were overcharging. I think there was some comparisons which were alleged that the room rates at hospitals are equal to room rates at hotels. Or for that matter, price of medicines or syringes at hospitals are more than what it is, people are able to source at pharmacies outside. I think very pertinently, the Commission has sort of ruled that hospitals are integrated services. We are not selling rooms, we are selling services. There are resident doctors, there are nurses, there are a huge amount of overheads which are incurred by hospitals while imparting services in the rooms. So it's not a direct comparison. Similar with syringes, I think, we don't sell syringes. We, the nurses or the doctors give injections. So, these are complete comprehensive services, and each item from that standpoint cannot be looked in its singularity.
I think the debate is on the markup that takes place. A lot of patients who come to private hospitals complain that maybe there is a higher markup for hospitals, which is eventually to also cover their margins. So if you look at the itemized billing, the syringe would be cheaper in a chemist outside as compared to maybe what you would get in the hospital. And similar to that, the bill would probably be cheaper if you source from outside as compared to the hospital. That's probably the debate. So your comment on that?
So I think first and foremost, when it comes to, there are 2 kinds of inputs that are required by a hospital, medicines and consumables. So if you look at medicines, I think the government has an MRP. In fact, most medicines are under capping. When it comes to consumables, of course, there are margins. Let's take syringe, for example. And in this particular case, this particular syringe, which is available outside for, I think, rupees 20, but the hospital was selling it for 240 rupees. So I think, percentage margin is one thing, but you have to look at it in its value as well, because behind that is a nurse which is imparting that medicine. Behind that is being done under supervision of a doctor. And all of these sort of costs are loaded onto the syringe. Having said that, I think if you, take into account all the margins, all of these sort of alleged overbilling margins, etc., on hospitals, but eventually it percolates down to a 10 to 12% net profit margin, isn't it? Because, a majority, if not all, hospital chains, operate at either single-digit net profit margins or very, very low double-digit net profit margins. Do keep in mind, it is an extremely capital-intensive business. The cost of technology, the cost of absolence of technology, the cost of infrastructure such as this, because we have to cater today to a very, very aspirational India as well. People are aware, people are seeking the best in class, be it technology, be it infrastructure. We were talking earlier, even, the kind of airports, public spaces, the metro stations in Mumbai, people are used to, are aspirational about, or the airports for that matter. You can't really have hospitals or technology which lie far behind.
Yeah. Do you think that eventually the government will probably cap certain, certain services by the hospital, certain equipment which is used by the hospital? It happened with the knee implants earlier. It's happened before from the government perspective. Do you think that could possibly be extended now?
So my belief is this, that, there's not a focus towards capping. The government, again, I've never held or seen or read a narrative or, gathered a statement from state or any central government or any body for that matter, which says cap the pricing of hospitals. These are determined by the market. But certainly, I think there is a push towards being transparent and being forthright. There is, or there has historically been, an opaque part of the billing, which is really, I think, high value implants or stents. They were high value items. So, in a procedure, in angioplasty, 60 to 70% of the cost was the cost of the stent. Or similarly in a knee implant. And I think rightly, the government perhaps said this is the opaque part of the billing, which a patient doesn't perceive the value, and you have to be transparent about it. And the way you're able to be transparent is if you cap the pricing.
Yeah.
But I don't think they've ever told a doctor, a clinician, or a hospital that you can't charge a certain amount for a single room vis-a-vis a multi-shared room or a doctor for his services or whatever. Because, I think, if you look at it, since 91, really, I think various governments have taken a step towards the right. I really haven't seen anybody take a step towards the left. This government more so. It is a free market out there. And I think, it's almost like saying we have malnutrition, but five-star hotels can't charge.
Yeah.
By the end of the day, there are services which are being provided by hospitals. And I personally don't see that forthcoming, but I do see, and rightly so, a push and perhaps a focus towards transparency and forthrightness.
Has this transparency increased in the past 10 years, you would say?
I think most certainly. If you look at the amount of scrutiny, firstly, awareness. I think awareness, whether it is from a patient standpoint or their scrutiny of the bills. And that's really what keeps hospitals honest. Do keep in mind, no hospital really has monopoly. If you look at Max, we perhaps operate at the highest occupancy. Yet, 30% of our business is institutional business, which is less than half. At less than half of the cost of the price of what a regular patient charges. There are other hospital chains which are operating at 60 to 65% occupancy levels, more or less. So each hospital competes against another hospital at the margin for the patient. You compete vis-a-vis the value proposition. A very important component of the value proposition is the pricing. It's almost like hotels and restaurants for that matter, right? At a good restaurant, you probably won't get a reservation, but people don't want to go to a bad restaurant. So you can imagine, with respect to your health, the whole sort of comparison is so much more profound.
Yeah. Well, let's just talk a little bit about the quarter gone by. It was a bit subduing in terms of the revenue. It grew 10%, Street was anticipating 14%. There was a little bit of pressure on the margins as well. This whole issue with regards to this oncology drugs, which you've stopped supplying in the CGHS scheme. Just take us through what kind of impact it had.
So I think 2 or 3 things here. One is, if you actually see the Bloomberg consensus, I think we're pretty much on the margin over there. So, but having said that, I think, you had many quarters of perhaps outperformance of street expectations. And this time we were as per expectations, or perhaps a little shy of it, but and rightly so. We expect more of ourselves as well, and so should the street. But do keep in mind, we've added, we started commissioning of 20% capacity over the last 3 to 4 months. You're standing in one, we've commissioned a part of the hospital, yet the rest is being commissioned. Yet you see it's staffed. The clinicians are already onboarded. So your cost structure sort of moves up when you do that. The clinician expenditure moves up. So that has an impact on your margins to some extent. I think other than that, we've had increase in institutional pricing after 14 years. The CGHS rates have been increased. But as a part of this increment, there was also a capping of margins in oncology drugs. To about the margins have been capped to hospitals have to provide a 30% discount on MRP. But some drugs, some medicines, Keytruda, for example, we operated, I think, 16 or 17% margins. So we've been unable to kind of supply that at a 30% discount. Patients are free to purchase or to get the same, obtain the same from the CGHS pharmacy and dispensaries. But because this has been, it's been about 200 plus crores of sales in the past, we've had to discontinue, and therefore sort of the top line gets impacted.
Sure. So this took place in the previous quarter as well. This is a continuous issue which you face for 2 quarters.
Well, it started in October.
Yeah. So, is there any resolution to it?
So there's a net improvement because of the CGHS rates. The total impact of positive impact of CGHS, including the net impact, including the reduction of the top line as well as the margin we were getting from these drugs, was about 200 crores.
Yeah.
But then we had another negative impact because of GST rates. So I think the net benefit is still 140 crores, of which about 100 crores has come through. And 30 to 40 crores is yet to come through on an annualized basis, because some of the super specialty rates, etc., I think still be worked out by the government. They are impaneling hospitals one by one. 2 of our hospitals have been impaneled and the rest are in queue.
Oncology is now 21% of your total revenue or your specialties.
That's right.
It used to be, what, 24%, and it used to be even higher.
That's right.
It's probably one of the most profitable segments of your business. How much is it possibly going to stabilize at?
So if you actually see, the occupancy has remained the same. So it's not as if other specialities have not supplanted that. And with respect to margins, again, you've seen the margins were 27.2, but now it's come to 26.8. So, it's not a big sort of change. considering this big rollout of 20% capacity as well, which supposedly, previously most analysts felt would have massive impact on margins when we rolled out this capacity, and yet we see it's only a 0.3, 0.4% impact. So I think that's worked out well. We've always guided to the fact that this new capacity rollout will not impact our margins, and I think that is something to which we will be able to demonstrate again.
Yeah. So oncology will be how much in terms of a percentage share?
So I think it'll be 21, 22. About 2% revenue you lose because of this whole med-onco. Okay. But we don't see any impact on the bottom line really, because like I said, it does get supplanted by or substituted by other businesses, and the margins are the same.
So how is the other section of complex therapies doing for you? Say cardio, ortho, nephro, neuro. How is all of that panning out for you at this point?
So other than oncology, all other specialties across all of Max,
how much are they growing?
They grew by more than 15% in this quarter, year on year. So that's a big sort of growth of about 15%. Do keep in mind, even the occupied bed days, that means the total number of new patients which have been admitted in the hospital has grown by more than 8% year on year. This is based on a quarter basis.
Okay. So complex therapies now, how much is it as a percentage of your revenue? How much do you want it to possibly grow to?
So I think eventually we all, kind of pray in the temple of science, medical science in this case. And, the complex therapies is something that every hospital network, every clinical program wants to serve, because that's really, I think, that is the part of the excellence of what people aspire to kind of reach. And eventually, I mean, today we have about 60% of our business is surgical business, within which we've seen growth in robotics by quite an extent in the last couple of years. And, going forward, I see actually with the advent of AI, with the advent of a lot of innovation, huge amount of innovations are happening at the clinical level, both in medical as well as surgical, robotics as well as immunotherapy. AI does sort of allow you to innovate much faster. So all of that will come through. So it's a little difficult in terms of me to pronounce that what kind of numbers we are looking at.
The focus that you have.
Absolutely.
Robotics, for example, how many robots do you have at Nanavati? How many are you acquiring in FY27?
So believe it or not, 2 years ago we had 2 robots, and now we have 28 robots. So
across India.
Across India, we have about 3 or 4 at Nanavati itself. We've got, so all our, essentially we are, this is a Mumbai-based hospital. And, the patients, people from all over the country, because the best clinical talent does reside in the metro cities of Delhi, Mumbai, Bangalore, and so on and so forth. The people also seek the best of technology, and we cater to that. So I think there's never been, any shying away from that part, because, there is no real import duty on it. And whatever you find anywhere in the world, you find in India. We get people from 145 countries who come to India for our clinical talent and technology that we're able to kind of...
In fact, your international patient revenue did very well. It's 9% of your sales now. So you're probably one of the leading chains when it comes to international patient growth. Any hiccups with regards to the West Asia crisis? We had some issues with Afghanistan earlier, I think.
Well, Afghanistan was our biggest business. It's 12% of our total international business. Yet, I think with the geopolitical situation there, India, we haven't been issuing visas, so we lost that. In spite of that, there's been a huge growth because we've been able to set up, we have 25 offices overseas for medical tourism. It's been growing at a pace of more than 20% for us for now a few years. West Asian crisis happened, but Central Asia kind of made up for it because we made some more inroads over there. But you'll always have some geopolitical issue in some part of the world or the other. It's about us making inroads in newer geographies. And, my belief is if you kind of spread the pie, you spread your net wider, the geopolitical issues become mere aberrations. if you actually sort of, we get people from 145 countries, literally the poorest parts of the world. So people from Ethiopia, people from Sudan, people at the bottom of the pyramid worldwide where it is self-paid. These are countries where either the clinical skills are not available, and other than that, the ability for them to go to any other part of the world, isn't there. I mean, India, in terms of value, in terms of the cost, in terms of skill sets, the comparative advantage that we have, no other nation in the world has even close. But I would also want to sort of point out, there are other developed countries, where the governments have been kind of this thing. But aging population, rising costs have, created huge amount of stress in their systems. I mean, take UK, for example. And for the first time, we started seeing people come in from the UK because, the waiting list for, let's say, a knee replacement is 28 months.
Wow.
So it was unimaginable in the past that people from developing countries...
On that point, how much of an opportunity is medical value travel for India as a nation, say the next 5 to 10 years?
So I think it's a massive opportunity. This is one industry where the comparative advantage that we have as a nation, no other country in the world has. Firstly, we have the demographic dividends. We are the largest producers of doctors, nurses, medical technicians in the world. We are perceived as competent. We are part of the popular culture. I mean, you won't see any television show on healthcare, ER or anything like that without Indian doctors and nurses. Everybody's been exposed to that. Look at the cost. I mean, today, a bypass in the US costs $130,000. It costs $100,000 in the UK. It's about $30,000 in Singapore, $20,000 in Thailand. It's less than $5,000 in India. We do a bone marrow transplant for $25,000. It's $850,000 in a place like MD Anderson. We do a heart transplant for $25,000 to $30,000. It costs more than $1 million in Europe or in the US. I mean, that's the kind of differential we are talking about. I mean, the soft power we have, I think, we haven't even tapped the tip of the iceberg as yet.
So for you, 9% goes to what level?
So look, I think, if you actually see, we've been growing at more than 20% top line for many sort of, for a few years now. And what that, I mean, I remember year before last, we grew at about 30% because we added 30% capacity. And the international business grew by 30%, but it seemed like 9% remains stagnant. So yes, it's been growing at 20-25%, but so is our top line been growing at 20-25%. I see this number grow. Again, it's a little difficult to kind of articulate or pronounce, where I see it in how much time. But I definitely see India as a leading medical tourism destination in the world. I think, we just haven't found our places yet.
Sustainable numbers for you, if you can guide us in terms of what FY27 looks like when it comes to revenue, when it comes to margins, 26 to 27% band, profit, what are you estimating?
So I'm not going to give you a guidance on numbers. I usually sort of stay away from it. But having said that, you can imagine we just rolled out phased commissioning of 20% capacity. End of the year, before the end of the year, we would have sort of rolled out another 10 to 12%. We don't see any impact coming through on EBITDA margins really, because the majority of our rollout is brownfield. So, I'm not concerned about, at the very least, it should grow in line with what our capacity addition is being. Do keep in mind, less than 2 years back, we added another 30%, which is again, only coming through now.
there is a possibility that CBI could produce Giribala in front of the vacation magistrate there at the Bhopal District Court. However, they do have 24 hours time, so they can alternatively wait till tomorrow. But the indications are that once they get out of Giribala Singh's residence, they will first go for a medical examination and then produce her before the local magistrate.
So, well, we'll have to wait and watch as to whether that procedure happens today or the CBI waits until tomorrow. We'll keep a track of that. For the moment, though, Arunima, thank you so much for getting us the latest. With that, it's time for a quick break. But on the other side, we'll get you all that's transpiring in Bengaluru as Siddaramaiah has resigned as the Chief Minister of Karnataka. What happens next? And of course, all eyes will be on his press briefing in a short while from now. Don't go anywhere. We'll be right back with it.
Residence of Chief Minister Siddaramaiah, the official residence. Just moments ago, we saw Chief Minister Siddaramaiah heading towards Lok Bhavan in a private car that belongs to another minister, Bhairati Suresh. He's given up on this his government vehicle, official vehicle. He's perhaps now moments away from handing over that resignation letter to the secretary of the governor at Lok Bhavan. That will happen, and in a short while from now, you will see Siddaramaiah heading back here, going to his home office, Krishna, and addressing a press conference. More interestingly, the optics of it. When Chief Minister left from here, he was heading to Lok Bhavan. DK Shivakumar was there. Other ministers were there. His close cabinet colleague, Bhairati Suresh, was driving him in his own personal car to Lok Bhavan. That's the optics of this. The Congress trying to ensure that a very loud and clear message goes out that this is a smooth transition, smooth leadership change that's happening here in Karnataka. And DK Shivakumar in the morning was touching the feet of Siddaramaiah, hugging him. Now he's accompanying him to the Lok Bhavan. He was at his home. He came back to the Chief Minister's residence. They have now left to Lok Bhavan. In a short while from now, you will see the Chief Minister addressing a press conference. He perhaps will be flanked by DK Shivakumar and other cabinet ministers, and he will perhaps explain on what has happened. But the idea is to thank the people, thank the Congress High Command and his cabinet colleagues is what we believe. Pallavi also now joining us on the broadcast. She has been covering and tracking these developments that are happening outside the Chief Minister's residence. Pallavi, a huge shift, a huge transition in Karnataka politics. A mega mass leader now moving away from a leadership role and perhaps will be in a role of a mentor. A big day for Karnataka politics and what happens in 2028 assembly election here.
And Harish, I think the Congress party would want him to be the mentor because, you know, this is something which even you were reporting and all of us were talking about it. He's a tall OBC leader, you know, and he's not someone who can be overlooked. And Rahul Gandhi's formula is very simple, that the only way we can come back to power is if the Congress is able to consolidate its hold over the Dalit, the OBC votes, and, you know, come across as the champions of the backwards, the downtrodden and the poor people. And therefore, he wouldn't want to give that inch of space to the BJP, where tomorrow the BJP can turn around and say there's so much for you questioning us, but what did you do to Siddaramaiah? In fact, I still remember there were many quotes which came in from BJP leaders, whether it was Amit Malviya, whether it was Bommai, all of them making the larger point that how badly they've treated Siddaramaiah. In the days to come, once the cabinet formation is complete, I am very, very sure, Harish, the BJP will make this a point. So Rahul Gandhi would have to ensure that Siddaramaiah is given that due respect, which is why the pictures that we were talking about become so important. That even DK has been given that brief that you should not come across as being graceless, or you and your supporters, and particularly your supporters, would have to be reined in, which is why when he arrived at the Bengaluru airport late last night, it was not as loud as we thought there would be a pomp and show. Nothing of that sort. We can still see some more alert coming in over here, Harish. So maybe he's coming back to, after handing in his resignation, we'll have to wait for that word to come in. But you know, that is what the message was given by Rahul Gandhi to DK.
In fact, Pallavi, there are a couple of breaking news that's coming in right now. The Chief Minister has now reached his home office, Krishna, not far away from here. He's submitted his resignation at the Raj Bhavan. He's here at the home office, Krishna. I'll ask my Vijay Riaz to zoom in. You can see that's his convoy going into the home office. That's where he'll be addressing a press conference. And moments after that, 4 o'clock, the Chief Minister is scheduled to take a flight to Delhi. He's leaving to Delhi at 4 o'clock, and that is for going ahead and meeting the High Command leaders. He will meet Rahul Gandhi and others. Right now, the Chief Minister's office saying that this is just a courtesy call to thank Rahul Gandhi and High Command leaders, but possibly it could also be an occasion for Chief Minister Siddaramaiah to now tell the High Command that he's not keen on going ahead and being a member in the Rajya Sabha. He would like to continue as a mere MLA in the state and mentor the government and others. But he's reached Krishna. Moments from now, you will hear from Siddaramaiah, his last press conference as the Chief Minister of Karnataka. After that, he will straight away head to the HL airport, from where he's taking a special flight to Delhi. Nabila Jamal, my colleague, also joins me. Nabila, the Congress saying not an end of an era, but a significant development in Karnataka politics, a mass leader stepping aside, moving away from leadership role. A new crop of leaders now get the opportunity to build their profile and also bring back the Congress party in 2028.
Right. In fact, Harish, I was just making my way through the Raj Bhavan and I saw it was just for the moment, barely 5 minutes, that Siddaramaiah's convoy moved into the governor's residence, the Lok Bhavan there. And it seems like they've already given, he's given his resignation there, and he's now coming back and headed exactly where I'm at the Chief Minister's home, Kaveri. So this is a real epic day, if I should say, for the state of Karnataka, considering that mid-term a Chief Minister was asked to change. A well-performing sitting Chief Minister who's the most popular mass leader in that sense, with the Ahinda face that he is. He has the massive support. He has the support of the maximum number of MLAs within the party, but yet he was asked to step down to cater to an ambition of another man as powerful and as astute as DK Shivkumar. But undoubtedly, one knows that if you have to compare the two of them, it was certainly hands down Siddaramaiah who had that kind of clout and support. But DK Shivkumar, with his equation with the High Command, the strategy that he put out to counter Siddaramaiah was basically to keep the High Command in good humor, ensure the funding for parties' election pitch in any state for that matter. DK Shivkumar was the financer. So we have, all right, we have some news coming in on DK Shivkumar getting ready for a press conference, along with, it appears that DK Shivkumar as well as Siddaramaiah are going to be holding a press conference. Let me quickly bring in Afreen, who's also with us. Afreen, could you hear me? Are you with me? All right, we're going to try. We're going to try and bring in Afrin for the moment, but DK Shivkumar also all set for a press conference. Harish, would you be able to tell us if Siddaramaiah so far has actually said that DK Shivkumar is the successor? Has he literally said it in any form or way? We know that some leaders like H.C. Mahadevappa came out and said and acknowledged that it is indeed DK Shivkumar who's going to be succeeding, but Siddaramaiah has not acknowledged it. Are you expecting that in this press conference that's going to happen in moments from now?
Nabila, some interesting visual coming in. Once again, a center chair for Chief Minister Siddaramaiah. On his left is G. Parameshwara, on his right is DK Shivkumar. And what we do know, and what Dinesh Gundurao told me personally, is that in this meeting, in the breakfast meeting, Chief Minister Siddaramaiah indeed told that the High Command has decided to go ahead with DK Shivkumar as the next Chief Minister, and he will extend his full support to DK Shivkumar as the next Chief Minister. So he's made it very clear to his cabinet colleagues, and perhaps today he will once again go ahead and tell it to the press, to the people of Karnataka, that he thanks everyone, the High Command and the people, and he also says that he will extend his support to DK Shivkumar. He's made it very clear to his supporters, to his loyalist MLAs and cabinet ministers. He perhaps will now tell that to the state, to the people of Karnataka. More interestingly, the other piece of news was Ramlinga Reddy, who confirmed to us, to my colleague Afrin, that indeed it will be indeed it will be Siddaramaiah who will be a proposer in the CLP meet. In fact, Siddaramaiah has just arrived for this
Harish,
press conference.
news coming in that Siddaramaiah has just arrived at the Chief Minister's home office. Right. Harish, Siddaramaiah has just about arrived at the Harish, can you hear me?
Okay, DK Shivkumar and Siddaramaiah, they're sitting right next to each other. The center chair still reserved for the Chief Minister. DK Shivkumar fine playing second fiddle for another few hours or so before he takes over as the next Chief Minister of Karnataka. This will be the last cabinet, this will be the last press briefing by Chief Minister Siddaramaiah in his capacity as the Chief Minister. The sense I'm getting is the Chief Minister also perhaps wants to sum up his contribution to the state, to the cause of social welfare as well, and talk about how he's done a lot for the Ahinda community, the SC/STs. There you go, Chief Minister starting with a stern warning, saying stop making noise and getting ready to speak.
ಆಯ್ತಾ ಎಲ್ಲ ಸೆಟ್ಲ್ ಆದ್ರ ಎಲ್ಲ ಮಾಧ್ಯಮದ ಸ್ನೇಹಿತರೆ ಇನ್ನು ಜೋರಾಗಿ ಮೈಕ್ ಇಲ್ವಾ ಕೇಳಿಸ್ತಾ ಇದೆ ಎಲ್ರಿಗೂ ಮಾಧ್ಯಮದ ಸ್ನೇಹಿತರೆ ನಿಮ್ಮೆಲ್ಲರಿಗೂ ನಮಸ್ಕಾರ ನಾನು ಮುಖ್ಯಮಂತ್ರಿ ಸ್ಥಾನಕ್ಕೆ ರಾಜ್ಯಪಾಲರ ಭವನದಲ್ಲಿ
I've resigned from the post of Chief Minister.
ರಾಜ್ಯಪಾಲರು ಊರಿನಲ್ಲಿ ಇಲ್ಲ.
The governor is not present in town. Hence, I had to go to his office and submit resignation.
ರಾಜೀನಾಮೆ ಪತ್ರವನ್ನ ಅವರ ಕಚೇರಿ ಅವರ ಕಾರ್ಯದರ್ಶಿ
I've handed over the resignation letter to his secretary.
ನಾನು ಮೊದಲಿನಿಂದಲೂ ಹೇಳ್ತಿದ್ದೆ, ಅನೇಕ ಸಾರಿ ಹೇಳಿದ್ದೀನಿ ಮಾಧ್ಯಮದವರು ಮುಂದೆ.
I've said it several times earlier, even in the media.
ಹೈಕಮಾಂಡ್ನವರು ಯಾವಾಗ ಸೂಚಿಸ್ತಾರೆ
I told that the moment the High Command instructs me,
ರಾಜೀನಾಮೆಯನ್ನು
I will
ಕೊಡ್ತೇನೆ ಅಂತ
resign.
ಹೇಳಿದ್ದೆ. ಅದರ ಪ್ರಕಾರ ಮೊನ್ನೆ ಹೈಕಮಾಂಡ್
Accordingly,
ರಾಜೀನಾಮೆ ಕೊಡಿ ಅಂತ ಹೇಳಿದ ಮೇಲೆ
accordingly, day
ನಾನು ನಾಳಿದ್ದು
before
ರಾಜೀನಾಮೆ
yesterday,
ಕೊಡ್ತೇನೆ ಅಂತ ಹೇಳಿದೆ. ಅಂದ್ರೆ ಈ
the High Command had asked me to resign, and I told them that I would resign day after tomorrow.
ಹಾಗಾಗಿ ಇವತ್ತು ರಾಜೀನಾಮೆಯನ್ನು ಸಲ್ಲಿಸ್ತಾ ಇದ್ದೇನೆ.
As a result, I have submitted my resignation.
ರಾಜ್ಯಪಾಲರು ನನ್ನ ರಾಜೀನಾಮೆ ಪತ್ರವನ್ನು ಅವರು ಬಂದ ಮೇಲೆ ಅಂಗೀಕಾರ ಮಾಡ್ತಾರೆ ಅಂತೇಳಿ ಸಂಪೂರ್ಣ ವಿಶ್ವಾಸ ಇದೆ. ಯಾಕಂದ್ರೆ ಸಂವಿಧಾನದ
I'm
ಪ್ರಕಾರ
confident
ಮಾಡಲೇಬೇಕು.
that the governor will accept my resignation once he's back in town. According to Constitution, he has to.
ಅವರು ಪ್ರೊಸೀಜರ್ ಏನು ಮಾಡ್ತಾರೆ ಅದು ಅವ್ರಿಗೆ ಬಿಟ್ಟಿದ್ದು. ಆದರೆ ಒಂದು ಸಾರಿ ಮುಖ್ಯಮಂತ್ರಿಗಳು
The procedure
ರಾಜೀನಾಮೆ
that he
ಕೊಟ್ಟ ಮೇಲೆ
follows, I leave it to him.
ಅಂಗೀಕಾರ ಮಾಡಿ ಮುಂದಿನ ಮುಖ್ಯಮಂತ್ರಿಗೆ ಅವಕಾಶ ಮಾಡಿಕೊಡ್ಬೇಕಾಗಿರ್ತಕ್ಕಂಥದ್ದು ಅವರ ಜವಾಬ್ದಾರಿ.
It's his responsibility to accept the resignation and make way for the next chief
ನಮ್ಮ
minister
ಪಕ್ಷ
to take office.
135 ಪ್ಲಸ್ 1 ಸ್ಥಾನಗಳನ್ನು ನಾವು ಪಡೆದಿದ್ದೇವೆ.
Our party has got 135 seats plus 1 independent.
ಜೊತೆಯಲ್ಲಿ ಇಬ್ಬರು ಇಂಡಿಪೆಂಡೆನ್ಸ್ ಕೂಡ ನಮ್ಮ ಸರ್ಕಾರಕ್ಕೆ ಬೆಂಬಲವನ್ನು ವ್ಯಕ್ತ ಮಾಡಿದ್ದಾರೆ.
We also have 2 other independents who extended support to us.
ಅದರಿಂದ ನಾವು ಸಂಪೂರ್ಣ ಬಹುಮತದಲ್ಲಿದ್ದೇವೆ.
We have absolute majority.
ಅದರಿಂದ ಮುಂದಿನ ಮುಖ್ಯಮಂತ್ರಿಗೆ ಅವಕಾಶ ಮಾಡಿಕೊಡಬೇಕಾಗಿರ್ತಕ್ಕಂಥದ್ದು.
As a result, they will have to make way or give opportunity to the next chief minister.
ಮಾತುಗಳನ್ನು ಈ ಸಂದರ್ಭದಲ್ಲಿ ಹೇಳಲಿಕ್ಕೆ ಬಯಸ್ತಾ ಇದ್ದೇನೆ.
And we have full majority, and the Constitution now gives us that right.
ಕರ್ನಾಟಕದ ಮೇರು ನಟ ರಾಜ್ಕುಮಾರ್ ಅವರು ಅಭಿಮಾನಿ ದೇವರು ಅಂತ ಕರೀತಾ ಇದ್ರು. ನಾನು ರಾಜಕಾರಣಿ.
Actor Dr. Rajkumar would call his fans as God.
ನಾನು ಸಂವಿಧಾನನೇ ನಮ್ಮ ಧರ್ಮ ಅಂತ ತಿಳ್ಕೊಂಡಿರ್ತಕ್ಕಂಥವ್ರು.
I'm a politician and I believe Constitution is my religion.
ಮತದಾರರೇ ನಮ್ಮ ಅಭಿಮಾನಿ ದೇವರು.
And voters are like God.
ಕನ್ನಡ ನಾಡಿನ ಕರ್ನಾಟಕದ 7 ಕೋಟಿ ಜನಸಂಖ್ಯೆ ಸೇವೆ ಮಾಡ್ತಕ್ಕಂಥ ಅವಕಾಶ ನಮಗೆ ಸಿಕ್ಕಿತ್ತು. 2 ಬಾರಿ
I got the opportunity to serve 7 crore Kannadigas. I got the opportunity to be Chief Minister twice.
2 ಬಾರಿ ವಿರೋಧ ಪಕ್ಷದ ನಾಯಕನಾಗ್ತಕ್ಕಂಥ ಅವಕಾಶ ಸಿಕ್ಕಿತ್ತು.
I also got the opportunity to be leader of
ಈ
opposition twice.
ಅವಕಾಶವನ್ನು ಒದಗಿಸಿಕೊಟ್ಟಂತ ಸೋನಿಯಾ ಗಾಂಧಿ ಅವರಿಗೆ, ರಾಹುಲ್ ಗಾಂಧಿ ಅವರಿಗೆ, ನಮ್ಮ ಅಧ್ಯಕ್ಷರಾದಂಥ ಮಲ್ಲಿಕಾರ್ಜುನ ಖರ್ಗೆ ಅವರಿಗೆ,
I'm grateful to Sonia Gandhi, Rahul Gandhi and our President Mallikarjun Kharge for giving me that opportunity. I would like to thank them at this point in time.
ತಿಳಿಸ್ತಕ್ಕಂಥ ಕೆಲಸವನ್ನು ಮಾಡ್ತೇನೆ. ನಾನು ಕಾಂಗ್ರೆಸ್ ಸೇರಿದ್ದು 2006. 2006ರಿಂದ ಕಾಂಗ್ರೆಸ್ಸಿನ ಕಾರ್ಯಕರ್ತರು, ಎಲ್ಲ ಕಾಂಗ್ರೆಸ್ಸಿನ ಮುಖಂಡರುಗಳು,
All Congress workers and Congress leaders,
ಲೋಕಸಭಾ ಮತ್ತು ರಾಜ್ಯಸಭಾ ಸದಸ್ಯರು,
Lok Sabha and Rajya Sabha members,
ನನಗೆ ಪ್ರೀತಿಯನ್ನು ತೋರಿಸಿದ್ದಾರೆ, ಅವಕಾಶವನ್ನು
have shown
ಕಲ್ಪಿಸಿದ್ದಾರೆ.
their love to me. They have given me opportunities.
ಅವರೆಲ್ಲರಿಗೂ ಕೂಡ ಈ ಸಂದರ್ಭದಲ್ಲಿ ಧನ್ಯವಾದಗಳನ್ನು ಹೇಳಲಿಕ್ಕೆ ಬಯಸ್ತಾ ಇದ್ದೇನೆ.
I'm grateful for all of that.
ನಾನು 2 ಸಾರಿ ಮುಖ್ಯಮಂತ್ರಿ ಆಗಿರುವಾಗ 2023ರಿಂದ 18ರವರೆಗೆ ಮೊದಲನೇ ಸಾರಿ, 2013ರಿಂದ 18ರವರೆಗೆ, ಆಮೇಲೆ 23ರಿಂದ ಇಲ್ಲಿವರೆಗೆ. ಈ ಸಂದರ್ಭದಲ್ಲಿ ನನ್ನ ಜೊತೆ ಕೆಲಸ ಮಾಡಿದಂಥ ನನ್ನ ಸಹೋದ್ಯೋಗಿಗಳು, ಅವರು ಎಲ್ಲ ರೀತಿಯಲ್ಲೂ ಕೂಡ ಬೆಂಬಲವನ್ನು, ಸಹಕಾರವನ್ನು,
All my cabinet colleagues who supported me between 2013 and 18 and over the last 3 years have showed
ಅದಕ್ಕಾಗಿ
their love
ನಾನು ಯಾವಾಗಲೂ
towards
ಕೂಡ
me.
ಚಿರಋಣಿಯಾಗಿರ್ತೇನೆ ಅಂತಕ್ಕಂಥ ಮಾತುಗಳನ್ನು
I'm always grateful for that.
ತಿಳಿಸಲಿಕ್ಕೆ ಬಯಸ್ತಾ ಇದ್ದೇನೆ. ನಾನು ಹಳ್ಳಿಗಾಡಿನಿಂದ ಬಂದಂಥವನು.
I'm somebody who's come from the rural background.
ನಾನು ಮುಂದೊಂದು ದಿನ ಶಾಸಕನಾಗ್ತೇನೆ, ಮಂತ್ರಿ ಆಗ್ತೇನೆ,
I never thought that one day I'll become either an MLA, a minister,
ಮುಖ್ಯಮಂತ್ರಿ ಆಗ್ತೇನೆ,
or even Chief Minister.
ನಾಯಕನಾಗ್ತೇನೆ ಅಂತಕ್ಕಂಥ ಕನಸು
I did not even dream about it.
ನಾನು ರಾಜಕಾರಣಕ್ಕೆ ಬಂದದ್ದು ಆಕಸ್ಮಿಕ. ಯಾಕಂದ್ರೆ ನಮ್ಮ ಕುಟುಂಬ
My entry into politics was mere accident. Nobody from my community or my family was in politics.
ತಂದೆ ತಾಯಿಗಳಾಗಲಿ ಅಥವಾ ಇನ್ಯಾರೇ ನಮ್ಮ ಕುಟುಂಬಕ್ಕೆ ಸಂಬಂಧಪಟ್ಟಂಥವ್ರು ಯಾರು ಕೂಡ ರಾಜಕಾರಣದಲ್ಲಿ ಇರಲಿಲ್ಲ. ನಾನು ಮೊದಲಿನಿಂದಲೂ ಕೂಡ ರಾಜಕಾರಣಕ್ಕೆ ಬಂದಂದಿನಿಂದ ಬುದ್ಧ, ಬಸವ, ಬಾಬಾ ಸಾಹೇಬ್ ಅಂಬೇಡ್ಕರ್,
Ever since coming into politics,
ಗಾಂಧೀಜಿ, ಇವರ ತತ್ವಾದರ್ಶಗಳಲ್ಲಿ ನಂಬಿಕೆ ಇಟ್ಕೊಂಡಿದ್ದಂಥವ್ರು.
ever since coming into politics, I believed in the ideology of Buddha, Basava, Gandhiji and Ambedkar.
ಸಂವಿಧಾನದಲ್ಲಿ ಅಪಾರವಾದಂಥ ಗೌರವ ಇಟ್ಕೊಂಡಿರ್ತಕ್ಕಂಥವ್ರು.
I'm somebody who believes or has immense faith in the Constitution.
ಎಲ್ಲ ಒಂದು ಕುಟುಂಬವಾಗಿ ಬಾಳಬೇಕು ಅಂತಕ್ಕಂಥದ್ರಲ್ಲಿ ನಂಬಿಕೆ ಇಟ್ಕೊಂಡಿರ್ತಕ್ಕಂಥದ್ದು. ಯಾವುದೇ ಜಾತಿ, ಮತ,
I'm somebody who believes that everybody, cutting across caste lines, religious lines, should work and be together as one family.
ಮತ್ತೆ ಆರ್ಥಿಕವಾಗಿ, ಸಾಮಾಜಿಕವಾಗಿ ಈ ದೇಶದ ಸಂಪತ್ತು, ಅಧಿಕಾರ ಎಲ್ರಿಗೂ ಸಮಾನವಾಗಿ ಹಂಚಿಕೆ ಆಗಬೇಕು ಅಂತಕ್ಕಂಥದ್ರಲ್ಲಿ ನಂಬಿಕೆ ಇಟ್ಕೊಂಡಿದ್ದಾರೆ. ಅದಕ್ಕಾಗಿಯೇ ಬುದ್ಧನ ವಿಚಾರ, ಬಸವಣ್ಣವರ ವಿಚಾರ, ಗಾಂಧೀಜಿಯವರ ವಿಚಾರ, ಬಾಬಾ ಸಾಹೇಬ್ ಅಂಬೇಡ್ಕರ್ ಅವರ ವಿಚಾರ, ನಮಗೆ ಆದರ್ಶಪ್ರಾಯ. ಇಡೀ ಸಮಾಜ ಕುವೆಂಪು ಅವರು ಹೇಳಿದಂತೆ ಸರ್ವ ಜನಾಂಗದ ಶಾಂತಿಯ ತೋಟ ಆಗಬೇಕು ಅನ್ನೋದ್ರ ನಂಬಿಕೆ.
I'm somebody who believes that the entire state should be a happy place for the whole community.
ಸಮಾನತೆಯ ಸಮಾಜ ನಿರ್ಮಾಣ ಆಗಬೇಕು, ಸಮಾನ ಅವಕಾಶಗಳು ಎಲ್ರಿಗೂ ಸಿಗಬೇಕು.
Everybody should get equal opportunity. Sandeep could come.
ಸಮಾನ ಅವಕಾಶಗಳು ಇಲ್ಲದೇ ಇರೋದ್ರಿಂದಲೇ ನಮ್ಮ ಸಮಾಜದಲ್ಲಿ ನಾವು ಅಸಮಾನತೆಯನ್ನು ನೋಡಲಿಕ್ಕೆ ಸಾಧ್ಯ ಆಗುತ್ತೆ. ಈ ಅಸಮಾನತೆ ತೊಲಗಬೇಕಾದ್ರೆ
This discrimination in the society should end.
ಎಲ್ಲರಿಗೂ ಸಮಾನತೆಯ ಅವಕಾಶ ಸಿಕ್ಕಲೇಬೇಕು. ಅದಕ್ಕಾಗಿ ನಮ್ಮ ಮೊದಲನೇ ಅವಧಿನಲ್ಲಿದ್ದಂಥ ಸರ್ಕಾರ 2013-18 2023ರಿಂದ ಇಲ್ಲಿವರೆಗೆ ಇರ್ತಕ್ಕಂಥ ಸರ್ಕಾರ.
That's why our government, the one from 2013 to 18 and the present one,
ಸಮಾನ ಅವಕಾಶಗಳು ಸಮಾನತೆ ಬರಲಿಕ್ಕೆ ಪ್ರಯತ್ನಗಳನ್ನು ಮಾಡಿದ್ದೇವೆ. ಮತ್ತೆ ನಾವು ಏನು ಮ್ಯಾನಿಫೆಸ್ಟೋದಲ್ಲಿ
no discrimination and there are equal opportunities.
ಆ ಮ್ಯಾನಿಫೆಸ್ಟೋದಲ್ಲಿ ಹೇಳಿರ್ತಕ್ಕಂಥ ಭರವಸೆಗಳು ಅವುಗಳನ್ನು ಜಾರಿ ಮಾಡ್ತಕ್ಕಂಥ ಪ್ರಾಮಾಣಿಕ ಪ್ರಯತ್ನವನ್ನು ಮಾಡಿದ್ದೇವೆ.
We made the honest attempt at implementing all our promises that was mentioned in the manifesto.
ಎರಡು 2013ರಿಂದ 2018ರವರೆಗೆ ನಮ್ಮ ಮ್ಯಾನಿಫೆಸ್ಟೋ ಮೂಲಕ 165 ಭರವಸೆಗಳನ್ನು ಕೊಟ್ಟಿದ್ದೇವೆ.
Between 2013 and 2018,
ಭರವಸೆಗಳಲ್ಲಿ 153 ಭರವಸೆಗಳನ್ನು ಈಡೇರಿಸಿದ್ದೇವೆ.
promises made in the manifesto, we managed to fulfill 158 of them.
ಆಮೇಲೆ 2023ರ ಮ್ಯಾನಿಫೆಸ್ಟೋ ಮೂಲಕ ಡಾಕ್ಟರ್ ಪರಮೇಶ್ವರ್ ಅಧ್ಯಕ್ಷರಾಗಿದ್ದರು, ಮ್ಯಾನಿಫೆಸ್ಟೋ ಕಮಿಟಿ ಅಧ್ಯಕ್ಷರಾಗಿದ್ದರು.
Through our manifesto that was released in 2023,
ಆಗ ಸುಮಾರು 550ಕ್ಕೂ ಹೆಚ್ಚು ಭರವಸೆಗಳನ್ನು ಕೊಟ್ಟಿದ್ದರು.
we had given 550 promises.
300 ಭರವಸೆಗಳನ್ನು ಈಡೇರಿಸಿದರು. ಸುಮಾರು 300 ಭರವಸೆಗಳನ್ನು.
We fulfilled 300 of those promises.
ಅದ್ರ ಜೊತೆಗೆ 5 ಗ್ಯಾರಂಟಿ ಯೋಜನೆಗಳನ್ನು ಕೂಡ ಘೋಷಣೆ ಮಾಡಿದ್ದೇವೆ.
We've also rolled out 5 guarantees along with that.
ಈ 5 ಗ್ಯಾರಂಟಿ ಯೋಜನೆಗಳನ್ನು ಕೂಡ ಮೊದಲನೇ ವರ್ಷವೇ ಈಡೇರಿಸಿದ್ದೀವಿ.
In our very first year,
ಇಲ್ಲಿವರೆಗೆ ಸುಮಾರು
we implemented all 5 guarantees.
1,40,000 ಕೋಟಿಗೂ ಹೆಚ್ಚು ಹಣ ಈ ಗ್ಯಾರಂಟಿ ಯೋಜನೆಗಳಿಗೆ ಖರ್ಚು ಮಾಡಿದ್ದೀವಿ.
We've disbursed more than 1,40,000
ನಾನು ಯಾಕೆ ಇದನ್ನೆಲ್ಲ ಪ್ರಸ್ತಾಪ ಮಾಡ್ತಾ ಇದ್ದೀನಿ ಅಂತಂದ್ರೆ
crores on this money, on these guarantees.
ಜನತೆಗೆ ಕೊಟ್ಟಂತ ಭರವಸೆಗಳನ್ನು
I'm mentioning all this to show that the promises that we gave to people we fulfilled.
ಈಡೇರಿಸತಕ್ಕಂಥ ಪ್ರಾಮಾಣಿಕ ಪ್ರಯತ್ನವನ್ನು ಮಾಡಿದ್ದೇವೆ.
We made an honest attempt at fulfilling the promises made in our manifesto.
ಇದು ನನಗೆ ಮತ್ತು ನಮ್ಮ ಪಕ್ಷಕ್ಕೆ ಸಂತೃಪ್ತಿಯನ್ನು ಕೊಟ್ಟಿರ್ತಕ್ಕಂಥ ವಿಚಾರ ಅಂತಕ್ಕಂಥದ್ದನ್ನು ತಮಗೆ ತಿಳಿಸಲಿಕ್ಕೆ ಬಯಸ್ತೇನೆ.
This has given us a lot of satisfaction both to me and my party.
ಅಪಪ್ರಚಾರ ಮಾಡಿದ್ರು ವಿರೋಧ ಪಕ್ಷದವರು.
Opposition parties indulged
including
in maligning
Prime Minister of the country.
Our party. None other than the Prime Minister of this country also indulged in it.
ಈಡೇರಿಸಲಿಕ್ಕಾಗಲ್ಲ.
They said we wouldn't be able to fulfill our promises.
ಖಜಾನೆ ಖಾಲಿ
We would go bankrupt.
ಅಭಿವೃದ್ಧಿ ಕೆಲಸಗಳಿಗೆ
They said the exchequer would go empty.
ಅಂತೇಳಿ ಇವತ್ತು ಈ ಗ್ಯಾರಂಟಿ ಯೋಜನೆಗಳನ್ನು ಜಾರಿ ಮಾಡಿದ ಮೇಲೆ ಕರ್ನಾಟಕ ಈ ದೇಶದಲ್ಲೇ
we started guarantee schemes.
ತಲಾ ಆದಾಯದಲ್ಲಿ ನಂಬರ್ 1 ಸ್ಥಾನದಲ್ಲಿದ್ದೇವೆ.
In fact, we are in number 1 position.
ತಲಾ ಆದಾಯದಲ್ಲಿ we are number 1 in the entire country.
Phone ಮಾಡಿ ಟಿಕ್ ಟಾಕ್.
GST correction ನಲ್ಲಿ we are number 2 in the entire country. Maharashtra is number 1. Karnataka is number
Powering India's potential in association with News 18 Network.
India's growth story is increasingly being powered by its human capital, and education is at the center of that transformation. From small towns to big ambitions, millions of students today are aspiring for opportunities that were once out of reach. To understand this better and to have a conversation around this, joining us today is someone who's closely shaping this journey. We are in conversation with Nitin Kukreja, CEO of Allen Career Institute. Nitin, it's great to have you. Thank you for making time and speaking with CNBC TV 18.
My pleasure.
So I want to start by asking you that Allen has built a 38-year legacy and, from a batch of just 8 students in Kota. How do you see this journey?
It's a fascinating journey, and it started, as you said, with 8 students. We just celebrated our 38th Foundation Day a couple of weeks back. And today we teach more than 5 lakh kids. So it's a journey that is the stuff that really dreams come true.
Right.
But as you said, powering human capital, that's what we do. Hopes and aspirations are not limited to big towns. They come from every center and every pocket of India. And we are a means to achieving the end for a lot of students who hope and aspire.
Right. It's often said that education is a great equalizer in our society. So how is Allen ensuring that it's implemented in its policies?
So we provide equal opportunity for any student who dreams to become an engineer or a doctor and doesn't have the access to the facilities back home. We teach for the IIT JEE exam, we teach for the NEET exam, but we are also not just preparing children for these exams, we are also preparing them for life. And this is the basic fundamentals that we impart to them in these years that they get ready for. Just to give you some numbers, out of all the IIT and medical college admissions that happen, only about 15% come from the metro students, the metro cities for us. So a large chunk really comes from the tier Z cities as the government classifies them as per the pay commission, the latest population norms. Tier Z cities contribute more than 50% to the IIT admissions and nearly 2/3 of the medical college admissions. So that's the social equality that we bring to the table, that everyone gets an opportunity irrespective of where they're from, because the reality is that while education has gone to every city and every village, quality education still hasn't, and that's the equalization that we do.
Right. You spoke about your top performance that are coming from these districts. So how is Allen unlocking these the potential of these children in these geographies?
So we give them the academic environment that they're looking for. They go through a program with us which involves great faculty, trained faculty, which involves a certain pedagogy that we follow. And in today's world, that their journey is also, their academic journey is also powered by technology. So all three come together and we give them the right framework and the right environment for them to unlock their potential. Look, every child will have some potential in themselves, and we give them the environment to basically unlock that potential.
Right. But do you think that India, and I don't mean to generalize, but do you think India underestimates its talent beyond the metros, beyond the big cities?
It doesn't underestimate it. I think every successive government recognizes that, has tried to harness it, and has done a phenomenal job in taking education out to every corner. But as I said, the challenge is not just education, the challenge is quality education. And being able to provide that in a country where there would be about 17.5 crore children between grade 6 and grade 12 is going to be a mammoth task any which way.
Yeah.
So we do recognize that a lot of talent exists outside the metros, but the means to unlocking it is still work in progress.
Right. You know, we were having this conversation about the success of Allen Institute and how a lot of your students are making it to IITs. The consistency, let's talk about that, and how are you able to ensure consistency in results year
So let
after
me
year?
give you first a sense of the scale that we do. We teach close to 500,000 students, 5 lakh students, as I said earlier. And we teach for the IIT exams, we teach for the medical entrance exams. There are 17,500, 18,000 IIT seats in India, all across. And there are about 15 lakh aspirants who appear for the engineering entrance exam. Allen students contribute 4,200 of those entrants. So 1 in every 4 IIT seats is actually an Allen student.
Oh.
And similarly, when I look at the NEET exam, the medical entrance exam, about 23 lakh students appear for that, and they're vying for 60,000 government medical college seats and about 2,200 AIMS seats. Now, out of the 2,200 AIMS seats, 500 plus is again Allen students. So again, 1 in 4 AIMS seats is also taken by an Allen student. So that's the kind of success that we bring to the table. These are again the top tier institutes, the top tier students, but shows the kind of scale and breadth that we bring to it. How we do it, it's a combination of many years of experience, but we bring highly trained faculty. We have a faculty training program that can produce anywhere between 500 to 1,000 teachers a year. And India is always going to be a teacher deficient country. And one of the biggest challenge in taking quality education out to every corner of the country is going to be the availability of teachers. So we train our teachers and put them in the classrooms. That's one. The second thing is a pedagogy honed over so many years, 38 years. It includes everything outside the classroom, from practices to tests, homework, personalized attention, doubt resolution, either in a physical form or in a digital form today. So it's a pedagogy that has been honed over many years. And in today's world, as I said, the technology aspect also comes into play. So every student's journey is now powered by the app as well. You may be a physical classroom student or an online classroom student. The out of classroom journey is common, where you can do your practices, you can customize your tests for yourself. You want to test yourself in a specific topic or a specific subject, you can do that. You can get your doubts resolved. We resolve about 6 million doubts on the app every year, and that's all powered by AI. So that's the sauce and the ingredients to the sauce and how it is made.
Wow. 6 million doubts. Okay, I got stuck there. All right. There's something else that I was keen on speaking with you about is Allen's contribution to making, to help India participate in global Olympiads.
Correct.
Can you throw some light on that? How did that happen, and how well are we doing on that front?
So we're doing phenomenally well, and our performance is increasing or improving each year. While we talk about all the sports Olympics, the fact of the matter is that 5 of our students have just qualified to represent India in the International Physics Olympiad, of which 4 are Allen students. Now, this is for the competition that's going to be held in July in Colombia. But if I take last year's performance, again, 5 students represented India, of which again 4 were Allen students. Each of them, all 5, got a medal back and placed India 5th on the table, on the medals tally. So I think that's a commendable achievement. But beyond that, Allen students have been doing this across many, many years. And not just the Physics Olympiad, there's also the Maths Olympiad, there is the International Junior Science Olympiad, and many such subject matter Olympiads. And I think in cumulative, Allen students would have got in excess of 150 medals for the country by now.
Wow. I think after every answer, I'm just amazed by the numbers that you're throwing at me. I think this is incredible. This is incredible. Nitin, I wanted to understand from you, it's on a personal note as well. What are the things that you are proud of as a CEO of Allen, the things that you introduced, or any story, any anecdote that you want to share with us?
Every story is a heartwarming story. Children come to us with dreams, aspirations, and to see them happy and their parents happy when they've qualified for these or had seen success in these exams is a heartwarming story. I feel personally proud of the fact that children from small towns are able to make their dreams come true. Gaya, which is a district classified in the government annals as a multi-dimensional poverty index district, if you have 23 children going to top medical colleges and IITs from Gaya, I think that's an achievement that I would be very, very proud of. And that's what we've really done over the last few years, and personally that I feel proud of, is that we're taking Allen to every corner of the country. No child gets left behind in terms of the access to the Allen quality of education. We are now present in more than 60 cities. We are present online. So anywhere you are, you can access the Allen quality, the Allen pedagogy, the Allen faculty. That's what we've done.
All right. So please hold on to that thought. What we'll do is we'll take a short break, and when we return, we will talk about Allen's vision beyond entrance exams and how the Allen Institute is embracing the digital education system. Stay tuned.
Allen, powering India's potential in association with News 18 Network.
Eventually get a
Ellen, powering India's potential in association with News 18 Network.
Welcome back. We are in conversation with Nitin Kukreja, CEO of Allen Career Institute. Nitin, let's talk about the growing online footprint of Allen Institute. And I also want to understand from you your take on the hybrid model of education.
So, to us, physical, online, hybrid is a fake debate. Children are looking for good education, and online is just one means or a medium to that education. Children have the ability to come to a physical classroom or not come to a physical classroom. What we offer them is quality education at both places. What we have focused on the online piece particularly is quality and learning outcomes, because that has been the piece that most edtechs have lacked in the many years that we've seen the edtech story unfold and unfold. We now teach thousands of students who are taking full-time courses with us. But within that, what I'm really proud of is the fact that we generate learning outcomes. And again, if I spell it out in some numbers, both last year as well as this year, we have 100 plus IITians coming purely from our online courses. In each of the last 2 years, we've had a top 100 rank in the IIT JEE exam. We've had a junior science Olympiad gold medalist coming from our online courses. And this year was a particularly proud and heartening achievement where AIR 11 in the JEE mains exam was a fully online student who got 100 percentile. Now, that to us is the real satisfaction, the real proof of the pudding that learning can happen online, because a lot of students and parents got disappointed during the entire COVID time where everybody faced a digital learning experience and really realized that there was very little learning that was coming out of it. But I'm proud to say that I think we've solved it.
Okay. From the fake debate, let's talk about something real. Allen has a strong presence in the foundation segment with close to 1 lakh students enrolled. So what has driven this early scale, and how are you approaching learning at the school level differently?
So again, it goes back to the biggest education challenge in India, which is that access to quality education is not easily available everywhere. And parents and students are looking for that solution because these are the formative years where the basics, the fundamentals get set, or a student falls behind. And to that extent, they're looking for options that can help them get the basics and fundamentals right. Not everyone will want to become a doctor or an engineer, but just having the basics right is what people are looking for. And that's where we come in to provide that solution as well.
Right.
So 100,000 students between grade 6 to grade 10. And that's the work we do.
So any new offerings or innovations that you want to talk about?
Sure. So a lot of these students are actually looking for something more advanced than what school has been doing, and that's the traditional offering that we've been providing them. But now we also realize that a lot of students are just looking to prepare for their board exams.
Yeah.
And that's the new offering that we're coming up with to just help you get ready for your board exams. Maybe you don't want to be 1 step ahead or 2 steps ahead of what school is doing for you. So just get ready for your board exams.
Okay. Allen is also expanding beyond entrance exams. So tell us about that, and what kind of opportunity do you see there? What are you doing basically outside of entrance exams?
So let me speak a little bit more about that. Again, 17.5 crore children between grade 6 to grade 12. And not everyone has access to quality schools, quality education. That's the fundamental education gap, education deficit in India. Access has been provided, and I think well-intentioned. We made giant strides over the last 50 years, 70 years, but still there is a gap remaining. And it's for people like us to go and try and fill that gap. What we are doing, you can never do it with the number of teachers that would be needed. 17.5 crore children means you would need close to 30 lakh teachers, and that's not going to happen in the foreseeable future. What we are doing is trying to make concepts and learning fun, engaging, interactive, and in a manner that you can do it at your own pace. So it's a completely new product. We're calling it Eureka, and that's just helping you get ready with your school exams, your board exams. We have it in 10th. We will have it in multiple languages. We'll have it for all the boards, not just the CBSE board, but all the boards, the state boards. And then we can take it to the 9th standard and the 8th standard, so that all your formative years where all your basics and fundamentals are getting set, those are the ones that you don't need to worry about at all. Then you have your choice of options, whether you want to become a doctor, or engineer, a lawyer, a chartered accountant. Those avenues are open to you after your 10th standard, in your 11th, in your 12th. But we'll get you set for those formative basic years, grade 6 to grade 10.
You spoke about the fact that you want to make education fun, and I'm sure as a company you have ambitions and you want to scale. But how do you ensure that in India, when you want to scale, you don't compromise on quality of education? And of course, there's a lot of competition as well.
So that's been the big challenge and the bane of Indian education, that however well-intentioned you may be, you've not been able to scale with the quality. And I would say that that's something we are very mindful of. When we go out and launch a center or even digitally, that's the one thing that we are very focused on, that the quality aspect never suffers. So when we've launched or opened a center in Lucknow or in Patna, and this year we've launched 6 centers across Bihar, we make sure we have our trained teachers, the pedagogy in place, we have the right fundamentals, the right inputs that we believe are necessary, and only then we go ahead and do it. Same for our digital business, and that's how you're seeing the results that the digital business is throwing out these days. It's because we've never compromised on the quality aspect. So when we start with a new product, when we start with a new city, the question we ask is, will we be able to deliver results? Will we be able to deliver learning outcomes? Because that to us is the basic premise with which we are going to operate. Now, that's the whole philosophy with which we've operated for the last 38 years. That's why we are where we are.
Okay. I'm going to ask you, this is the final question. I'm going to ask you a very HR or a CEO type question.
Sure.
So where do you see yourself or Alan 10 years from now in terms of scale and impact?
Look, there is a long road ahead.
Yeah.
The number of students in India is huge. People have different aspirations, and there is a widening education deficit across the country. We're still only, when I say that we're teaching 5 lakh students, we're still only scratching the tip.
Yeah.
And it's just the tip of the iceberg. So I think the whole world is open. We will go pedagogy by pedagogy, we will go geography by geography, and just make sure that the Allen quality of education is available to all. That would be a very satisfying 10-year journey.
All right. Thank you, Nitin, for having that conversation with CNBC TV 18, and wish you all the best for your launches and future endeavors.
Thank you very much.
And with that, it's a wrap on this special conversation with Nitin Kukreja. And as we continue to track their story, because strong fundamentals, wider access, and a clear focus on outcomes, that's what continues to define India's evolving education landscape. And as Allen expands its reach under his leadership, the opportunity to unlock talent across the country only grows stronger. Thank you for watching. This is Archana Solanki for CNBC TV 18.
Ellen, powering India's potential in association with News 18 Network.
Hello and welcome. UBS is holding its Asian Investment Conference 2026 in Hong Kong. It kicks off today and runs for the next 3 days. Joining us now are Divya Nagarajan, Head of India Research UBS, and Sunil Thirumalai, who is the Executive Director, GEM Equity Strategist at UBS. Divya and Sunil, great to be speaking with the both of you as we kick off. I think 3 days of pretty interesting conversation. And of course, this is the first in a series of conversations we'll have with many from your teams. Well, there is so much ground to cover with respect to what is going on in the investment world. But let me just sort of start by getting a FII temperature check, if I can call it that, with respect to Indian markets. The temperature surely isn't running high, but how far below normal are we right now? Divya, why don't you go first?
I would say about 45 to 50. I think what we are beginning to see is that the earnings season has been pretty good so far. And I think people who have stayed away are now trying to see, can we look at some bottom-up ideas? So we are definitely seeing pockets of interest emerge, especially from an FII perspective. They're looking at value bottom-up stories that can be earnings compounders over a long period of time. So it's still early days, but I would say I would put it at an optimistic 45 to 50 compared to where we've been in the last couple of months.
Sorry, I said the range was 90 to 100. When I heard 45, I had a mini heart attack. I think you meant it in. You're saying it's picking up. That's basically what you're saying, all right? The trajectory.
I would have put it lower a couple of months ago, but I think with the strong earnings season coming through, we're definitely seeing more incoming requests from foreign investors.
Yeah. And, guys, we're speaking to you on a morning when Taiwan has overtaken India's market capitalization. So we just looked at the live numbers, 4.95 trillion, and we're at about 4.92 or so. So it's quite incredible, right? But there's one stock there, and TSMC, which is outsized part of the index. Same thing with Korea as well. Actually, a few weeks ago, both Korea and Taiwan were within 10% of India's market cap range. And Taiwan, of course, has now bridged that. Sunil, so come in there. Is that the main challenge? This entire AI trade and all these large stocks like TSMC, which feed into the big AI boom in the US? And so far, we don't have a foot in the door there, at least in the listed universe.
Yes, so I think just to take a step back and get a broader perspective, for the last 2 to 3 months, we've actually seen meaningful outflows of foreign money from all of EM, all of Asia, not just India. It's, Korea has seen big outflows, Taiwan has seen big outflows as well. But the drivers for those outcomes, in spite of that, we've seen, as you mentioned, Korea and Taiwan have done well, and India has, kind of underperformed. So there are a few, angles to that. AI is a very important aspect, as you mentioned. There does not seem to be any letting of demand from the US hyperscalers in terms of their capex, and hence the demand for the upstream companies in North Asia. And yeah, of course, India is kind of missing out on that. And added to that, is also the oil price spike and the Iran conflict. While even the two markets in the North Asian markets that we are discussing are also dependent on imported energy. They're not energy surplus economies. They are importers. They've been able to manage it probably a bit better, and for sure for these specific industries, they are being considered as strategically important, and a lot of support being given to those. So yes, I think AI trade is pretty important for this divergence where India has underperformed. We're not sure if that's dying out anytime soon.
Sunil, the reason why there have been large outflows, actually, out of markets like Korea, Taiwan, etc., is it? I read that for large active EM investors, there is like a 10% limit on a single stock, and because these are essentially, such large trades, TSMCs, it's like the right. So is that the reason why perhaps there has been some selling out of those? So occasionally we see these kind of sharp outflow numbers, and then they come right back.
Yeah. So absolutely right. It's not that I think it's because of the single stock limits. TSMC is beyond 10%, and Samsung is less than 10% for an EM investor, but it's catching up pretty soon. So there would be some funds which are above who would have been overweight Samsung, for instance, and they are being forced to sell. So I mean, I think that is definitely there. So it's not that. So which also means that if there is any correction for some reason in some of those stocks, you could see some buying coming back immediately. So that could also provide some floor to those stocks. So there is this technical factor at play as well.
Sunil, can India have a bull market in the absence of an AI play or the AI ecosystem? What is your own view?
Well, okay. So I think a bull market for India is an absolute return concept. It's not a relative return. So it's possible that EMs do well. India may underperform because of whatever AI trade that's happening elsewhere, but it can still have a positive return year, right? So I think the two are not really mutually exclusive. If you have decent earnings, if you have it is a domestic story for India given the way the index is. So if you have decent earnings growth, if you have you're beginning to see banks pick up on credit growth after a while, they're gaining market share against the bond market. And if they are able to manage their margins, and probably see some increase in margins in a rising rate environment, all of that is good, right? You have other themes like defense, renewable energy, etc., that are picking up across the market. So I don't think and importantly, keep in mind that after COVID, the foreign investor, the impact of the foreign investor in determining the direction of the market has kind of reduced a bit. It's not gone away, but it has reduced a bit. And if the domestic money is supportive and if the earnings start recovering, there's no doubt why India can't have a positive return year. And outperformance versus underperformance versus the rest of EM can be for various other factors.
Okay. Divya, you said that the foreign interest in India is picking up, albeit slowly, but it's still picking up. There are certain themes, bottom-up ideas that they're looking at. Do you want to tell us a little bit what is catching their interest? Are there any sectors or themes?
I think as Sunil spoke, Rima, I think financials is definitely an area we're seeing a lot more interest, both on the banking and non-banking side, surprisingly. And again, it's for the reasons that he mentioned earlier. I think the credit growth is picking up. We were also, I think, just coming out of a few years of cleanup on the NPA side. So the sector is actually in a good place and in a much better place, I would have said, than if this crisis had happened a year ago. It would have been a different story. But now the sector is actually in a much better fundamental space. So I think banking, financials is definitely a place that we're seeing interest. But also smaller mid-cap names, which have been, again, out of favor from a foreign perspective for a while, where there are compounding stories, sustainable earnings stories, we're definitely seeing interest. There's a lot of questions around what's going to happen around energy security. What is India doing on renewables? Will you fire up thermal? Will you fire up nuclear? So there's definitely a lot of interest around energy security as a theme and renewables as a theme. So definitely in areas of interest there.
Divya, you'll also believe as a house that the AI theme has still a lot more legs to go. How long do you think this can run? Can it run for another 1 year? We're talking about 3 years, because that in a way determines India's relative performance. What is your own view, or the emerging market view at UBS? Divya?
Yeah, so let me sure, let me take that. So I think the way we would look at it is that the timeline or looking at when this trade ends essentially depends on when the revenue monetization hope for the US hyperscalers disappears, right? I think there is some level of monetization that's happening today. Not a whole lot, but it is picking up. Every new model release that comes out and disrupts a particular industry, like we've seen the legal industry being disrupted, consulting industry, and so on. Every new model release that comes out is basically a motivation for those model developers and the infrastructure providers behind them that there is revenue to be made. As long as that hope is there, I think money will continue to flow into those markets. Now, at the end of the day, keep in mind that the entire AI value chain from the hyperscalers to the providers at the semiconductor providers on the upstream, they're actually making, as a group, a lot of free cash flow. So they're not burning money in the traditional sense. They're not. It's very different from the dot-com period when the cable make companies were investing a lot of money, getting into a lot of debt, and so on. That's not the situation. So that basically means that this could have some room to go. The opposite scenario, which would be relatively positive from the Indian market's perspective, would be if the very quickly these companies realize that the revenue upside is just not there. People are not willing to pay, and the token budgets are getting exhausted, but the token costs are not coming down. The unit costs are not coming down, just like technology costs normally fall, and hence there is a big challenge in revenue monetization. I think that's what I would watch out for. Right now, it seems like they are making decent FCF as an ecosystem, and that should give them some room to continue with this.
Well, interesting point there. Hold that thought. We're going to take a quick commercial break here. Come right back and continue this discussion.
Breakdown.
Welcome back. We are in conversation with Divya Nagarajan and Sunil Thirumalai of UBS. The UBS Asian Investment Conference kicked off in Hong Kong today, and we are talking to them about all things investing, particularly with regards to where India finds its place in this big AI boom, which is underway globally. AI boom in India is not a prerequisite for markets to do well, but let me flip that. Is a AI sell-off elsewhere a prerequisite for foreigners to come back in a large way to India?
So to a large extent, global equities are kind of geared up and leveraged to this AI trade. So if you're talking about a serious unwind, that would be bad for equities globally, right? So you could see a relative outperformance of India, but I'm not sure we can be very confident of India having big upside.
It's not my case that we see a global sell-off in India is up, but generally, relatively, we'll stop talking about this for a bit. We'll start talking about, the good old, all the sectors that there are top sectors here. That's what I meant.
But I would just add at the starting of the of this question you mentioned about the AI trade not being there in India. India can still benefit if AI diffusion and adoption happens 100%. At an economy level. It's a very solid 5-year story. And hence those things will start showing up in our market in other sectors over time. But I just want to point that out.
Yeah, no, 100%. Divya, so run us through, so banks is one, right? You said that energy securities comes up, and I think you've got positive views on names like ONGC and some of the others there. So just talk to us about where to kind of which are pockets you'd pick out and sort of look deeper, study more for ideas.
So I think there are two parts of this conversation, right? The here and now versus what happens if the conflict drags on. So let's leave the conflict dragging on situation aside for now. So I think banks we've talked about, energy security we've talked about. Actually, if you look at the consumption stories, I think consumption's also been picking up. I think if you look at the consumer sector, especially the big staples names have actually done pretty well compared to our expectations. So that's another bright spot right now, assuming that that story doesn't get derailed. But I would argue that if inflation comes back, then some of these big, large consumer names could be a little bit more resilient. We also like the short cycle industrials because there's been inventory replenishment, and I think we're seeing that inventory ordering pick up. And that's, I think, a place that we like as well. Long cycle capex could get pushed out more because we have uncertainty going on, but I think the short cycle industrial capex is where we expect to see continued positivity. The last place I would also say is defense. I think we are in an increasingly uncertain multipolar world, so I think that continues to be a secular area of spend for governments across the world, and the Indian government, I think, is no different there.
And Divya, on IT, not in the near term. In the near term, the market narrative is very simply put that Indian IT is an AI loser. But we've seen the Indian IT industry navigate through various technological changes. And if, as Sunil said, that AI diffusion takes place, then and AI adoption picks up, maybe the Indian IT companies do have a role to play. Which side would you bet on, Indian IT over the medium term, valuations aside, just purely on the basis of a business case, on the kind of growth numbers that we have on account of AI 3 to 5 years down the line? Would you be bullish or bearish on IT?
That's essentially taking a call on whether generative AI succeeds on its promise or not and how it plays out. But I think taking a balanced view here, I would say that the companies are much more faster this time around in preparing themselves and disrupting themselves. So you have many large companies have already started reporting AI revenues. So you can see how they're investing in it, how those revenues have started to grow. We're seeing very healthy double-digit QOQ growth in what these companies report as AI revenue. That being said, there will be some disruption on the existing base, which I think will have some impact over the near term. But overall, I think the companies are definitely preparing themselves to see how they can stave off being disrupted to the extent that they can. The caveat here is the technology itself, because the technology, as I said to you when I was there last, is still very young. And as the technology evolves, I think its capabilities seem to be evolving by leaps and bounds. And that, I think, adds a little bit of uncertainty to the level of preparedness that the industry can have on this. So net-net, I would say we are slightly cautious and we like the smaller names because I think they're a little bit more nimble and agile compared to the large caps.
Sunil, say the same. I mean, I just want feedback from foreigners on IT. What do you hear? IT services in India.
I think that's a uniformly negative view right now from a foreign investor perspective. Sorry, Sunil, go ahead.
Yeah, I would agree. It's generally negative, and I think there's also a lot of people are looking forward to just the IT companies themselves messaging and clarifying what their strategy is better. And I think that would really help if over the next, let's say, 1 or 2 quarters, their own strategies are more clearer and put out there. But yeah, I mean, I think there is a lot of skepticism.
Divya, at a slightly high level, I mean, if you pull back a little bit, right, with if AI really is going to change the world, I mean, we thought technology will change the world. Now AI will change the world. AI technology did change the world. So if there's generally, we don't know, right? I mean, it's a debate. Will it create more well-paying jobs? Will it sort of create? What will it do to effective demand? Right, demand at a certain price point in countries like India. Is that a question which comes up at all? I mean, it's a question which everyone is there somewhere, but no one is really sure how to answer it or how to frame it. Divya, if you can take that.
So let's look at the bull case, right? The bull case is that the IT outsourcing exports. It's not just the Indian companies anymore. We have these big global GCCs that also export IT services from India. if that story remains intact, we don't have to worry about consumption. The sector adjusts, there's a short-term blip, and then we move on. And then the India story, the consumption story, everything continues. If you go to the other end, the scenario there is that if it disrupts jobs, and the white-collar jobs in India are largely concentrated around some of these sectors, then what happens to the ripple effect on the overall economy? Then you could have second-order, third-order impact. So I would say these are the two ends of the outcome. We would hope that we end up towards the positive end of the spectrum, where the industry and the export services say adjusts, and therefore we find some way. Sunil, I think please feel free to jump in. But we've also seen how India's leapfrogged technological advances and moved. Like, for instance, I never had a landline because we moved around a lot, and then we went straight into mobile phones and mobile payments and everything else. Could we have something like that benefit India? Could AI actually end up being a benefit for India, where we leapfrog certain parts of our evolution?
Yeah.
I think that's an interesting question as well.
No, I think that's Sunil, if you want to come in. I was talking to someone in a top consulting firm who consults in the digital AI kind of adoption thing. His perspective was there's a lot of FOMO right now as well, especially if you're listed. What is your AI strategy? What are you doing? So maybe that, but it's real, but there's also some level of FOMO. But yeah, Sunil, jump in if you want to.
I mean, if I may quickly add, I don't think we have the kind of confidence or visibility that we'll get into a situation where large corporations suddenly come around and say, I'm firing 90% of my staff. No, I don't think that's so that economic disaster where there are no jobs and companies are just focusing on cutting down staff. I mean, that's a very, very far away, low probability event where we stand right now. What is more likely is that companies use the available AI tools and the upcoming AI tools to become slightly more productive. Cost of delivery of products or services to their customers comes down, and hence their addressable markets go up. That's how I'm thinking about it, at the moment, because that's what is visible right now. That's what we are seeing, within the companies that we study or within our own organization. But I don't think we should, start factoring in situations where, 90% of white collar staff in India will get fired and, it'll all be done by AI. No, I don't think that level of confidence we have on the technology right now today.
Divya, you just briefly spoke about consumption. I wanted to understand about how you approach gold as an asset class, and also in terms of theme. Some of the jewelry stocks, they pulled back because of those duties that were imposed. But otherwise, the gold appeal seems to be quite strong. So your take?
Well, I don't claim to be an expert on gold. I think India has always been a gold-hungry country. But I think the gold is also, as long as there is uncertainty around what the Fed is going to do, I think the gold prices will remain volatile. That's our house view. I think Bhanu Bhaveja, our strategist, when he was here, and I will quote him, he said gold could have, we've seen a lot of volatility and a spike up in the last few months on gold on all these concerns. But we do think there's some upside left, but in the short term, I think the uncertainty around interest rate hikes in the US will keep gold volatile as well.
So Divya, my question was on the jewelry stocks. Do you believe that they fall well into this consumption basket? Some of them are not very, very cheap. The largest player in there, which is Titan. And the other ones, at some point of time, they're given a bit of a heartache. So your view on the stocks?
So I think it's, as you correctly said, very stock specific. There are some that are well-managed companies and have navigated gold prices very well. And there are others who are still kind of finding their feet in terms of managing those idiosyncrasies. So I think it's going to be very company specific there.
Sunil, if the war comes to an end tomorrow, do you think the Indian markets rally hard? Will foreign investors, because energy security is one of India's vulnerable points. So if the war comes to an end, what kind of upside do you see immediately in the markets?
There will be an upside, yes, of course. But I would go back and see how much has the market actually fallen since February 26th. When we had no clue that this war is going to happen, right? So I'm not sure if anything beyond a 4-5% kind of a upside, based on this. Then you come back to fundamentals. Then you come back to relative earnings growth. India versus other markets, and within India which sectors and so on. So it is definitely a good sentiment positive, but I don't think. Just like tariffs last year, which was a big headline news, but the markets largely shrugged it off. I think that's been what we've seen in the markets across global markets when it comes to oil price impact as well. So yeah, that will be a positive, movement, of course, but I don't think it'll be a whole lot.
Divya and Sunil, when are we seeing the first AI agent sectoral researcher at one of the sell-side firms? Will it be in UBS? At UBS, I'm sure there is one already somewhere. Divya?
Well, I think the way I would think about it, not to alarm any of our population or sell-side brethren, I think it is definitely a good helper. I think it can definitely help us kind of get to the market faster. And I think we do at UBS have a lot of programs that help analysts kind of publish faster, respond to market reactions faster. And we also have AI avatars. So the next time, hopefully, my avatar is speaking to you and not me. But that being said, I think for regulatory and for whatever logical reasons, I think I would like to hope that human brains don't get replaced, and therefore our analyst community and our sell-side brethren, I think, can rest in peace that there is the human value and the logic that we bring that still continues to be accelerated by AI rather than replaced by AI.
When I heard that rest in peace, no, but point taken. I hope we're all here, a year from now, and you sort of join us for the next leg of the conference next year. Thank you very much. Great start, and wish you all the best of luck at the UBS Asia Investor Conference. Thank you for joining us.
Thank you.
The shock.
We have with us a very special guest, the chairman of the Vedanta Group, Mr. Anil Agarwal himself. Mr. Agarwal, a busy day. Glad you could take out time to join us on CNBC TV 18. Let me first talk about the one issue that's been on all of our minds, demerger. This was a big issue on the agenda. You seem to have finally crossed that threshold. Tell us one question that we're all asking. What's next?
Thank you very much for inviting me. CNBC is my favorite channel.
Glad to hear that, sir.
Board. Very nice. We have grown in our natural resources, since I left Bihar till now, I only looked at below the ground. So we have developed very beautiful business, and it was very important to each business is so good, so that can be by itself, Vedanta by itself. So we have demerger has already happened. I'm thankful to all the regulator or whoever was there and the court and everybody. So we have 4 big company. One is the Aluminum Vedanta Aluminum.
Sure.
Which is a phenomenal company. This will be world largest company in the private sector. We started with the 1 lakh ton of aluminum production from Bharat Aluminum. Now we are producing 30 lakh ton and going to produce in 3 years' time 60 lakhs ton. The lowest cost of producer. That story doesn't end there. We will create 1,000 industry downstream. We are creating an industrial park because aluminum users are tremendous. So all the downstream 1,000 industry will be developed, so people will come and set up the industry, and we'll support them in every respect. Then we have oil and gas. Oil and gas, my heart and soul is there. India has tremendous reserve and of oil and gas, hydrocarbon, and we were the only people in India producing oil in private sector. It was not an easy job. We are looking for producing 500,000 barrel to spend $5 billion in 3 years' time, 3 to 5 years' time, to produce 500,000 barrel at the lowest cost. We will have producing sweet crude. We have a complete pipeline. We have every kind of opportunity. We have a tight oil. I have a shale gas. I have a shallow water. I have a deep water. I have a big block in the Assam northeast where the first oil was produced. We are in the process. We are looking for government to give us a lease, long lease. So we are comfortable because then we can make a big investment.
Okay.
So aluminum, oil and gas, power. Power is very, very important. At the moment, our power company produce about 4,000 megawatt, going to produce 20,000 megawatt. For that, all brownfield. All brownfield. We are looking forward. One of the best company. We have all coal linkage. Coal is not going anywhere, and we should be very proud of our coal. Coal, we have coal. What India has is sulfur-free, and I have always been advocating that coal is not going anywhere. We are a poor country. We are going to make sure environmentally we 100% take care of that. But we will make a power company about 20,000 megawatt power plant. That's what we are looking at. We have a iron and steel company, which is a phenomenal company. It is around Tata Steel, Bokaro Steel. It has infrastructure. We have a gas pipeline to produce 15 million ton of steel. At the moment, we are producing 3 million ton. We have another million ton in Goa, so 4 million ton we are producing. And we are going to produce 15 million ton, all green steel, electrical steel, or special steel. So we are the largest producer of iron ore. We will 100% backup of coke and the iron ore. So looking forward, this steel company still has a great demand in India. And then we have Vedanta Limited, which will have Africa largest zinc company. Very, very, very proud of having a zinc company. We have a 65% of Hindustan zinc. We have a FACOR, which make we also critical materials. So this is a Vedanta Limited. again, very flagship company. So these are the company demerger. All the share will be in the process of issuing. By next month, all these 4 companies will trade by themselves. It will have a very strong management. And this will be company which is what we require in natural resources in India. And we will proceed in that direction.
I don't want to come in there in the middle, but that's an important clarification that you're giving. Can we take it as a confirmation that perhaps by next month we'll see these individual demerged entities also being listed?
Absolutely. By next month, all the individual entity will be listed.
That's fantastic. You've given us a very comprehensive roadmap about how each of these companies in their individual spaces can grow up to be bellwethers. You talked about subject to support from the government, you're looking to make big investments. So tell us, can you give us some glide path, some indication as to what is the kind of capex that you're looking at, say, over the next 3 to 5 years?
They're looking to spend about $20 billion. And we have a very good internal profit generation in the company. Internal accruals are very, very good. Some equity, some debt we might have to take, but $20 billion investment will be there, and probably we will increase our production by 2.5 times of everything.
But you're saying mostly through internal accruals. Any numbers that your team has run by you?
No, we will be having about $10 billion EBITDA.
Okay.
$10 billion EBITDA. So I don't know that financial detail, but I was not ready. But $20 billion we spend. Fund will never come on the way. Government is with us, and this all will be India. And by this, I'm looking forward at least 5,000 downstream industry to come in with our product. For me, most important, which gives me joy, to develop the downstream industry.
Exposed to
You've talked about previously, we've heard you speaking when you say that Make in India push has been very good. It's yielded results when it comes to smartphones, electronics, even the defense sector has done very well in terms of indigenization. But that you classify as above ground Make in India. The question that you asked previously is, what about below ground Make in India? Again, tell us, is there a need for perhaps a Make in India push even for below ground resources that you manage?
What we're talking at is self-certification, what government... I'm very thankful to Prime Minister Modi, Amit Shah ji. They always think how the business can be developed, the employment can be developed. And what we are looking at, simple policy, trust-based policy, trust-based and court also has to... What Indian courts are there is worldwide, people are very proud of. It's very important. The time is the essence because India can't wait now. Time is the essence. All economic, whether it's a court, whether it's a regulator, more and more trust-based it be given. Entrepreneurs should be given a recognition. Manufacturing people must be given a recognition. You know, because they pay the highest tax. You will not believe every year I'm paying 60,000 crore tax. When I set up all this industry, I raised $35 billion abroad and brought the money here and invested all the money in all these companies. So these are the... And it's not me. Every individual is like me. Because we have the DNA of entrepreneurship.
Right.
We have a DNA of the women working very differently. So these things were being encouraged nowadays. Tremendous opportunity. We will, as far as Vedanta is concerned, we are very clear how we demerged identity will work. Very strong management. For me, it's a very inclusive.
Sure.
Because for me, last person working in my company, I cannot ignore him. He's also very, very important for me. And I'm very proud of my people and my team. We are ordinary people. Vedanta means what? Ordinary. But we deliver extraordinary result.
Well, you are anything but ordinary, Mr. Agarwal. But let me follow that up with another question that's close to your heart, what's on import substitution. I came across some very interesting numbers. We have an import bill of roughly around $800 billion. Half of that are below ground resources which we end up importing. So whether that's oil, gold, bauxite, for example. So we're talking about nearly $400 billion every year. What is the missing from our picture? Take oil, for example. We've not been able to build up capacity here within the country. What is the rationale? What's required from the private sector, from the government?
We have to be very, very careful of the world. World does not want us to produce. They want India to be a market. Middle East, all world they develop 2 hours away to supply into India. The Gold Council, they just want to supply to the gold, whether it's a copper. We have a tremendous bauxite. I just read in the newspaper, you know, the largest company has gone to Guinea to produce alumina. Why? India has the largest deposit and the best bauxite because we have to simplify our policy. Land is required, everything to be digital. Seller is ready, buyers are ready. We have to address I'm just thinking big way, is our system.
Okay.
System. Our bureaucrat officers are very qualified. They are most intelligent people, but they have to let go. They have to rethink inclusive. How do we recognize is very, very important. Your government companies, what is it called? All the government companies? Public sector. Public sector, very important. Government has to take a decision. Everything has to be privatized.
Okay.
Everything has to be privatized. No one person will be retrenched. I can see 5 times more production can come up. It is very important that we take decision. In fact, I'm for gold company, nothing producing, copper company. I'm ready to take challenge on anything. Let the parliament decide and trust. And I will do everything for my country. So, and the court. Courts are, judiciaries are very important. Time is the essence. We have no other in the world, the judiciary, what we have, nobody has. But for the, to take country forward, to create job, to develop the economy, is very important. The decision, we don't waste time, we move forward. Where else we'll find Prime Minister like Modi, Amit Shah, these people, what they have done in West Bengal. West Bengal was the hub for the industry. Hub for the industry, what they don't have. It is all, everything, Bihar, this, you talk about Assam, these things, what they are addressing now, will develop.
You spoke of reforms. I want to get in your reaction on one particular aspect. You've previously spoken of how this 50-year lease that we currently have is not quite working. We need a lifeline. As long as the life of the mine is, that should be the duration of the lease itself. Are you calling for a complete overhaul of the current mechanism that we have for auctioning, for allocation of mines, of resources, of natural resources?
Beautiful question. No, government has all the powers. Give a long rope. What is this short leave, 50 years taking back? People will run away. Nowhere like this is in the world. You are unnecessarily hanging the short. Tata Steel, we will, huge plants are there. And then you make a policy that you'll take back the mine and you re-auction. Does it work? We have to come out with a long lease, whether it's oil, and there should be one policy below the ground. For the oil, you have a different policy, and for mineral, you have a different policy. Below the ground, simple policy. For us, only one objective. How do we stop import and start producing? And this can only produce by the private sector. It's very important. And public sector must be privatized.
Okay.
And the court must be very conscious that time is the essence, whatever it comes to, whether any NCLT or this, they're doing a fantastic job, but time is the essence.
Okay. Okay. You've mentioned privatization twice, so I'll just labor on that point. You talk about completely privatizing as far as all the PSUs are concerned. Will you be...
There can be exception. I'm saying generally. Because no democratic country government doesn't run the business.
So if the government were to take up on your suggestion, which is greater divestment, greater public sector assets put on the market, would you be in the market in line for perhaps some of these government assets?
My shop is open. I'm not going to go to hunt. But something comes to my shop. Any customer comes, any opportunity comes, for my shareholder, I will look at.
Fair enough. Just a couple more questions, Mr. Agarwal. One question is that you've talked a great deal about privatization. You've talked a great deal about regulatory reforms. One low-hanging fruit, to your mind, that you will recommend to the government can be put into action as early as tomorrow. What would that recommendation be?
Anything which we are importing.
Okay.
Anything which we are importing, and there is a black and white, there is nothing left. What entrepreneur can do, we have proven from, one example is Bharat Aluminium. One example is Hindustan Zinc. There are only two companies I have taken. Anything, and if you see the privatization of the airport has happened, privatization of anything, then you have trust. I really salute all my industry. They were from where to where, whether it was a telecom, whether it's airport, airline, any steel production, anything you entrusted to the or corporation, whoever trusted, they have delivered.
Sure. That brings me to my one final question. I'll end you by asking, we're living in tumultuous times. There's geopolitical sensitivities. There are factors, some beyond our control, some in our control. With all of these multiple moving parts, one commodity that you're bullish on for perhaps the next decade or so?
I'm very bullish on aluminium, copper, oil and gas. All three critical metal, very, very important. And fourth is, we can be the largest producer of arm and ammunition. The kind of factory we have, massive, if they can be modernized and privatized, we will be the largest producer of today's digital technology given. But we have to be, Parliament has to be together. Everybody has to be together, one way, one goal, to make sure that we will produce arm and ammunition here. And we run our, whatever strength we have, we leverage that 100%.
Fair enough, Mr. Agarwal. We'd like to thank you for joining us, for sharing time with CNBC TV 18. You've given a lot of insight as to the recommendations for the government, but clearly close to your heart, import substitution, and of course, perhaps some form of regulatory changes as well. Mr. Agarwal, we'd like to thank you for joining us and sharing time with our viewers right here on CNBC TV 18.
Thank you very much.
to what.
Try not to be.
Now the real question is, where does that come from? Is that a level of insecurity?
I was talking about it with my shrink yesterday.
Was it insecurity? It's always insecurity.
Otherwise known as Claude.
Yeah, otherwise known as Claude.
Life is binary. Self-esteem, insecurity.
Scott.
Self-esteem, insecurity. That's the morning message.
All right.
Gary, thank you. What was your friend's name again?
Greg DiTomaso.
Greg, we want to thank you.
Thanks,
and
Greg.
you know what? I feel you. I just want him to know that.
Is that because you're a Golden State Warriors fan?
No, because I was a Knicks fan, but when Jordan was Jordan, there was a reason.
He was a bandwagon fan.
There was a reason to be a fan.
I'm out of here. That's Andrew. I've always liked him, but that hurt. That's wrong, bro.
There is
Coming up, a new round of U.S. strikes on Iran as Tehran says it's targeting an American base in the Gulf region. Former White House senior advisor in the Biden administration, Amos Hochstein, will tell us what this will mean for negotiations and reopening the Strait of Hormuz. Kwak returns in just a moment. Crude prices moving higher this morning, back above $90. WTI up 3% now after some new U.S. strikes on Iran overnight. Joining us now, Amos Hochstein, TWG Global Managing Partner. He's a former White House senior advisor in the Biden administration. Amos, it's good to see you this morning.
Good to see you, too.
I'm going to look at two polar opposites. If President Trump got everything he wanted, and it all came true, everybody signing on to the Abraham Accords, no nuclear material left in Iran of the enriched material. Iran not controlling the Strait of Hormuz since it's in international waters. If all those happen, all those things, it would be amazing. On the other hand, Iran seems to say it's going to continue to control the Strait, not going to hand over any of the nuclear material, and wants sanctions relief, and wants billions of dollars that's frozen right now, and once that freed up, along with war reparations. They don't even seem like we're in the same universe in terms of where we are. Is there something we're missing? Are there moderates in Iran that aren't entrenched way over on that side, Amos, that we're talking to?
So I think you're right in describing the picture as this binary statements coming out of the two sides, which is why those two are not even nobody's negotiating those issues at all. The only thing that's being negotiated right now is an MOU that will open the straits and give a time horizon where we negotiate all these tough issues of the enriched uranium that's already, right, the stockpile of enriched uranium, the future of enrichment, et cetera. And right now we're only negotiating essentially what will it cost the United States, what would we have to give Iran to open the straits, kind of an open for open. So we went into a war, we fought a war, we're now negotiating over the opening of the Strait of Hormuz, which was open before the war, in order to give us space to negotiate the other issues. Because you're right, the claims that we're making on the U.S. government side, the public claims, which is not what the U.S. government is claiming in the negotiating room as a position, don't even match the reality of where the Iranians' public statements are. My experience is that normally whatever we're saying publicly is not exactly the posture in the room. The problem here is that President Trump is elevating the publicity of it, and therefore it gets very hard to negotiate an outcome against public expectations.
You have not been a rabid critic of the whole thing. I think you're hopeful that this could end up being a positive for maybe for the region and maybe for the United States. Is that fair to say, Amos, or are you disconsolate and pessimistic?
Look, Joe, as you said, I try to be, the bottom line, I get criticized from the far left and the far right. The bottom line is this: I'm on Team America. I'm always on Team America, regardless of who the president is. It's not a secret I'm not a fan of President Trump's. It's not a secret that I thought that we should not have gone to this war, and that really, I still don't understand why we entered the war. I'm confused as I was in February. Having said that, I'm Team America. I want us to win. Whenever we do something, I want it to have good outcomes, and I believe Iran is a horrific regime that has hundreds of thousands of people's blood on their hands. I want this to be a good outcome. I just don't understand this process that we're in. I don't think we're going in a good direction. And I think there's an irony here. Wall Street wants the war to end, but the reason the war is not ending is because of Wall Street, right? I mean, that's the irony that's the reality. Wall Street wants to believe that President Trump is saying is right, that we are on the precipice of a deal any second, which is why oil prices have dropped, despite the fact that the data is coming out that on like gasoline inventories are drawing to the place where they soon won't be able to draw. Our entire U.S. economy is now based on inventories, but inventories are finite. They end at some point. And we're getting to that point, as I said on your show a few weeks ago, by the middle of June, we get towards that cliff, maybe the end of June, but not beyond that, right? The inventories are coming down every single week. The API data yesterday, the EIA will have data today at noon that will show more inventory draws, which means we're already 5% below, more than 5% below the 5-year average, which means we're going down to a point where we can't do that anymore. And then this buffer that we've been living through goes away. Now, I think it's incredibly important to reach a deal before all of that happens, where we still have the leverage is kind of equal. Both sides have leverage. At some point, that could switch, where the leverage goes to the Iranian side without us having a matching leverage, except for the huge leverage of the U.S. military and going back to strikes. That's how I see the situation now.
The two situations I described at the top, on a Venn we use Venn diagram a lot. I don't know. It always seems to, when you're trying to, because nothing. I guess in this country right now, there's no overlap on anything, so we're constantly saying it. So there wasn't a whole lot of overlap on those two scenarios. But, Amos, if you're a total optimist and believe the president in what he's saying, and if that were to come to pass, all those things, all the things that I checked off, you would have to go back and say, I was wrong, right? This was worth doing. It was. The Strait's now open. They don't have the nuclear stuff anymore. Abraham Accords, the whole region is changing. You'd have to shake your head and say, wow, he did it. And I guess you're just saying you think that's not a very likely scenario. What do you put that at, 10 or 20%?
I think that's well below 10%.
Well below
that
10%.
Scenario. Well below 10%, because I think that no matter what happens, Joe, the Iranians will control the Strait of Hormuz for the foreseeable future. It doesn't even matter what the deal says. And everybody in the region believes that. Trust me, I've been to the region. I spoke to the leadership in the region. They all know that. We will negotiate over how much control they have physically. But even if they say we're not charging a toll and so on, they're already there. And that's why you're seeing the build out of infrastructure away from it.
If the midterms weren't coming up, this would be as good a time as any to just take that off the table permanently, because they should not be able to control what's happening there for the global economy in international waters. And sooner or later, somebody probably needed to go in and just end that situation. You're sort of just resigned.
But Joe, we can't. There are limits to our military power and abilities.
But are there? If you were going
hold on,
war,
Joe. You're right. If we want to go in and take over the country of Iran, but we're not going to do that. It was a bad experience in Iraq. We're not going to do it here, and this is a far bigger country. So
I know.
we should enter conflict so we can win. And I think this one, I see it as a very low likelihood of your scenario, your fantasy scenario. Right. The more realistic one is complicated. And again, I say we're several weeks away from where the economic issues start affecting us in a fairly
significant way. The worst case, almost, you're right, is it something that looks like what we had, which was terrible, the JCPOA or something like that. That's the worst. If we
Joe, that's
end
the
up with
likeliest. That's the likeliest scenario.
Well, that's depressing. All right, Amos, you're big downer. Good to have you. Yeah, good to have you on. Look at that smile. God, you're beautiful.
Realistic or optimistic, those are all different things.
I know. Look at this. You know what this is? It's my water. It's half full. Always. See you later. Thank you.
Coming up, we have some big data on the way, jobless claims, the latest read on GDP, and personal income and spending, all coming up at 8:30 Eastern Time. So we have to a break. Check out these retail movers. We got Best Buy, Kohl's, and Dollar Tree all out with better than expected quarterly results, and those stocks on the move this morning in a big way. We're coming right back.
news in the last hour. Fertitta Entertainment reaching a deal to buy Caesars Entertainment for $31 a share in cash. Tillman Fertitta's company owns the Golden Nugget Hotel and Casinos, Landry's restaurant chain, and, of course, the NBA's Houston Rockets. You can see shares of Caesars are up by about 1.5%, 1.6%. It is a $5.7 billion they are paying in cash, $5.7 billion deal that they're paying for in cash. When we come back, the push to regulate prediction markets like sports gambling. The head of the American Gaming Association will tell us why he's challenging the CFTC's authority. He's calling it a rogue agency when it comes to monitoring these markets. He will join us. Regulate the firms as sports books or casinos. Joining us right now to talk more about it is the American Gaming Association's president and CEO, Bill Miller. And Bill, things are getting pretty heated here to the point that you've had some pretty harsh fighting words for the agency. You're calling them a rogue agency at this point.
Well, first of all, Becky, thank you for having me on this morning. I think one thing that's really important is to say this, that, we absolutely share President Trump's view that America should be the crypto capital of the world. We also believe that the CFTC has an important role to play in the financial space, in and around commodities, precious metals, and other things. Where we differ strongly is the belief that, the CFTC is enabling these prediction markets to operate national sports books with very little to no regulatory oversight.
You're saying, though, that when it comes to sports, these prediction markets aren't futures contracts. You think it's just straight up sports gambling?
Absolutely. You had the CEO, Charles Schwab, on the CNBC Squawk Box a few months ago, and he said, look, one thing I'm really worried about is that young investors believe that they can have a prediction market account alongside their 401k and their stock trading account. And he thinks that, and I think that, and we think that that is incredibly reckless and dangerous.
What's the reaction that you've gotten when you've spoken with the CFTC? I assume you've gone to them with some of these issues?
Well, I think that we've certainly commented. The CFTC recently closed a comment period. The AGA weighed in then. We've weighed in previously when before the current chairman was in to express our concerns. And it's not just our concerns. We just had recently 41 attorneys general from around the country weighing in saying, CFTC, you play an important role in the nation's economy, but you're not the regulator of national sports books. 41 attorneys general. That's of every political stripe that there were in this country. And so I think that it's not about the AGA or the gaming industry. It's about states and tribes that are losing literally $1 billion today in state and tribal revenue that would otherwise go to fund important community projects and pay taxes to these states.
Yeah, let's talk a little bit about that number. That is an update that is just out today from you all, that $1 billion number. How do you come to that conclusion?
We have a very good methodology. It's really based around what we see in terms of where the sports betting markets are, and we know that there are, about 40 states in America that actually have legal sports betting. We also see that where the growth, the significant growth for these platforms, the Kalshis and Polymarkets and others, is in the states that don't have regulated and legal sports betting, like California, Florida, and Georgia. And so ours is an estimation based around analyzing both regulated and the unregulated and illegal markets today.
It's interesting. I remember a time when your organization represented the people who were seen as kind of out there pushing for more sports gambling to be legalized by the states. If you were somebody who opposed gambling, people probably looked at you as the ruffians who were out there in the mix of this. Now it feels like you all are getting disrupted to some extent by the new kids on the block with some of these things. My guess is you're not concerned about sports gambling. That's not what the fight is over. It's about the state's rights to legalize this versus others?
It's a great question, and honestly, we think about it's only been since May of 2018 when the Supreme Court struck down PASPA. It allowed the states to make determinations about whether or not they wanted to have sports betting in their states. States like Texas and Utah and Georgia have not yet made determinations, and yet these prediction markets are moving in against those states' will. Without any regard to what the policymakers in those states want. We're all for innovation, and I think that as an industry that's regulated, heavily regulated, 8,400 regulators in the state and tribal world, we're for innovation. We push for innovation, but we don't push for we're not pushing against innovators here. These are individuals. These companies are marketing themselves as financial investing tools when the reality is the vast majority of their business is sports betting, and they're seeking to avoid the actual regulation and licensure that our people do.
Bill, we just got the breaking news earlier this morning that Fertitta Entertainment is buying Caesars. What do you think about that and the potential for additional consolidation within the industry?
I think that, I've been in this job for about 7.5 years now. Certainly there have been times when there's been more consolidation. There's certainly been, private equity that's bought into the space. I think that this has been a deal that has been in the works for some period of time. And we're always seeing kind of expansion and consolidation in the industry. And so I think that, this is something that I think has been talked about for several months now, and good to see it come into fruition.
Do you think that the industry is more ripe for consolidation at this point because of what we're seeing, this disruption that's coming from places like Kalshi and Polymarket?
Well, I think that there's a real threat out here, and so what it means for consolidation is hard to say, but it is certainly something that again. When 41 state attorneys general write in with their significant concern about taking states' rights away and hurting these businesses that they regulate within their states, it's certainly a concern. And look, I had an opportunity last week to be a witness in front of the U.S. Senate Commerce Committee, and it didn't matter which side of the aisle you sat on. Every single United States senator, from Chairman Ted Cruz to ranking members, Republicans and Democrats, all said the same thing. These prediction markets are backdoor sports betting, and it is a significant concern of those members of the U.S. Senate.
Bill Miller. Bill, thank you for joining us.
No, thank you for having me.
By the way, folks, we want to disclose that CNBC and Kalshi have a commercial relationship that includes customer acquisition and a minority investment. All right, it is just after 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. Among our top stories this morning, oil prices rising as tensions escalate between the United States and Iran. You can see WTI up by about 3% to $91.41. Brent is up to $96.94. U.S. forces launched limited strikes on an Iranian military site and intercepted attack drones, while Iran claims that it targeted a U.S. airbase. Kuwait has also activated air defenses over what it calls hostile missile and drone threats. The CFTC is asking a judge to throw out a $5 million penalty against crypto exchange Gemini. Regulators now say that the firm founded by the Winklevoss twins should never have been accused of making false statements about its Bitcoin futures business. And shares of Dell Technologies jumping in the pre-market after the company won a $9.7 billion Pentagon contract. The 5-year deal will streamline Microsoft software licensing across the United States military.
Some new data out on auto loans as monthly payments keep climbing. I want to get straight over to Phil LeBeau. He joins us with the details. Phil.
Andrew, the amount we are borrowing to buy a new vehicle and the amount that we are on average paying every month, they're both at all-time highs. But what really stands out in the latest data from Q1 of about 5 million open auto loans is the percentage of those loans that include people paying at least $1,000 or more per month for their auto loan. How much has it increased? Take a look at this chart. This says it all. It was 18.9% of all auto loans in the first quarter where people had to pay at least $1,000. That's up compared to what, 5% 5 years ago? It's been a huge surge there. And if you think, well, it's a bunch of rich people buying high-end cars, the people at Experian have done crunched the numbers, and that's not the case.
The assumption is that it's all luxury. It's high line, it's luxury, and that is not the case. You don't get to a luxury make until you're like 13th or 14th down the ranking.
Well, if it's not luxury, who's spending $1,000 a month for an auto loan payment? Well, primarily it's people who are buying pickup trucks. Now, there may be some contractors in there, some small business owners, and they can write off some of that as a business expense, but there's clearly people who are spending a lot of money on full SUVs, mid-size SUVs, and pickup trucks. It's 75% of the auto loans with $1,000 or more monthly payment. By the way, the average monthly payment for all vehicles has now hit an all-time high of $770. As you take a look at GM, Ford, and Toyota, we should also point out that the average amount borrowed, no surprise here, as the amount of the price for vehicles continues to climb. The amount borrowed now is almost $44,000. Guys, that is also another record high.
Phil, want to thank you. Appreciate it.
Coming up, Blair Efron on AI and the tech trade, and then Aura's new ring. CEO Tom Hale is going to join us.
Joining us right now to do just that is Blair Efron. He is the co-founder of Centerview Partners. And Blair, thank you for coming in today.
Thank you. Thanks for having me.
It feels like there is activity kind of percolating in a lot of different industries. What are you seeing right now?
It remains busy. It's busy all year. You know, if you think about last year, we ended at $4.5 trillion, which was the second highest ever. Despite a little bit of a slowdown given the situation.
Because of the Iran war.
Iran, pricing of oil, obviously. It remains busy, and we'll probably end the year strongly, $4 trillion, and across most sectors.
You know, it actually surprises me that higher oil prices and what's happening in Iran would slow things down much when you are continuing to watch the indexes hit new highs every day.
So it is more the band of uncertainty has expanded, but also the band of resilience has grown. So again, we're seeing activity. Last week there was a big real estate deal, the biggest REIT deal ever. I think you will with 3 IPOs. When the IPO market's active, it always helps M&A. So I think we'll percolate through the year nicely.
What do you hear in terms of the IPO market? It also seems like a lot of people are kind of in a rush to hit while the markets are hot.
Becky, people are always in a rush when the markets are hot. Nothing unusual here. The bigger thing to me will be how much comfort these 3 deals get. And if they are getting the tailwind that we're all thinking about, it'll have an overall great effect for the markets generally. And the bigger question is going to be the economy longer term. We just think about 27. That's going to be really for the M&A business, the biggest determinant.
Are there issues where, you know, the CapEx, we were talking earlier this morning, the Conference Board has its latest issue that says CapEx spending, even though consumers or CEOs are worried about what's happening in the economy, they are continuing to make sure that they are spending on CapEx. It's almost required because of AI.
What strikes me on that is only 5% of CEOs recently polled said that they will lower CapEx from projections. The rest will raise. More importantly, you have $700 billion, which we all talk about, of CapEx coming from the big 4 hyperscalers. To put that in perspective, in 2021, we did a $1.2 trillion bipartisan infrastructure bill over 10 years, and we thought that was a huge tailwind. So the point is the tailwind here is substantial. The bigger question is going to be when and how much is the return on this investment. Like any time you see this, I'm betting investors will demand a return sooner than one might think.
We had one guest who told us earlier today that all that CapEx spending, when they worry about the economy and protecting their margins, means that they're buying less of their own shares in buybacks. I also wonder, you don't see that. Okay, that's what I wondered. Does it take away from other initiatives, from either hiring, from M&A activity, from buybacks?
So let's parse that out. The first quarter, you saw robust earnings. 2/3 of the S&P 500 surpassed estimates. I think you'll see that in the second quarter as well. Cash flow numbers as strong as ever. And the best companies are having the flexibility to invest in CapEx, give money back to shareholders, and think about M&A. And I think that's actually what's going on. So what is more to the point is by the time you get to the third quarter, I actually do think you'll start to see a little bit of a slowdown in this outsized earnings growth relative to estimates. Inflation will start working its way through. The margin question, last quarter, every company, basically, the average margin was up substantially. You wouldn't have expected that. It'll be the same this quarter. I think that's going to start to level out, and that will be interesting to me to see if the market can stay at 22 times PE once that happens.
AI question on a personal basis. We actually talked to Greg Fleming about this yesterday.
Greg is, I'm sure, very good with AI.
Well, no, but I assume that your firm is now using AI.
Aggressively.
Aggressively, okay. So are you finding that whatever you're spending on AI today is justified, meaning that when you look at the productivity gains of the employees that are on your staff, you're saying, wow, they're able to do 2x, 3x, 5x, whatever they were doing before, and therefore we're able to make 5x what we made before? Or are you saying that they're now able to go home earlier? What's the big distinction?
Andrew, that's the question of the day. I think for us, AI has been unalloyed positive. We look at it as a revenue-enhancing tool, not a productivity tool.
Okay.
If I can free up 20, 30% of our colleagues to focus on more strategic, more client-oriented, more higher-margin business, that's a good thing, number one. Number two,
the level of analysis, when done right, frankly, blows me away. Now, you're talking to somebody who still likes an abacus, but when I see my younger colleagues show me analysis, and I said, this must have taken me 3 weeks. No, a couple hours.
Right.
And it's great analysis. So if you look at a firm like ours, you look at law firms, you look at banking firms generally, I think we'll be using it differently than how companies are using it. I will tell you that the rate of uptake, the rate of adoption among companies, I think is slower than people think if you are not tech native.
Does it mean you're freeing up these workers to do other bigger thought processes that bring in more revenue? Does it mean you're slowing your hiring?
I do think there is this question of hire and freeze. I do think the numbers are slowing down, but let's put it in perspective. Over the past 2 months, the most recent data says there are 100,000 jobs lost to AI, yet the past 2 months, employment, 140,000 on average. So what you really need is an economy to keep growing. Every 1% of GDP is 1 million jobs. That's the key. Now, is there a dislocation? Becky, we're all concerned about that, and I think there needs to be a deep national agenda and conversation about what we're going to do to reskill and take care of people during this period of dislocation.
Hey, Blair, I imagine a certain percentage of your job is hand-holding for your clients to try
Certain
to make...
percentage?
Yeah. What percentage of your job is hand-holding?
I would say hand-holding.
Well, making them feel better as...
I think a big part of my job is to be a sounding board to really talented CEOs who, for the most part, know what they want to do, or they have a choice A versus B, and you're debating and batting around the idea. So it's not necessarily hand-holding. It is a voice for the executive to bounce things off of.
What are the issues that are getting bounced off of you right now? What are the top issues?
I think the top issue is how much money to put into AI and still get the return, to Andrew's question. Second issue is this question of this is the time of year you start making business plans for next year. Do I look at GDP growth? Last year, this time, CEOs were saying for the most 2.5% growth. It's been dialed back to 1.5%. I'm starting to hear a lot about 2027 as a big issue, and I do see a level of caution coming into the 27 projections.
Okay, good to know. Blair, thank you.
You guys are great. Thank you.
Great to see you. Thank you. Coming up, don't go anywhere. Don't go anywhere. Or out with a new product. CEO Tom Hale joins us next. We'll talk to him in just a little bit. Thanks.
Back to 85.
OR5. It's smaller than its predecessor, offers more users more features. And joining us right now is Aura CEO Tom Hale. And just the last week, the company made CNBC's annual Disruptor 50 list. It also, and maybe importantly, I don't know if he can talk about it, I don't think he can, filed confidentially for an IPO after all of this time. I was going back to look, Tom. I've got data on my ring from back to 2017. So I don't know. I feel like I've been tracking this for a long time. My readiness note today is in the 70s. So I don't know. What's your readiness right now, Tom?
92, even though 92. I'm up early. I got 92. Yeah. Solid day. Big day for us. Big day for the company. And we appreciate you being an OG of Aura, Andrew. You've been an incredible supporter.
So tell us about the new ring. I've been begging you, as you know, I think since we first met, when can I get a smaller ring, a thinner ring? When can the battery be longer? I think this is finally that.
We have finally achieved, I think, what seems like a real technological miracle. And just for comparison, if you can see these two rings, the one here, this is OR5. It is tiny. This is the current OR4 ceramic. And you can just look at the difference. These rings are the same size. They're both my size 10. And you can just see the difference between the two. This is 40% smaller by volume. It is the world's smallest smart ring. This is what our members have been asking us for years. And by the way, this was a hard technical challenge. There's sort of laws of physics involved with the sizes of batteries. There's the ability to pack all the electronics, the sensors. The geometry is different because it's so small. We've really upgraded this product to be what people have been asking for. Now, the thing is we've also rebuilt the sensor architecture with larger and smarter LEDs for more precise research-grade accuracy. The whole thing is made of aerospace-grade titanium. It's fully waterproof with 1-week battery life. And there are new finishes that are even harder. I will tell you something. I've been wearing this ring for 6 months with a cover. I've been going to the gym and working out with this ring and not even feeling it on my body. And that is the first step, I think, in building something which is truly a transformative wearable.
Okay, so hold on. Now we're just talking about this. Only people who have an Aura will know what we're about to talk about. If you work out with the ring, so I don't work out with the ring on because I've ruined my rings over the years. I've scraped them up, scratched them up. It hurts, all of that. Why would that not happen this time?
So two things. One is we've introduced an even harder treatment that's the cover of the outside of the ring, which is what gives it its distinctive look and feel. I wear it actually with a cover. Obviously, I couldn't wear an Aura Ring 5 out in the public without people noticing it, but I would wear it with a cover. And so you can get a small silicone cover that costs like 99 cents on Amazon, and it protects the ring from any damage. But sometimes when I work out at home, I would actually wear it without a cover, and I haven't been able to scratch it. So it's quite comfortable. It's quite small. Now, the thing is that this is big news for such. What we've really done this time with OR5 is really introduced a bunch of new software capabilities. And I think this is the first time that we can credibly say that we're closing the loop between data and real medical care. There's a whole set of features in this release that are software features. The first, of course, is our Aura Advisor, which is taking a huge step up in terms of the kinds of things that it can do. We're introducing a partnership with licensed physicians on demand through a partner that we work with called Counsel Health. They provide a clinical grade AI, so you can ask the AI all sorts of questions about your health, about your Aura data, how we can import your health records into it and understand what's going on with all of your biomarkers. Of course, we do CGMs, we do blood tests. But if you want to, you can escalate to a clinician. An actual doctor will come online and answer questions. And this is the idea. The idea is that the ring might notice something. Many people who use Aura know about something called Health Radar. Health Radar is the way that we start to look at what's going on in your physiology, and then we tell you about it. We tell you you're getting sick in a couple of days, or that you might be, maybe you have a risk of hypertension, or maybe you have a risk of sleep apnea, and we can escalate you directly to a doctor. The ring notices you, and then Aura can step in and help. We can help you get the
I can crazily tell people, and these guys know because I think we've talked about it. I've come in here in the morning on the show, and my symptom radar is like either medium or high or something, and then of course 2 days later, I get sick. So
2 days later, yeah, on the couch.
It's insane. My question to you: you compete with Whoop, obviously that's the biggie. Google's getting into this business in a big way with its own product on the wrist, not a ring. Samsung's obviously in the business on the ring. How do you see, and then obviously there's Apple Watch and others. How do you see this long term in terms of where you guys are relative to where everybody else is? The other thing I was going to say is live activity. I saw a note that you're able to actually track your heart rate live for the first time. That was something I used to use, like a Polar for working out, because that was something that this ring did not do.
That's right. So I think the way to think about this is that this release for us really marks this transition beyond the ring and beyond the device. I think many people have thought of Oura as a ring company or as a sleep company. And the truth is we're completely a horizontal health intelligence platform. So we're taking you beyond the device. We want to give you a complete picture of your personal health, whether that's fitness, your longevity, any chronic disease you might be managing. And of course, we want to help women, in many cases, get pregnant. I have people stop me in the airport and say, Oura Ring got me pregnant. So this whole sort of suite of health capabilities, I think that's where this is all heading. And this marks, I think, a big moment. This tiny, tiny ring, but is really supported by an enormous and powerful software platform, is really transforming us from kind of like just a wearables company to really a health platform company. And I think we're introducing features to support that. We talked about Health Radar. We talk about something that is really exciting for us, but in the world, people are using GLP-1s all the time. And this software release includes GLP-1 insights that bring together information about your dosing, your side effects, your weight, your key Oura biometrics in one longitudinal view. So as you come onto the drug or come off the drug, we're giving you the support that you need. And Andrew, I think you're going to love this one. One of the features that we're launching into labs is something called Brain Health Study. And it's basically a way for you to assess your cognitive health on a day-to-day basis. And so if you think about it, if you have a low sleep score, you can take this little brain health test and you can understand if your cognition is actually at par, above par, or below par. And I think this is a really powerful thing because, of course, you all know this, but sleep is one of the foundational elements in giving you cognition. So we want to give you this picture of your full health. And I think this marks a transition from us just being a device to a health platform. Now, what's important about that is what does that mean for everybody else, our competition? I think we have been on a tear. We have grown this business massively in the last couple of years. We've 4x'd our member base in the last 2 years. We have 5 million members, and that's growing. 80% of our members renew after their retention tells you. That tells you something. This is not just a gadget. It's not a toy. Are you going
to have to raise the price on the monthly payments long term? What do you think that looks like?
No, we have no plans right now to raise the price on the monthly payments. To understand the business model, I think the subscription is powerful because it allows us to continue to invest in the product. The reason why we can put so much work and energy into building the software in the way that we do, which is very differentiated, is because of the subscription business model. More importantly, it also allows us to know that we know who our customers are. We're not there to take your data and monetize it with someone else. We are there to support your health, and you pay us to do that, and that's why the subscription makes sense.
How do you measure cognition? What are the markers?
Yeah, so there's a lot of science that has studied the way people react to cognitive tests. And so for us, we do a very simple test. You have like 9 shapes that change. They're randomized between each test. You can't learn it. And 9 numbers. And we'll pop a number, and then you have to draw the shape. So we're measuring a bunch of things. We're measuring your cognitive speed. We're measuring the motion of your hand.
Okay.
Yeah, it's not the ring is not measuring your cognition. It's not some
That'd be pretty fantastic.
Tom Hale, thank you.
Welcome to Indianomics. What's puzzling about the rupee fall in the past 15 months is that it is happening at a time of modest current account deficit. Current account deficit, or CAD, is the extent to which current outflows like imports, interest payments on loans are higher than inflows like exports and remittances. Historically, over the past 30 years, India has run a CAD of just 2 to 2.5% of GDP, and we have had enough capital flows to fund it. In 2013, CAD went up to 5% of GDP and we had a rupee problem. But in FY25, India's CAD was only 0.6% of GDP and we still had a problem. Likewise, in FY26, CAD, or current account deficit, is only about 1.3% of GDP. We still have a falling rupee because capital flows are not enough. The problem is, historically, we always had enough capital flows, that is FDI and FPI inflows, to bridge the current account deficit. But in the past 2 years, we are not able to get capital flows even to fill smaller current account deficits. But then we can't do much about capital flows if investors are chasing AI stocks or commodity markets. What we can control is our exports and imports. Hence, the Indian government has signed a host of FTAs to boost India's trade. India signed 9 free trade agreements in the past 5 years, and 11 more are in the pipeline. The question we are asking today is, will more FTAs help us to bridge the current account deficit? Will they increase capital inflows in the form of FDI? Will they give us more services exports? Joining me are 4 experts: Arpita Mukherjee of ICRIER, Amita Batra of JNU, Rupa Chand, formerly of IIM Bangalore, and Professor Pralok Gupta of the IIFT, Indian Institute of Foreign Trade. Gentlemen and ladies and Mr. Gupta, thank you very much indeed for your time. Well, let me start with Arpita Mukherjee. Ms. Mukherjee, you know, I was looking at the data from UAE and Australia. Those are the 2 countries with which we first signed FTAs. They become effective in 2022, I believe. But if I looked at it, 22, 23, 24, 25, 26, it is not as if exports have grown a great deal. I mean, they've grown in some years, but, you know, to Australia, for instance, exports have grown by just 3% in FY26, 3.96%. It's not as if the FTAs have done wonders. Are the FTAs taking time to generate exports? How should we look at what to expect from the free trade agreements?
See, basically, the exports happen from the free trade agreement based on tariff phasing period. So you have to wait for 3 to 5 years to see a change. Having said that, the 2 countries that you selected are actually a very low tariff country. So they, any which way, had very low tariff. And the FTA that you selected with Australia is actually a mini deal. It's not a very comprehensive FTA covering wide range of products on both sides. Secondly, after the trade agreement is concluded and signed, it takes time for the implementation, and based on the phasing out, you see the benefits. So if you are entering a zero duty immediately on signing of the agreement, that will show something, or else you are going for like 5-7 years phasing out, then you will see the growth in exports slowly.
Okay, fair enough.
These are 2 things you have to take into account, and don't take all trade agreements from the account of, you know, that they will really boost export. It also depends upon the market. There are markets where you know, the custom duties are much lower than India. In most countries, they are lower than India. So, you know, when you are doing a free trade agreement, India may have to reduce the duty more than those markets. But there are many other gains of the trade agreement, like you bring in regulatory parity and all of that. That we can discuss later.
Fair enough. Fair enough. Professor Batra, would you want to add to this? What's your take? Is my whole premise to look at FTAs as a solution to current account deficit all wrong?
Not at all. Yes, exports are expected to be pushed up because of an FTA. But as has been said already, there has to be a distinctive higher preferential margin that we must be able to access the other market with. In case of Australia as well as EFTA, you see the tariffs on the other side are low, preferential margin is low, the incentive for our exporters is low. Plus, there is also another aspect, you see, which is that when we look at competition in these markets, particularly when we're talking about Australia, there have been some gains, as you mentioned, in the textiles and clothing sector. But these are far smaller than the rate at which you see a competing nation like Vietnam gaining in Australia. So these are, Vietnam is a country that's already present in these markets. It dominates these markets. And so there is existing first mover advantage for certain other countries that you have as competition. So export competitiveness, building that up for us as a prior to export and FTA benefits is very important. The second aspect that you mentioned in terms of the capital account bit of the overall balance of payments, I'd like to touch upon that too, because an FTA is not just supposed to be, I say supposed to be, just export push through the preferential access, but also the linkages that it provides any country in terms of integrating with global value chains. EFTA has an investment promise from the other side, but the commitment is another aspect.
Okay.
And so are the UK and the coming in EU, European Union FTAs,
Okay.
With all these, what we need is an additional component which ensures investment is part of the trade deal or as a separately negotiated parallel agreement. And that will come in when we have our own template, that is the bilateral investment treaty model of 2015, worked upon, that was promised in the budget of 2025, but we've yet to see the outcome of that. So it's the trade investment linkage that must be promoted and that must be protected and be a part of the FTA trade deal to give us the real benefits in terms of enhancing our exports and attracting FDI.
Okay, fair enough. Let me get Professor Gupta in. Professor Gupta, as has already been said, I am prematurely looking at the goods data alone. We have to look at investments and services. So if you can enlighten me on either of them, have our FTAs already signed or to be signed concentrating enough on promise of FDI? I think with the Europeans, there is some $100 billion commitment. Can you enlighten us? If we are not able to narrow our current account deficit, will the FTAs at least bring in enough capital flows to bridge that deficit?
Yeah, thank you, Lata. Just 2 points. One, before coming to your question with respect to, because you started your show with linking FTA journey with the current account deficit.
That's right.
So it is very important to note that our renewed journey for FTA, it started in 2020. So at that time, we were not facing any pressure on the rupee. So it's more a part of that. Exports are part of our more growth strategy when we are talking about the 5 trillion economy. But essentially, what I'm trying to say is that it's not that because CAD is high, so we are focusing on FTA. We have started FTA journey much ahead. And coming specifically to your question on the services and investment, yes. On the services sector, there are significant commitments from our FTA partner countries. So from like European Union, we have around 144 subsectors that have been committed by European Union out of the around 160 subsectors in the services side. The same is true for UK also. So more than 135 subsectors they have committed. And one thing which is very important to note in the services, that there is a commitment, there is a liberalization or commitment on a foreign direct investment in the services sector, which is in the trade parlance called Mode 3 or commercial presence. So India has made commitments on Mode 3. That means India has committed to allow foreign direct investment from these countries. So there is an expectation that significant FDI in the services sector will flow.
Yeah.
Second, on the 100 billion in the EFTA agreement that you talk about, the Switzerland, Iceland, Norway, and Liechtenstein, there is a provision that these countries will make 100 billion investment in coming 5 years. And if there is a shortfall, then the balance that have been achieved in the FTA, that could be recalibrated.
Okay.
So it's a more like incentive or facilitative element that these countries, the private sector are more promoted to make investment in the country. So I would say that these FTAs are geared towards having a multi-pronged effect on the economy in terms of investment, in terms of increasing exports, in terms of increasing imports to ensure the raw materials for India. For example, in the Australia deal, we have good provisions for the raw materials like cotton, chemicals, and different kind of raw materials, so that supply chains are completed. Also, there is a mutual recognition agreement, like with the Australia. You mentioned some data on the Australia. So last year only we signed a mutual recognition agreement on the organic foods.
Okay.
And so India's testing is India's standard that would be accepted in India.
Fair enough.
Now, see, where is the market for organic food?
Yes.
The market is in the developed countries.
Yes.
Now, if these kind of things are happening in the FTA, they will give benefit in different to the country.
I take your point, sir. If it has only happened last year, then I'm counting my chickens too quickly. We will have to give it time. Professor Rupa Chadha, thank you for your patience. Can you tell us if the FTAs are geared towards having more GCCs and other kinds of services? Is there evidence already?
Okay, so thank you very much, first of all, for having me on this show. First of all, the whole perspective of looking at an FTA in terms of its benefits is not about reducing deficits. And as previous speakers have said, it is much wider than that. It is about promoting exports, but it's also about increasing inputs and having, supply chain diversification, getting access to critical inputs, reducing manufacturing costs. So there's a range of things that you actually want from the FTAs. They're geopolitical, of course, as well. And second thing is that having a deficit bilaterally is per se also not bad. It could be because you're actually getting access to better quality inputs, and that feeds into better quality exports. You could be increasing your bilateral deficit, but actually increasing your exports to third market. Now, here coming to the services question that you specifically asked, yes, of course, we've seen that our surplus is there in services. We are seen to be competitive in services. However, not a sufficiently broad range of services. So we tend to focus on IT-enabled and professional services. So I would look at services much more broadly than, again, just professional services and IT services. And I would look at imports of services as well through Mode 3, which can enhance our overall economy-wide competitiveness. Okay. So what do I mean? I mean, for instance, logistics. Okay. That's a very important sector. Many of these sectors are actually open to FDI. Okay. Telecommunications. Okay. So what I'm getting at is that look at the service sector both as an enabler for exports in other areas, as well as our exports, which we already have, which we are doing very well at in areas like DCCs and IT services, professional services.
Ma'am, I have to run into a commercial break. Sorry for interrupting you. We're going to come back and take a more detailed look at all these verticals that you'll have spoken about. Mutual investments, getting into global value chains, more services, more investments, all those questions after the break. Welcome back to this very special Indianomics. I have four trade experts, Professor Arpita Mukherjee, Professor Amita Batra, Professor Pralok Gupta, and Professor Rupa Chanda, who have invested a lot of their research efforts on FTAs, designed them for India. Some of them, they've been part of the negotiations. They're asking whether at what point in time the FTAs will ensure that we are able to either get enough capital flows to bridge our current account deficit or to narrow the current account deficit itself. Ladies and Professor Gupta, thank you for your patience. Arpita Mukherjee, to start again at what is our current problem. I agree with all of you that we did not design the FTAs at a time or with the intention of narrowing current account deficit, because at that time, that was not the problem. But right now, we have that problem. So by when do FTAs mature enough for us to be able to milk them to give us either exports or higher investments? Does it take 5 years, 10 years to really marinate?
Lata, that depends upon when did you sign the agreement, when the agreement got implemented. So if you sign the agreement, see, there is a gap between the signing and the implementation. If you look at UK, it is almost a year. EU, it will be almost a year. So there is a gap between the signing and the implementation. And then after the implementation, there are trade partners have 5 to 7 years. In some cases, earlier FTA, we had 10 years to actually see the entire benefit. So there is a time period that is there. During this time period, let us understand, if you go back to your question of export versus import, during this time period, you also have to see that these countries are doing trade agreements with many other countries. Yeah. Some of them who have signed agreements before us, like Amita pointed out, and their implementation has already happened, whereas we are in a phase of implementation. So if you're looking by country, you need to also, the other thing is that if I am catering to Australia, I need to actually think what Australians will consume and like. They have a limitation to how much they can consume Indian products. Like, if I am going to sell basmati rice to everybody, there will be a limit to which they will consume basmati rice. So am I able to move up the value chain from a raw material intermediate producer to a final product that is needed by those markets? So this is also very important, and that's what I think Rupa was trying to push, was that whether my domestic economy is gearing towards the need of the partner country and customizing the product that is needed there. Okay. The moment we customize the product that is needed there, you will see a growth in our export. It takes a time for the industry to rethink, understand a new market, look at it from a liberalization perspective, that I am going to now get a easier access to this market and then move forward.
Fair enough. Ma'am, I'm sorry. I am out of time. This is a small show with too many good experts. We'll have to debate on a later day. But Amita Batra, when we did the ASEAN FTA, we got into trouble with a lot of Chinese goods coming, because the rules of origin were not very clear. Are we now ironing that out? Can we say that the new gen FTAs are better designed to ensure that our goods go to the destination countries more safely and we are not flooded with third-party products?
Thank you, Lata, for that very important question. I'll answer it in two ways, and be a little more specific. One, to also your earlier question, I really consider the UK and EU FTA, both of which to be yet implemented, to be more substantive, and I think to be more benefit yielding. Because both these have in them elements that can bring us value chain integration and possibility of immediate benefits in terms of 100%, for example, in case of textiles and clothing being brought to, of our tariff lines in that sector being brought to zero on immediate effect. Okay. But as I said earlier, there is competition, and so we need preparation. This preparation is very important. We have time as far as the EU FTA is concerned, and we need to bring our exports up to that level which will be accepted in those markets. There is a lot of potential in these markets. There's a lot of consumption, but we have to remember that there is also a lot of emphasis on sustainability. related regulatory standards in both the UK as well as in European Union. So prior preparation is important, When you talk about rules of origin, I think it's very important, A, that we not be flooded, B, that we are able to send our exports to the right destination in the right manner. As far as flooding is concerned, I have to say what the UK, for example, has adopted recently in terms of reduction of its quotas. India has somehow taken that as an issue to delay the implementation of the India-UK FTA. Now, I wish we had not done that because the issue of there, as far as dealing with the reduction of quotas for steel imports is concerned, should have been taken separately at the WTO, which we are. But we should have gone ahead with the FTA implementation, which was to otherwise come in May, because it has benefits of value chain integration, particularly also in a sector that we are very good at, such as automobile components. Although that would have been phased out over 10 years, but it would have given us a very, very good...
Dr. Batra, I will have to give you more time because this is a large topic, especially our relation with Europe. Unfortunately, the clock is ticking. Just 1 minute each to the other two guests. I'm sorry. Pralok Gupta, what's your sense in terms of when we will start getting the full benefits of these 9 plus 11, 20 FTAs? Do you think India's trade gallops by the time we get to 2030?
See, I think earlier speaker also pointed out that we are talking about this number 9 and 11 FTA, but only 3 FTAs, UAE, Australia and EFTA. They are right now in the implementation stage. The others are either just signed, not yet implemented, or still negotiated.
Yes.
To say that when they will come into implementation. But I say that their effect come into play in the short period, in the 3 to 5 year, but there are also long-term benefit in terms of increased whenever professional move to their countries, in terms of increased remittances flow, and also the innovative approaches that we now have in our FTA. For example, in the Australia FTA, we have post-study work visa.
Yes.
Our students going there, they will work and send the remittance here.
Yes, yes. Fair point. Got it, sir. Got it. I'm sorry, I'm out of time. Rupa Chanda, you can add one more sentence to this. Out of time.
Okay, so I will just say that for at least the UAE and the Australia FTAs, we are seeing some increase. Now, to what extent you can say that's due to the FTAs, that's always difficult. You have to look at utilization rates. But really, the benefits will come if you, in parallel, also have domestic reforms, scaling strategies, SME integration strategies. It would take at least around 3 to 5 years, as Pralok said, to see some benefits, but the longer term benefits of leveraging investment, technology transfer, digitalization, integrating services with manufacturing, these are really the things that will pay off in the long term. And there are many intangibles that will come in terms of quality, standards, skilling, capacity building, etc., which you cannot quantify with any bilateral trade
superb.
deficit.
That's an excellent last sentence to wrap up this discussion. We should not be counting them prematurely. It's just that there is this big problem of rupee and current account deficit sitting on our head, and we get these high, headlines of FTA. We try to link the two. We should know that this is a longer term effort. Thank you very much, ladies and Professor Gupta, for joining me. We will invite you for a more detailed discussion later on. That's it on Indianomics. Thanks for watching.
Hello. How are you? You wear anything else now?
I don't. If you see me 99% of time, I'm always wearing something comfortable and hence Bliss Club.
What's been the craziest thing in the last 6 years?
Craziest thing? Oh, so many. The fact that everyone says this one word, which is comfort, it's actually changed everything about how we think about, a large bit of what we do.
Okay, so this is a get ready with me, courtesy Meenu Margaret of Bliss Club, and she's ironing what I'm supposed to wear. So we're getting all set. Thank you very much. Thank you. Yes, this is the Bliss Club transformation.
I wouldn't have started Bliss Club. That's the honest truth. Everything that had to go wrong with a business went wrong with a business. We're called Bliss Club because the mission is to spread happiness through movement. We've only seen an ecosystem of low quality synthetic fabrics. So growing up, my mom would say, "Ye polyester hai." Matlab, this is low quality. If we're building it, we have to build it from scratch. And so that's what we did. And I think that's been the toughest part of our journey over the last 6 years. Our first product was called the Ultimate Leggings. This is your one legging that you need in your wardrobe and you don't need anything else. When you say that, hey, hip to waist ratios of women are different, we don't get the right length of our products or pockets, like I don't think they would ever relate to this, right? And like basic things, it feels too basic, but for a lot of women, it's life-changing. If the product is not the center of everything, then your marketing is just packaging something which is not great.
You have your startup, Vidit has Misho. Brother, how did the two of you get together? How did you meet?
We literally met at a New Year's party. 3 days later, we went out on our first date. And 3 years later, we got married.
Menswear, that is the latest category.
Vidit and I have had some very, very fun conversations on the table on, me trying to understand male anatomy.
Does the
levels,
focus
right?
group win the dining table?
Oh, much bigger than that. But
the market research is all happened at home.
Some questions I can ask only to Vidit.
For somebody who's looking at building a D2C business in India,
you cannot build 100 ultimate products at once, right? You do one thing, you do it really well. If we contributed to India's happiness index by just even 1%, that would be awesome.
You can eat 5 samosas and still be able to get into very stretchable pants. That should make a lot of people happy.
Or that.
From the gym to the boardroom, performance wear is no longer about workouts alone. It's becoming everyday uniform, and one homegrown brand is sprinting to capture that shift. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Founded in 2020, Bliss Club is a community-first apparel brand that's reimagining activewear for the Indian consumer. The company today has scaled to an ARR of 300 crore rupees, serving over 1 million customers with 16 brand-owned stores and a strong D2C engine that contributes nearly 70% of its business. At a time when most apparel brands rely heavily on marketplaces, Bliss Club is betting on control, from proprietary fabrics engineered for over 12 months to a tightly managed supply chain and a capital-efficient, near-zero working capital model. The result? Differentiated products built specifically for Indian bodies and a brand that's growing fast with nearly 90% year-on-year growth. But the real play is larger. As performance wear blurs into workwear, travel wear and daily essentials, Bliss Club is widening its playbook, moving beyond women's activewear and stepping into menswear, tapping into the global shift towards all-day high-performance dressing. Joining me now is Meenu Margaret, the founder and CEO of Bliss Club. Meenu, it's great to have you join us here on Young Turks. 6 years on, and who would have thought that a company that was founded in the middle of the pandemic, has today been able to get an ARR of 300 crore?
Yeah, no, thank you for having me, firstly. And it's been a really exciting journey from where we started, which is literally our 2-bedroom apartment in Kormangla and one of the bedrooms there.
Many stories in Bangalore have started like that. Many of India's startup unicorns have started like that.
Kormangla is the place, But yeah, from the bedroom to the offices now to, having offline stores, it's been incredible. It's been super fun and very exciting as well.
Let's wash some dirty lid in public now.
Okay.
What was the reaction when you said, okay, I'm giving up on the PhonePe job and I want to try my hand at entrepreneurship once again?
To be honest, friends, mostly everyone was starting up. So it just felt like, yeah, of course you're going to try as well. But I think with family, everyone was super excited. I mean, to be honest, like that's what Bangalore does to you. Like if you're not starting up, then what are you doing, right? It's almost like that. But everyone's been more than excited and helpful. And I think that's the ecosystem, right? Because I was just telling someone I met just earlier today that in Bangalore, it's just this like bunch of people who are excited to build something, and everyone's so helpful. Everyone, like even when I started Bliss Club, I reached out to at least 100 people. 60 of them probably had a conversation with me, told me about what it takes to build an apparel. I don't come from an apparel background myself. So yeah, I think it was great. And I think Bangalore is very accepting of people starting up. And yeah, I think family was more than excited for me. Yeah.
So, getting to the idea of wanting to get into activewear. Now, COVID happened. So it was a breakout moment globally for this industry.
Yeah.
But how did you come upon wanting to do that and doing it in an Indian way for Indian bodies, for Indian shape?
I was exploring a couple of other ideas. One of it was in EdTech, but it didn't go too far. I couldn't build conviction around it. The third problem statement I looked at was actually this, which is that, hey, there is traditional sportswear, which is meant for the gym, but there's this entire part of my wardrobe where I just need great basics, but which are really functional. But I'm wearing it to work, I'm wearing it to, travel, casual occasions. But in India, you only have sportswear. So why is this entire category of just, great basics, which are super functional, why does it not exist in India? So I was looking at this. This is my last idea. November 2019 is when I was looking at the idea. December, I was speaking to someone in China, exploring the whole, the fabrics and, how do I go about doing it again, because I don't come from an apparel background. And at that time, she was like, hey, you know what, there's something going on here. There's this, people are falling sick. And I'm like, okay. And then 3 months later, COVID hit. Just the timing really worked out in some way, right? Because at that time, and we're called Bliss Club, because the mission is to spread happiness through movement. So we started as an Instagram page. We were doing a lot of Zoom sessions, WhatsApp sessions of, Zumba, bachata. A lot of people don't talk about this, but I think it is also an inflection point of people over-indexing comfort in their apparel, where when we stayed at home for 2 years and we realized what it feels like to be in pajamas for 24 hours in a day, you didn't go back wearing, uncomfortable clothes which are so tight on your body, or, it makes you think about your waist the whole day. And I feel like that's the inflection point that the world and India specifically was waiting for, that comfort matters so much more, and hence you are going to index on this comfort for your daily life and whatever you wear. And
you have no experience in apparel, as you pointed out, no experience in building a supply chain. The decision to actually engineer the fabric, to invest in that, where did that come from?
The first time I went to a factory is after I decided to start an apparel. And that's the first time I realized that human beings stitch clothes and not machines. I did not know that every single chaddi in the world, every seam of that chaddi is stitched by a human being somewhere. I somehow thought that there are conveyor belts and things just get stitched in a conveyor belt. If I knew what it took to build this ecosystem around functional fabrics, technical fabrics and technical fits, I wouldn't have started Bliss Club. That's the honest truth, because I think what I realized after I started was that most larger brands in India, most incumbents in our category are all global brands. And most of these brands don't have design or product development teams in India. So they're either based in Germany or the US or Japan. And so India doesn't have talent that knows about technical fabrics, that knows about technical fits, because a lot of our products are very close to body. It has to fit a certain way. Our fabrics are engineered for different degrees of friction, movement. And so I then realized that, this talent is non-existent in India. If we're building it, we have to build it from scratch. And so that's what we did. And I think that's been the toughest part of our journey over the last 6 years. I think we spent the last 3 years, honestly, just building out our supply chain and our sourcing and product development team.
So where does all the sourcing happen from?
So 80% of the sourcing happens outside of India. And that's actually the case for most, technical fabrics. Because India is great with apparel production in cotton. India's been a cotton producer, a cotton manufacturer, and hence a cotton producer, consumer, right? But cotton is not the best performance fabrics because cotton does not have intrinsic, stability. It is a natural fiber. It does deteriorate. It fades after some wash. It doesn't take a large amount of stretch. So mostly synthetics and high quality synthetics is where the whole performance fabrics really stays. And India's never had that ecosystem. And so most of production happens outside of India. Most of these are large export manufacturers across, Indonesia, Sri Lanka, Bangladesh. And so that's broadly our sourcing base. And I think that's one thing I've realized, right? Like India, so growing up, my mom would say, ye polyester hai. Matlab, this is low quality, right? And I think India's always seen that we've only seen an ecosystem of low quality synthetic fabrics because we've just been a very rich cotton, manufacturer and consumer. But there's a whole world of very, very high quality synthetic fabrics, which are great on performance, great on durability, great on your skin, are not bad for your skin. And I think India's never seen that. And I think that's the single line opportunity I feel exists in India, that there is a whole world of high quality synthetics and performance fabrics we can bring to this country in terms of quality that this country hasn't seen. And that's what excites us. Like what you're wearing.
Yes.
This
Which
is not
Bliss Club.
this is not what typical polyester feels like, because
it doesn't.
We grew up feeling like polyester should feel plasticky, they feel rough, they itch on the skin. We have all of these, and including me, like before I started, I had all of these things that came with it. And now I'm wearing the most high stretch pants, which are super comfortable. I can go to the gym with it. I can go to work with it. This remains exactly the same after 100 washes. This does not, you can't do this with natural fibers.
rate.
So many people talk about textile as being the big multiplier in terms of jobs. It is a labor-intensive sector, and how India has lost progressively space to countries like Bangladesh, Vietnam, so on and so forth in the textile and apparel space. What do you believe we need to do to prioritize focus on this sector and ensure that we move the supply chain to India?
I think two parts to it. One is cotton, the other one is non-cotton. And I think with cotton, India is probably among the top 3-4 countries in the world in terms of producers, manufacturers, all of this, right? And exporters. I think one is synthetics is a place where we haven't really evolved to. And synthetics requires also very high capex investments when it comes to factories and manufacturing, because these are naturally, man-made fibers and man-made fabrics. And I think with India and how manufacturing has evolved, I think there are very few high capex, large factories and manufacturers when it comes to, yarn stage and, fiber stages. And I think given how with our joint families and how manufacturing and like family businesses have evolved, it keeps breaking down into smaller manufacturing units, and hence synthetics has not seen that evolution in India. So I do feel like from that lens, there are maybe a handful, maybe in fact just a couple of maybe $1 billion plus revenue manufacturers when it comes to apparel in India. And I feel like there's so much opportunity in terms of just investment into this sector And I think that scale of investment is required for synthetics to grow.
You know, from idea to getting your first check, getting the first investor on board, what was that meeting like?
So like I said, we started as a community. First 9 months was just the community, and then we launched our first product.
And you launched with one SKU.
Yes.
So that was it.
Yes. That was actually, again, very, very counter anyone's opinion from apparel.
I would imagine, because people would have told you, like, what are you thinking? How can you just launch with one product?
Correct. One SKU, not even a product.
Yeah. What gave you the conviction?
So literally everyone is like, in apparel, people want choice, and you have to launch you have to give them a selection. You have to give them a bouquet of products and let people choose. In my head, I was like, the problem, like our category is a very problem solution category, right? So if there is a problem, we build a solution to it. So you don't really need a bouquet of solutions. You need a single, well thought out, well executed solution. The idea was that if we build this one product and it's truly ultimate, then why does she need anything else? And hence our first product was called the Ultimate Leggings. And it was that this is your one legging that you need in your wardrobe, and you don't need anything else. And so we solve for everything from fabric. How can you build a high stretch synthetic fabric that feels like cotton? How do you give it as much functionality as it possibly requires? So it had 4 pockets, it had the right Indian, I'm 5'2" in height. And so it had the right length. So built for our heights, for our bodies, our shapes, our waist to hip ratio. And so the idea was that if we can solve all of this really well, why not launch with just this one product? So I think it was more of conviction on this is how our category should be built out. This is how we start off. And so the idea was that if this one thing does not solve a problem, then nothing else will. So it was just a little bit of let's go all in and figure out. And I think a large bit of our journey of building and my personal journey of building an apparel has also been slightly contrarian. And so it just felt like this is the right thing to do. Let's do it. And it doesn't matter what.
Do you think, you said that you had support from family and friends when you decided to start up.
Yeah.
But what about investors? And we hear this from a lot of women, that it's harder as women founders to raise capital.
It is harder. And I must say that. And I don't think I would shy away from saying that in any way. And I think it's harder because specifically for my category, we started off as a women-only category. In the recent past, we have now men's.
Yes, expanded into men's.
Yeah, and now it's easier already, Sharon. Now I'm like, hey, why don't you just try my product? But I think the honest truth is a large bit of the investor VC ecosystem is skewed towards men. When you say that, hey, hip to waist ratios of women are different, we don't get the right, length of our products or pockets, like I don't think they would ever relate to this, right? And like basic things, it feels too basic, but for a lot of women, it's life-changing. I think for me, so I have a woman partner and a male partner, and both Mukul and Shweta are very, very high empathy people, and I think have, so Mukul from Elevation was part of my seed round. I remember the conversation with him, which was, hey, Mukul, can you review my pitch deck? He was looking at the deck and he's like, oh, but these numbers are great. You're already doing this much with just this one product and you're like growing so fast. Like, let's explore this. And I'm like, so that round was mainly supposed to be an angel round, and it ended up being a institutional round. But yeah, I think that time the numbers were just speaking for itself. We were growing every week with just this one SKU, and so that was really exciting. And they happened to speak to a lot of customers and kind of build conviction. But yeah, I think for a lot of women first businesses, it is a problem, and I think it is like I'm hopefully like now seeing some bit of a change, like green shoots of change. But I still feel like it's we have a long way to go on that.
We do have a long way to go. What were some of the most the questions that you think that you were asked that you believe Vidit or any other male founder was not asked?
In the recent past, I've been asked, and especially after I've had a kid now, on if you decide to have another kid, and I'm a single founder. So if you decide to have another baby, how would you manage the business? I'm 100% sure no male founder has ever been asked, if you have another kid, how would you manage your business?
Yeah, Vidit was never asked this question,
never asked,
right?
Of course not. And we both had the kid at the same time. Why are you questioning me just because of my gender? But yeah, that's unfortunately where India is right now, and we have a long way to go.
It's not just India. It is a global issue. Yeah, it is a global issue as well. But and this is what I want to talk to you about, because you have your startup. Vidit has Meesho. But how did the two of you get together? How did you meet?
We met 13 years back. We met at a New Year's party. It's actually a very serendipitous story. Yeah, this was, I think both of us were preparing for GMAT around the time we met. So this was right before Meesho, 6 months before he started up. But yeah, we literally met at a New Year's party. And 3 days later, we went out on our first date. And 3 years later, we got married.
The conversation that you and Vidit had, when you decided to have a child, both of you are founders running your own individual businesses.
Yeah.
How is this all going to work? Who was going to travel? Who was going to stay at home? I mean, did you have a conversation about this, about sharing the load, sharing responsibilities?
We have an Excel sheet for everything. So we had an Excel sheet for this as well. So a lot of things we learned along the way. But I think for the first 6 months, I had to go back and went back to work 3 weeks after I delivered, right? And so we had to figure out, I was breastfeeding, how does this happen? So with it, my mom and my mother-in-law would do night duty. So I never slept with the kid. He's been fully involved with bringing up Ira from day one, including sharing the load on the breastfeeding, which actually is a very, very intense journey, which a lot of people don't talk about because the kids literally depended on you to stay alive. But I could sleep through the night, get up in the morning, go to work. And then, we manage things that way. Even now, Vidit does the groceries at home. He manages the kitchen. I do the rest of the half. So we have a very, very, equal share in terms of how we manage our household.
Menswear, that is the latest category that you've decided to try and disrupt. Take me through what the ambition is. What is the aspiration from here on?
We started with women. We started with women activewear because that was just the larger white space. Like absolutely no one was building for women. Definitely not in the functional apparel space, and felt like this is where we wanted to start from. We wanted to do a few things and be significant for few people before we decide to do everything for everyone. And so I think 6 years in, we've been very excited about building for men. I think men shop a lot more closely to our category as well, right? Functional, comfortable clothes. If they like something, one in every color. We've been cooking menswear for the last 3 years at Bliss Club, to be honest. So the idea maybe 3 years ago, actually fabric 2 years ago, and then product for the last 12 months. But we've been like super, super excited about building for them. Last 6 years has been learning curves in different levels.
The focus group in the dining table.
Oh, much bigger than that. But
the market research has all happened at home.
Some questions I can ask only to with it. But no, I think we're spoken to like 50, 60, maybe 100 men over the last 18 months. We wanted to launch for men exactly how we launched for women as well. So very few products. We launched with a single pair of pants, a jacket, a polo, and a crew neck. So 4 products. And the idea was that let's do these 4 things, but do it really well and solve for specific problem statements that they have. A large bit around fit, which, to be honest, before I started building for men, I didn't think fit as a thing was a big issue for men. I thought most men were pretty okay with fit, and I thought women had bigger problems because of curvy bodies and different shapes. But men have just as much issues as women have in terms of fit of products as well. And then, of course, fabric is a large bit of it. So even when we've launched for, the men's polo, for example, it's a high durable, you can use it for 100, 200 washes, but it feels exactly like cotton, though it's not. And, it just kind of becomes your go-to polo. And for a lot of people who've spoken about that, they absolutely love it. So very, very excited. Building for men's is a whole new learning curve for me and for the company. So we're kind of building it in our own way and building it the way men we should for men. And I think offline, has been exciting for us, and we've gone through our own journey with offline. I think we're at this point where, and we started offline because if you feel the fabric, you know why our fabrics are differentiated. It's tough to communicate that online. Online, everyone makes tall order claims. Like there's nothing that differentiates us from any other brand if everyone's claiming the same thing. But the moment you feel the fabric and you fit the product, then there is no asking why is Bliss Club different from any other brand in the market. And we found that, extremely strong product market fit offline. So our offline stores do incredibly well. They're growing,
How many do you have today and how many do you intend to set up?
We have around 22 stores closed, so 16 live and 5 in the pipeline. But the idea is to get to our next, from 20 to 100 stores in the next 2 to 3 years. So that's what we're working backwards from. That's also why I'm in Delhi, actually, looking at stores. Yeah. So I have a whole hectic day today with a lot of store visits. But I think stores are, an exciting journey for us. And it's that inflection point where we're looking at larger stores and doubling down on offline.
A lot of the Bliss Club story has been about storytelling as well. So let me end by asking you, if you were to tell the Bliss Club story today to somebody who's not really familiar with the product, what would you say?
If you look at India and India's happiness index, we are ranked, I think, in the last 10 among all the countries in the world. And, it always felt like, where we seemingly seem like such a happy country. We have all of this culture, all of these festivals, but why we ranked so low? Why are Indians so unhappy? And it just felt like, 20 years later, if because of Bliss Club, people started moving, and if we contributed to India's happiness index by just even 1%, 1 point up, that would be awesome.
You can eat 5 samosas and still be able to get into very stretchable pants. That should make a lot of people happy.
Or that. And if we can kind of be part of that journey and help India move in that direction, then that'd be super, super awesome. So that's the story I want to look back and tell myself, that, hey, we were part of that journey and we contributed this teeny weeny percentage to make this country more happy. That would be like pretty awesome. Yeah.
Well, we wish you all the happiness and we hope that you continue to clock all the milestones that you have set out for yourself, as well as for Bliss Club. Meenu, it's been an absolute pleasure. Thanks so much for joining us here on Young Turks Reloaded. We look forward to hearing much more from you in the future.
No, thanks for having me, Shireen. Super awesome.
Movement is medicine, and you heard it from Meenu Margaret herself. We are going to take a break here on Young Turks Reloaded. As always, send us your feedback. We always like to hear from you. Till next week, from the entire team and more startup stories. Goodbye, and thanks very much for watching.
services company IPOC Schuster LLC doing the honors at the Nasdaq in Times Square. Octave Intelligence, a enterprise software company celebrating a spinoff from Hexagon AB. And at SIBO in Chicago, it's the Security Traders Association of Chicago's Stacked Face-Off Hockey Tournament and the Sopel Foundation for Dyslexia. Brent Sopel of the 2010 Blackhawks champs among those in attendance. Jim, as we are holding 7,500 for sure by about 20 points.
No, I want to go in Salesforce. Mine was